Hello CMA final students. I have done comprehensive revision of PGBP and depreciation. For your December 2025 examinations, question number 2 is relating to calculation of total income and tax liability. To solve that question, this revision is immensely helpful for you. Good thing is, whatever this material is there, entire concept book, PGBP and depreciation, I am giving this concept book for you at free of cost. You can go to my website phoenixbyuma.com. There are free resources on dashboard. In that, select course CMA final. You select revision CMA final December 25. You can see PGBP and depreciation CMA final concept book December 2025. You just click on it. You can download entire material PGBP and depreciation. You can start studying using that material. Free of cost I am giving. Another important thing, whatever the running notes, even running notes also I uploaded on free resources. So during the lecture, whatever the running notes that I have discussed, entire running notes is made available for you. I have done question paper analysis. In that I told 8 important chapters. From 8 important chapters only, all descriptive questions are asking. Out of 8 important chapters, I have done revision of transfer pricing. Now I have done revision of PGBP and depreciation. And with regard to transfer pricing, I released one question bank. That also you can find in free resources. Transfer pricing very important because 28 marks, 4 questions, 4 into 7 marks, 28 marks are asked in June 2025 exam. Very important. You can see transfer pricing question bank. See, the number of problems are high, around 60 problems I gave, but please solve them. I compiled all the transfer pricing questions from June 25 exam, December 24 exam, June 24 exam, and June 24 MQPs, June 25 MQPs, December 24 MQPs. All of them I have compiled and have given in transfer pricing question bank. You can download and you can start doing the problems. For PGBP also, like today itself, I am going to upload PGBP question bank. You solve all the problems. I have covered all past exam questions, past MQPs. Okay, this is going to be very good resource for you. Listen all the revision classes, do all the problems for 8 chapters. I have covered in question paper analysis 8 chapters. For all 8 chapters, I will revise, I will give question bank to you. Solve all the problems. Definitely you will clear in CMA final December 2025. After solving all the 8 chapters, like if you do not clear, then come to me, because you know almost all past exam questions, past exam MQPs, everything is covered in those question banks. All those question banks I will share to you at free of cost. They will be immensely helpful to you. If you do all those questions, you can go to examination very confidently. And trust me, if you prepare all those questions very well, you will definitely clear. Now let us start revising PGBP. What are the sections covered under PGBP? Section 28 to 44, these are the sections that are covered under PGBP. What is the charging section? Charging section is section 28. What is method of accounting followed under PGBP? See, under PGBP, if SSC wants to follow accrual basis, he can follow accrual basis. If he wants to follow cash basis, he can follow cash basis. So cash or accrual basis as may be followed by SSC. There are some exceptions, 32, 35D, 35DDA, 43B. In these cases, deduction is allowed on cash basis. Okay, like 35D, 35DDA, like VRS compensation expenditure, that is allowed as deduction in cash basis. So generally cash or accrual basis as may be followed by SSC except these sections. Okay, next we will discuss charging section. Charging section is section 28. What charging section says? Any income that is received out of either business or profession, that income is taxable under PGBP. So whatever the income that is received out of business or profession, that income is taxable under PGBP. Here profession includes vocation also. That means not only from profession, even from vocation also, if any income is received, that income is also taxable under PGBP. Normally profession means there will be some formal training. Vocation means there is no formal training. A person will do same work over a period of time and he gets expert over that work, and through that work he earns livelihood. Okay, that we call as vocation. Tailoring is there. For example, no formal coaching was taken, but daily he will do tailoring. He became expert in tailoring. Through tailoring he is earning income. Even that income is also taxable under PGBP. So simply income from business, profession, vocation, all these incomes are taxable under PGBP. Next, compensations. See, in business, we enter into various contracts. For violating the contract, if any compensation is received, that compensation is taxable under PGBP. Are you able to understand? Let's say I entered into contract with MRF tires. I will purchase 5,000 tires after 2 months. But after 2 months, I did not purchase tires. I breached the contract. For breaching the contract, I paid compensation of 10 lakhs. Now 10 lakhs is expenditure to me. The same 10 lakhs is income to the receiver, and such income is taxable under PGBP. Are you able to understand? So in business, if any compensation is received, either with regard to termination or modification. Termination means what? Cancellation. Okay. Modification means change in scope. So, for change in scope of contract or for cancellation of contract, if any compensation is received, such compensation is taxable under PGBP. Are you able to understand? If interest on compensation is received, interest on compensation is taxable under income from other sources. Let's say, like I am authorized dealer of Apple mobile phones. Now Apple mobile phones, it cancelled my authorized dealership. For cancelling authorized dealership contract, Apple paid me compensation. Whatever the compensation that I have received, that compensation is taxable to me under the head PGBP. Are you able to understand? Now, along with compensation, I also received interest on compensation. Interest on compensation is income. Such income is taxable under income from other sources. Okay, next. Income derived by trade, professional or similar association from specific services provided to its members. See, generally, I am member of ICAI, but ICAI will conduct some seminars, GST workshop, income tax workshop, AI workshop, for providing specific services to me. If my institute charges fees from me, if I pay any fees for getting specified services from professional association, ICAI, whatever the fees that I have paid, it is income to ICAI, and such income is taxable under PGBP. So simple, either trade association or professional association. From its members, it is getting fees. Why it is getting fees? For providing specific services. Okay, so exclusively for members, if any specific services are provided and if any fees is charged, such fees is taxable under PGBP. Are you able to understand? Export incentives, you all know, duty drawback and profit on sale of import entitlement license, cash assistance against exports, all these benefits are taxable under PGBP. Are you able to understand? Next, perquisites. See, during the course of business or profession, along with fees, if I get any additional benefits, those additional benefits are perquisites and those additional benefits are taxable under PGBP. For example, let's say I went for audit. My audit fees is 2 lakh rupees. Client is so much happy with my work. He paid 2 lakhs audit fees. Along with 2 lakhs audit fees, he gave one mobile as gift to me. Value of mobile is 50,000 rupees. Now, along with 2 lakhs audit fees, I extra got 50,000 worth of mobile as perquisite. Now, whatever additional benefit that is received during the course of business or profession is there, that value of mobile is taxable to me under the head PGBP. Are you able to understand? You all know in CA inter, CMA inter salaries you have studied. Perquisite means additional benefit. If perquisite is received from employer, taxable under salaries. If perquisite is received during the course of business or profession, then whatever the perquisite received, that is taxable under PGBP. Okay. You all know, in case of partnership firm, share of profit received by partner from partnership firm, share of profit is not taxable to partner because already partnership firm had paid the tax liability. That's why share of profit received by partner from partnership firm is not taxable. Next. So, very simple, partnership firm, partner. From partnership firm, share of profit is received. Is it taxable? Share of profit is exempt. Are you able to understand? From partnership firm, if any interest, salary, bonus or commission is received, then it is taxable to the partner. Whatever the salary, bonus, commission that are received are there, they are taxable to partner under PGBP. Are you able to understand? So very simple. Partner getting share of profit, exempt. Partner getting interest, partner getting salary, remuneration, bonus, commission from partnership firm. Those incomes are taxable to the partner under the head PGBP. Are you able to understand? Non-compete fees, you all know. For avoiding competition, if any non-compete fees is paid, that non-compete fees is income received and such income is taxable under PGBP. Are you able to understand? For example, I am teaching direct taxation. There is also another faculty who is teaching direct taxation. That faculty came to me, Umasankar sir, stop teaching DT. I will give you 3 lakh rupees if you stop teaching DT. I said, okay, I am not giving competition to him. For not giving competition to him, I took 3 lakh from another DT faculty. Now, whatever 3 lakhs that I have received, that is non-compete fees and it is treated as income and such income is taxable under PGBP. Are you able to understand? Fair market value of inventory on conversion of capital asset. See, whenever stock in trade is converted into capital asset, on date of conversion, whatever the fair market value is there, whatever the fair market value of stock in trade is there, the fair market value of stock in trade is taxable under PGBP. Are you able to understand? Next. Any amount received for a capital asset on which 100% deduction was claimed under section 35 AD. What do you mean by this? For claiming deduction, like under section 35 AD, specified business, 100% expenditure is allowed as deduction. So if you buy any asset for specified business for which you have claimed 100% expenditure as deduction, subsequently on sale of that capital asset, if you get any amount, that amount is taxable under PGBP. For example, I am running hotel business, 4-star hotel. It is a specified business. In 4-star hotel, I purchased the air conditioner for 80,000 rupees. Now total 80,000 rupees I will claim as deduction in P&L account. So tomorrow, if I sell that air conditioner, I got 60,000 rupees. That 60,000 rupees is taxable under PGBP. Are you able to understand? Next, speculative business. When can we call a business as speculative business? Very simple. Intraday trading is best example for speculative business. In case of speculative business, there is no physical delivery of shares, there is no physical delivery of securities. And transaction settlement will also happen in terms of margins. That type of business we call as speculative business. For example, in case of intraday trading, like when you buy shares in intraday trading, shares will not be credited to your demat account. Whenever you sell shares, shares will not be debited to your demat account. So in case of intraday trading, there is no physical transfer of shares because on the same day you will buy share, on the same day you will sell the share. So ultimately, if you get profit, amount will be credited to your bank account. If you lose, If you lose money, amount will be debited from your bank account. So in case of intraday trading, there is no fiscal delivery of shares, and transaction settlement also will not happen for whole amount. Transaction settlement will happen only for profit or loss. Such type of business we call as speculative business. Best example is intraday trading. Are you able to understand? Next. In case of company, generally companies are formed for certain objective. Companies will be formed for doing specific business. Let's say one company is engaged into transport business, it will do only transport operations. One company is engaged in selling gold, it will do sale of gold only. So in case of company, if it is engaged into trading, okay, whether the trading is intraday trading or long term trading, both are treated as speculative business only in case of company. Are you able to understand? Do you notice the difference? In generally, intraday is only treated as speculative business. But in case of company, company is formed for certain specific objective. Then why company should do trading? So whenever company do trading, whether it is intraday trading or long-term trading, such trading by company will always be treated as speculative business. Are you able to understand? So generally, only intraday trading will be treated as speculative business. But in case of company, both intraday trading and long-term trading will be treated as speculative business. Are you able to understand? You all know speculative business loss can be set off only against speculative business profits. Speculative business loss cannot be set off against any other income. It can be set off only against speculative business profits. Are you able to understand? Next, transactions not deemed to be speculative. See, you know hedging, you would have studied in your financial management. So whenever you enter into hedging contract means what? To stop your loss, to reduce your risk, to minimize your risk. If you enter into hedging contract, so entering into hedging contract is not treated as speculative business. Are you able to understand? So hedging contract in respect of raw materials or merchandise is not treated as speculative business. Hedging contract in respect of stocks and shares and derivatives forward contracts. Remember, 4. Hedging contract for raw materials, hedging contract for shares and stocks. If your main business is buying and selling of shares, then risk is there. To reduce your risk, you will enter into hedging contract. Hedging contract is not a speculative business. It is specifically excluded from speculative business. Okay. Next, forward contract is not speculative business. Dealing in derivatives is also not treated as speculative business. That's all about speculative business transaction. Okay. Next, we will discuss expenses, section 30 to 38 expenses. I hope you are clear till here. Next section 30, building expenses. See, two options are there. With regard to building, you can be either owner or you can be tenant, correct? If you are owner of the building, what are the expenses you will claim as deduction? You will claim depreciation, you will claim repairs. See, only revenue nature of repairs are allowed as deduction under section 30. Capital nature of repairs are not allowed. If there is capital expenditure, capital repairs, that will be added to cost of building and it will be allowed as deduction over a period of time in the form of depreciation. Are you able to understand? So, only revenue nature of repairs are allowed as deduction. Next, property taxes. If you pay any municipal taxes with regard to building, those property taxes are allowed as business expenditure. Next, if you pay any insurance premium, see, with regard to building also, we will pay fire insurance premium. Fire insurance premium is expenditure with regard to building and it is business expenditure. It is allowed as deduction. Are you able to understand? Next, as a tenant, important. Owner, you will claim depreciation. As a tenant, can you claim depreciation on building? You cannot claim depreciation on building. As a tenant, you will claim rent expenditure. Are you able to understand? Rent or repairs. If repairs are done by tenant, those repairs expenses tenant can claim as deduction. Next, property taxes, insurance premium. All these expenses can be claimed as deduction as a tenant. Are you able to understand? Next, some note points are there. If building is used partly for business purpose and partly for personal purpose, with regard to business purpose, whatever the expenses are there, only those expenses are allowed as deduction. For example, I am CA in practice. In ground floor, I have practice. In first floor, I am doing like I am living. That means ground floor is used for professional purpose, first floor is used for personal purpose. Now only 50% depreciation I can claim as deduction. Are you able to understand? Because building is partly used for business purpose and partly used for personal purpose. So if building is partly used for business purpose, how much percentage of building is used? Only that much percentage of expenditure is only allowed as deduction under PGBP. Are you able to understand? Next. Notional rent. See, in case of sole proprietor, generally, let's say I am owner of the building. In that building, I am doing practice. I will claim depreciation. Along with depreciation, if I give this building on rent to some other person, I would have got rental income. As I am using my building for my practice purpose, I am not getting rental income. Opportunity cost, I missed rental income. That notional rent, can I claim as deduction? I cannot claim as deduction. Are you able to understand? So the thing is, depreciation, rent, both are mutually exclusive. If you claim depreciation as deduction, you cannot claim rent as deduction. If you do not claim depreciation as deduction, then you can claim rent as deduction. Are you able to understand? Capital repairs, you all know, capital repairs will be added to cost of the asset, and capital repairs are not allowed as deduction in a single year. They are allowed as deduction over a period of time in the form of depreciation. Are you able to understand? Next, with regard to plant and machinery, section 31 also, same concept. If you are owner of plant and machinery, you will claim depreciation, you will claim revenue repairs, you will claim insurance premium paid. These expenses you will claim as deduction. If you are tenant of plant and machinery, that means you took plant and machinery on rent, then whatever the rent expenditure that you have paid, it is allowed as deduction. If you do minor repairs to plant and machinery, those are also allowed as deduction. If you pay any insurance premium for plant and machinery, that insurance premium is also allowed as deduction. Okay, you can see. But very important, see this note point, third note point. Repairs means an expenditure incurred to keep an asset in good working condition. Repairs includes minor renewal, renovation, repainting, rewiring, replacing parts of an asset like a motor in a machinery. Repairs excludes, important, repairs excludes full replacement of asset, reconstruction or rebuilding of entire structure or machinery. What do you mean by this? See, I purchased one asset. There was some fault. The machine, the existing machine was replaced with a new machine. Whenever replacement is done, please consider replacement as buying of new asset. Okay, replacement is not treated as repairs expenditure. So like repairs includes all revenue repairs, but if there is a replacement or reconstruction, then it is not treated as repairs, it will be treated as fresh purchase of the asset. Are you able to understand? So that's what. So section 30 we are done. Section 31 also we are done. Next we will discuss section 32, very important, depreciation. My dear students, at the end of this PDF, PGBP is also available. I request you to open PGBP. Sorry, I request you to open depreciation. You can see once PGBP gets completed, then depreciation concept is there. Please open depreciation concept. I hope till now you are clear. Please respond. Next, depreciation. One thing is very clear. Depreciation as per accounts is different. Depreciation as per income tax is different. Under accounts, we will calculate depreciation for each asset independently. But under income tax, we do not calculate depreciation for each asset independently. Instead, we calculate depreciation under income tax for group of assets. That group of assets we call as block. So, the point is, under accounts, for each asset separately we will calculate depreciation. Under income tax, we will calculate depreciation for a block. We will calculate depreciation for group of assets, which is also called as block. Okay, so under income tax, block wise depreciation will be followed. Next point, under accounts, there are many methods to calculate depreciation. Straight line method, written down value method, like production units method, machine hours method, like this. But under income tax, there is only one method to calculate depreciation, that is written down value method, except in case of power sector undertakings. See, power sector undertakings, they can follow straight line method or they can follow written down value method. Remaining all persons in PGBP, they should follow only written down value method to calculate the depreciation. Are you able to understand? Now, we will classify all assets into blocks. All assets will be classified into block. But to classify assets into block, two conditions are required to be satisfied. Condition 1, all assets in the block should be of similar nature. Similar nature. And all assets in the block shall have same rate of depreciation. Are you able to understand? That means two conditions. All assets in the block must be of similar nature. All assets in the block shall have same rate of depreciation. Using these two conditions, we are going to classify assets into blocks. Are you able to understand? Similar nature, same rate of depreciation. Next, conditions for allowance of depreciation. If you want to claim depreciation, two conditions are required to be satisfied. Condition 1, you should be the owner of the asset. That means what? Tenant cannot claim depreciation. Only owner of the asset can claim depreciation. So if you want to claim depreciation, you should be the owner of the asset. Then only you can claim depreciation. Otherwise, you cannot claim depreciation. That is condition number 1. Condition number 2, asset shall be used for the purpose of business during the relevant previous year. What do you mean by this? Only if asset is used in business, then only depreciation is allowed as deduction. Let's say I purchased a mobile. I am using this mobile for my personal purpose. If I use mobile for my personal purpose, why is it allowed as business expenditure? Why depreciation on mobile is allowed as business expenditure? No, only if asset is used for business purpose, then only depreciation will be allowed. So to claim depreciation, two conditions. You should be the owner of the asset and you should use the you should use the asset for business purpose. Then only you can claim depreciation. Otherwise, you cannot claim depreciation. Are you able to understand? Next. However, for first condition, there are 4 exceptions. First one is hire purchase. See, whenever you buy goods on hire purchase, ownership will be transferred after payment of last installment. Even though ownership is transferred after payment of last installment, still from date of put to use, you can start claiming depreciation. That means even though you are not legal owner, even though you bought any asset on hire purchase basis, even though you will get ownership after payment of last installment, still the date on which that asset is put to use, from that date onwards you can claim depreciation. That is exception 1. Next, exception 2, co-ownership. Let's say there are two persons like Umasankar and Tejeshwar. We both together purchased one car. Car cost is 70 lakh rupees. I contributed 40 lakhs. Tejeshwar contributed 30 lakhs. So total cost of car is 70 lakh rupees. Now, I am not the single owner of the car. There is also another owner, Tejeshwar. Still, how much I contributed? 40 lakhs I contributed. On that 40 lakhs, I can claim depreciation. That means what? There is no rule that you should be the exclusive owner. Are you able to understand? Even though you are not exclusive owner, as a co-owner also you can start claiming depreciation. Are you able to understand? Next, capital expenditure on leased asset. I took one building on lease. On leased building, I have incurred capital expenditure. Tell me whether building is owned by me. I am lessee of the building. I am tenant of the building. Building is not owned by me. Still, I incurred capital expenditure on building. Whatever the capital expense on building is there, the capital expenditure on building, I can capitalize. I can recognize as asset in my books, and on that I can claim depreciation. Even though I am not owner of building, still for that capital expenditure, I will be deemed as owner, and on that capital expenditure, I can claim depreciation. Next, purchase covered under section 53A of Transfer of Property Act, TOPA. See, there are three conditions. There should be agreement between seller and buyer. Buyer has paid the consideration, or buyer is ready to pay the consideration. Buyer has taken the possession of the property. If all these three conditions are satisfied, then buyer will be deemed as owner of the house property, even though in registration office registration is not done. Still, buyer will be deemed as owner, and buyer can start claiming depreciation on the asset. Are you able to understand? So generally only owner of the asset can claim depreciation, but for exceptions. In case of hire purchase, even though you are not legal owner, still you can claim depreciation. In case of co-ownership, even though you are not complete owner, still whatever the amount you contributed, for that amount you can claim depreciation. In case of capital expenditure on leased asset, asset is leased only, but if you incur capital expenditure, for that capital expenditure you are the owner and you can claim depreciation. Next, section 53 of Transfer of Property Act, the conditions. When conditions given under 53 of Transfer of Property Act are satisfied, then even though physical registration is not done, still you are the owner and you can start claiming depreciation on that asset. Next, second condition, asset shall be used for the purpose of business. Correct? Used. Usage can be either active usage or passive usage. Active usage means what? You will use the asset regularly in the business. That we call as active usage. Passive usage means you do not use regularly, but you keep the asset ready for use. Whenever there is necessity, immediately you will use that asset. That means asset is not used on daily basis, but it is kept ready. Whenever there is requirement, that asset will be used. That type of usage we call as passive usage. Fire extinguisher is there. Daily will you use fire extinguisher? Will you apply it as perfume? No, right? Fire extinguisher, it is kept ready for use. Whenever there is fire accident, then you will use fire extinguisher. So we can tell fire extinguisher is used passively. Are you able to understand? That is the difference between active usage and passive usage. The thing is, even though you use asset passively, still you can claim depreciation on that asset. Are you able to understand? Next, another important point. You bought one asset in current year. You did not use that asset. You did not put to use. If asset is not put to use in the year of purchase, you should not claim depreciation. Only when asset is put to use, then only you have to claim depreciation. Are you able to understand? Next, date of purchase, date of put to use. Date of put to use. What is relevant? Will you calculate depreciation from date of purchase? Answer is no. You will calculate depreciation from date of put to use. Are you able to understand? So what is important date? Important date is not date of purchase. Important date is date of put to use. Only when asset is put to use, the day on which you put the asset to use, from that date onwards you can calculate depreciation. Are you able to understand? Don't calculate depreciation from purchase date, that is accounts. Under income tax, you should calculate depreciation from date of put to use of the asset. Are you able to understand? Good. Next, there is no depreciation on land, obviously, right? Land is not a depreciable asset. Don't calculate depreciation on land. People will laugh at you, okay? Next, reduced depreciation. What do you mean by reduced depreciation? First year, asset is put to use for greater than or equal to 180 days. Then you will calculate full rate of depreciation. In first year, if asset is put to use for less than 180 days, then you will calculate half rate of depreciation only. Are you able to understand? So calculation of depreciation half rate we call as reduced depreciation. Are you able to understand? So in the year of purchase, the year in which you purchased the asset, in that year, if asset is put to use for either 180 days or more than 180 days, then 100% like full rate of depreciation will be provided. However, if asset is put to use for less than 180 days, then half rate of depreciation will be provided. In second year, if asset is put to use for greater than or equal to 180 days, then also full rate. If asset is put to use for less than 180 days, then also full rate. Very, very important. Are you able to understand? So the thing is, from second year onwards, even though asset is put to use for less than 180 days, still you will calculate full rate of depreciation. That means what? Half rate of depreciation. This concept is applicable only in the first year, the year in which you purchase the asset. In that year only you will calculate half rate of depreciation. From next year onwards, whether asset is put to use for more than 180 days or whether asset is put to use for less than 180 days, still you will provide full rate of depreciation. Are you able to understand? Next, assets. Depreciable assets are classified into 4 blocks: building, furniture, plant and machinery, intangible assets. So there are only 4 types of assets under income tax. Practically you can have n number of assets, but under income tax there are only 4 types of assets: building, plant and machinery, furniture, intangible assets. And intangible assets excludes goodwill. Nowadays, there is no depreciation on goodwill under income tax. Once upon a time, there is depreciation calculated for goodwill under income tax. Nowadays, don't calculate depreciation on goodwill. Even though you purchase goodwill, you should not provide depreciation on goodwill. Are you able to understand? Building. If building is mainly used for residential purpose, then rate of depreciation is 5% except hotels. Hotels are commercial purpose only. On hotels, you can claim 10% rate of depreciation. So very simple, residential building 5%, commercial building 10% is the rate of depreciation. Purely temporary erections. Okay, so if a building is purely constructed temporarily, on that building you will provide 40% rate of depreciation. Next, furniture. On furniture and fittings, rate of depreciation is 10%. Next, intangible assets. Intangible assets can be know-how, patents, copyrights, all these. On intangible assets, what is the rate of depreciation? 25% is the rate of depreciation. See, there are only 4 types of assets: building, plant and machinery, furniture, intangible assets. Plant and machinery. Any asset which is not building, which is not furniture, which is not intangible asset, remaining all assets will be classified as plant and machinery. That's why plant and machinery is also called as residuary asset. Residuary means what? Any asset which is not building, which is not furniture, which is not intangible asset, it will be classified as plant and machinery. For example, I am using mic. Whether mic is building, whether mic is furniture, will I sit on mic? No, right? Whether mic is intangible asset? No, mic will be treated as plant and machinery. Are you able to understand? So any asset other than building, furniture, intangible asset, it will be treated as plant and machinery. Next, what are the rates of depreciation? Those which fly in air, aeroplanes and aero engines, rate of depreciation 40%. Next, ship, those which will go on water, ships and vessels, speedboats, rate of depreciation 20%. Next, cars or vehicles. If vehicles are used in hire business, used in business of running them on hire, rate of depreciation 30%. If vehicles are used other than on hire business, rate of depreciation is 15%. Are you able to understand? Next, molds used in rubber and plastic goods, rate of depreciation 30%. You know molds, right? Using one mold, we will create thousands of assets. For example, first I prepare mold of chair. Using that mold, we will prepare hundreds of chairs, thousands of chairs. So even mold is also asset. Using mold, we can create multiple number of chairs, multiple number of assets. So mold is also asset. On mold, the rate of depreciation applicable is 30%. Are you able to understand? Next, life-saving medical equipment. On life-saving medical equipment, rate of depreciation is 40%. Ventilator, oxygen cylinder, those are life-saving medical equipments, 40%. Containers made of glass or plastic used as refills. See, nowadays we are getting 20 rupees pet bottle, Sprite pet bottle, Thumbs Up pet bottle. But when we are in childhood, we used to drink Sprite, Thumbs Up in glass bottle. Okay, now glass bottles which are used as refills, on those glass bottles, rate of depreciation is 40%. Are you able to understand? Next, computers, rate of depreciation 40%. See, not only computers, if you buy any computer software, you purchased MS Office, you purchased Tally, even on computer software also, you need to apply 40% rate of depreciation. Next, air, water and pollution control equipment, rate of depreciation 40%. Next, energy saving devices including renewable energy saving devices, 40%. See, generally petrol vehicles or diesel vehicles, rate of depreciation, if it is used in higher business, 30%, other than higher business 15%. But if you buy electric vehicles, rate of depreciation 40%, very important. Okay. Next, books. In our profession, major asset is books only. On books, rate of depreciation is 40%. Next, on other plant and machinery, rate of depreciation is 15%. Oil wells, rate of depreciation 40%. Windmills, you have to remember the date 1st April 2014. If windmills are installed before 1st April 2014, rate of depreciation is only 15%. If windmills are installed after 1st April 2014, rate of depreciation is 40%. Are you able to understand? Next. Next, written down value of the block. I have told you under income tax, depreciation is not calculated individually. Depreciation is calculated block wise. How depreciation will be calculated block wise? What is the format that we will see? First, there will be opening written down value of the block. For opening written down value of the block, we will add additions. Additions are classified into three types. Put to use greater than or equal to 180 days. Put to use less than 180 days. C, not put to use. See, even if asset is not put to use, still you have to add that asset to block of assets. You will not provide depreciation, but value of asset which is not put to use, that value will be added to block of assets. Are you able to understand? So thereby you will get opening written down value plus additions. On opening written down value plus additions, you will reduce money receivable in respect of assets sold. Very important. Whenever you sell any asset, okay, then you have to reduce sale value from the block. Are you able to understand? You will not reduce book value. What you will reduce? You will reduce sale value of the asset from block. See, in accounts we will reduce book value. Under income tax, calculation is different. Whenever you sell the asset, on sale of asset, you have to reduce the sale value of the asset. Thereby you will get depreciable value. Whatever the depreciable value is there, that is to be apportioned on LIFO basis, last in first out basis. So depreciable value will be first allocated to assets put to use for less than 180 days. Balance depreciable value, you will apply full rate of depreciation. So whatever the depreciable value is there, in that depreciable value, separate value of assets put to use for less than 180 days. On those value of assets, you will provide half rate of depreciation. On balance depreciable value, you will provide full rate of depreciation. Are you able to understand? So thereby you will calculate current depreciation, current year depreciation, and you will also calculate additional depreciation. Okay, you can see here current year depreciation, additional depreciation. After reducing current year depreciation and additional depreciation, you are going to get closing written down value of the block. Are you able to understand? See, I am doing revision of depreciation. At any point of time, if you have doubt, if you need further explanation with regard to depreciation exclusively, I uploaded one lecture on YouTube. You can check in my channel. Exclusively relating to depreciation, there is one lecture. Watch that lecture, you will get complete clarity. Okay. Next, we will discuss additional depreciation. See, only two persons can claim additional depreciation. One is manufacturing business. Okay, those who are engaged in manufacturing business, they can claim additional depreciation. Second, those who are engaged in generation or transmission or distribution of power, nothing but power sector undertakings or power generating units, they can claim additional depreciation. Are you able to understand? So those who are engaged in manufacturing business, those who are engaged in power generation business, only these two people can claim additional depreciation. Next, whether additional depreciation is available on building? No. Whether additional depreciation is available on furniture? No. Whether additional depreciation is available on intangible assets? No. Additional depreciation is available only on plant and machinery. That too, new plant and machinery. That means what? On second hand plant and machinery, you cannot claim additional depreciation. Additional depreciation is available only on first hand plant and machinery. Okay, next. Ships, aircrafts, they are also plant and machinery, but can you claim additional depreciation on ships and aircrafts? No. On ships and aircrafts, additional depreciation is not available. Next. Put to use greater than or equal to 180 days. First year, additional depreciation is equal to 20% of cost of plant and machinery. Okay. However, if asset is put to use for less than 180 days, then additional depreciation is equal to only 10% of cost of plant and machinery. Okay. In second year, you will claim balance 10%. Are you able to understand? So very simple, asset put to use for either 180 days or more than 180 days. You will claim 20% of cost of plant and machinery as additional depreciation. If asset is put to use for less than 180 days, first year 10% of cost of plant and machinery as additional depreciation. Second year 10% of cost of plant and machinery as additional depreciation. Are you able to understand? Next. If SSE is paying taxes under 115 series, 115 BAA, BAB for companies, domestic companies, 115 BAC for individual HUF, AOP, BOI, AJP other than cooperative society, 115 BAD, BAE for cooperative society. So whenever a person is paying taxes under 115 series, then he cannot claim additional depreciation. So simply additional depreciation is available only under old tax rates or optional tax rates. Under new tax rates, additional depreciation is not available. Okay. Next, additional depreciation is not available for second hand plant and machinery. So when you buy second hand plant and machinery, whether you buy in India or outside India, additional depreciation is not available. Next, any plant and machinery installed in office premises or residential accommodation or any guest house. See, if you buy plant and machinery that is installed in office premises, additional depreciation is not available. So simply, if you buy plant and machinery that is used in manufacturing area, then only you can claim additional depreciation. If you buy new plant and machinery, I purchased a new laptop, I am using laptop in accounts department in administration office. Now on that laptop, can I claim additional depreciation? No. I purchased the laptop and is I am using in manufacturing area, I can claim additional depreciation. Are you able to understand? Next, office appliances, road transport vehicles, and plant and machinery on which 100% deduction is allowed. Very simple. Additional depreciation is available only on new plant and machinery that is used in manufacturing area. Then only you can claim additional depreciation, otherwise you cannot claim. And if power sector undertakings opt for straight line method of depreciation, they cannot claim additional depreciation. See, additional depreciation is available only for manufacturing businesses and power sector undertakings. If power sector undertakings are following WDV, claim additional depreciation. If power sector undertakings are following straight line method, then they cannot claim additional depreciation. Are you able to understand? Next, printing business. Even printing is also treated as manufacture. CBDT gave one circular. Printing business is also treated as manufacturing business. On printing business also you can claim additional depreciation. Okay. Next, additional depreciation shall be computed on individual asset basis and not on block of assets. So additional depreciation is calculated for each asset individually. It will not be calculated for block of assets. So this is the concept relating to additional depreciation. Is this also applicable for power generation units also, sir? Yes. Power generation units. See, power generation units, if they follow WDV, then they can claim additional depreciation. Additional depreciation allowed. If they follow straight line method, additional depreciation is not allowed. So that much. I have another class. Tomorrow I will do revision of second part of PGBP. Okay. So hello CA final students. I have done part 1 revision of PGBP. I have discussed till additional depreciation in part 1. Now in part 2 we will continue with remaining concept of depreciation and we will see other provisions of PGBP. After additional depreciation, next concept is cost of additions, actual cost or cost of additions. See, whenever you purchase any asset for the purpose of business, cost of additions is equal to purchase cost plus incidental expenses. You purchase one plant and machinery from Mumbai, not only cost of plant and machinery, till that plant and machinery is put to use. Whatever the expenses are there, all the expenses are to be added to the cost of the plant and machinery. So you will take purchase price. On that purchase price, you will add taxes. See, if input tax credit is available, well and good. If input tax credit is not available, you would have studied in your GST. If ITC is not available, that ITC component, input GST is also required to be added to the cost of the asset. And loading and unloading charges, insurance, transportation charges, all the expenses, whatever the expenditure that you incur on asset, till the time that asset is put to use, all the expenses are required to be added to the cost of the asset. Are you able to understand? Installation charges, interest on borrowed capital till the asset is put to use. See, on 1st April 25, hold on, I'm sorry. On 1st April 25, 24, you took loan for plant and machinery. On 1st July 2024, that asset is put to use. Now, from date of taking loan up to the date asset is put to use, whatever the interest cost is there, that interest cost will be capitalized. That interest cost will be added to the cost of the asset. After asset is put to use, whatever the interest cost is there, such interest cost will be debited to P&L account. Are you able to understand? That means what? Whenever you take any loan for buying asset, from date of taking loan up to the date asset is put to use, interest cost will be added to the cost of the asset. After asset is put to use, whatever the interest cost is there, that interest cost will be debited to P&L account. Next, trial run expenses. See, you will test whether machine is working properly or not. For that, you will do trial run. Whatever the trial run expenses are there, they will also be added to the cost of the asset. Okay. Next, if you get any subsidy from government for buying plant and machinery, let's say I am starting one company in remote area. So government gave me subsidy. I wanted to buy one plant and machinery. Cost is 1 crore rupees. Government gave subsidy of 20 lakh rupees. Whatever the subsidy given by government is there, that will be reduced from cost of the asset. Next, cost met by any other person. So not only by government, if subsidy is given by any other person or if amount is paid by any other person, that amount will be reduced from cost of the asset. Next, amount on sale of trial run product. See, when you do trial run, some finished good will come, right? On sale of that finished good, whatever the amount that you receive, that will also be reduced from cost of the asset. So this is how we are going to calculate cost of additions. Cost of additions is equal to purchase cost plus all incidental expenses, transportation, insurance, loading and unloading charges, trial run expenses, interest cost from date of taking loan up to date asset is put to use. All expenses we will add to the cost of the asset. What we reduce? We reduce subsidy from government or any other person and sale of trial run finished goods. These two amounts are to be reduced from cost of the asset. Okay. Next, whenever you are paying purchase cost and incidental expenses, like more than 10,000, you should not make cash payment. Okay. You remember, right? 40A3 provision, same concept. Whenever you are paying these expenses per person per day greater than 10,000, cash payment you should not do. Are you able to understand? So per person per day you should not make cash payment of more than 10,000. So one doubt here, only subsidy from government should be excluded. No. If subsidy is given by any third party, that will also be excluded from cost of the asset. Okay, I wanted to buy plant and machinery. Aishwarya helped me. The cost of plant and machinery is 50 lakhs. Aishwarya gave me 10 lakhs. Now cost to me is 50 lakhs minus subsidy given by Aishwarya, 10 lakhs. Net cost is only 40 lakhs. Okay. Whether depreciation can be claimed for trial run assets? No. Trial run, you are doing trial run for asset, whether asset is working properly or not. There is no concept of trial run assets. We will verify when we buy asset, is it working properly or not. That we call as a trial run expense. So see here, all these expenses, okay, per person per day you should not make cash payment of more than 10,000 rupees. Then what? If you want to make payment of more than 10,000 rupees, you should make payment by account payee check or account payee bank draft or account payee electronic clearing system. So only through bank transaction, you should make payment of more than 10,000 rupees. Then only that expenditure will be added to the cost of the asset. Otherwise, that expenditure will not be added to the cost of the asset. Are you able to understand? Another important point, in 40A3, there are two limits. For transporter, limit is 35,000. For other persons, limit is 10,000 rupees. However, for cost of additions, under section 43(1), whether it is a transporter or any other person, limit is only 10,000. Are you able to understand? Threshold limit is only 10,000. So whenever you are calculating cost of additions, the threshold limit is 10,000. Whether you make payment for transporter, for transportation, whether you may make payment for any other person, you should not give cash payment of more than 10,000 per person per day. If you give, then that amount will not be added to cost of additions. So the thing is, for 40A3 cash payment, two threshold limits are there, 10,000, 35,000. For calculating cost of additions, there is, when you are calculating cost of additions, there is only one threshold limit, which is 10,000 rupees. Are you able to understand? One doubt here. In case of motor vehicles in showrooms, sir, some motor vehicles are used for trial run, no sir. Can depreciation be claimed? See, in motor vehicle showroom, let's say a car is there. Car is used for test drive purpose. When car is used for test drive purpose, it is not stock in trade. It will be recognized as asset of the company, and on that you can claim depreciation. Okay. On test drive vehicles, they will be recognized as asset of the company. You can start claiming depreciation. Next, there are some special cases for calculating cost of additions. Whenever you buy any asset for scientific research purpose, you will claim 100% expenditure as deduction under section 35. After using asset for scientific research purpose, if you bring into normal business, in normal business, cost of additions is equal to nil, because already under scientific research, you claimed 100% of the expenditure. Now, again, if you add it at some value, it will lead to double deduction. That's why whenever scientific research asset is brought into normal business, cost of additions will be taken as nil. Okay. Next, on conversion of stock in trade into capital asset. See, you are converting stock in trade into capital asset. My main business is buying and selling of air conditioners. In my business, I installed one air conditioner. Whenever I take and install air conditioner, actually ACs are stock in trade to me. But one of the AC I am using in my business, I am not selling. So whenever I take one AC from stock in trade and install that AC in my office, then that stock in trade is no more stock in trade. It will be treated as capital asset. So whenever you convert stock in trade into capital asset, cost is equal to fair market value on date of conversion. Are you able to understand? So fair market value of air conditioner on date of conversion will be taken as cost of air conditioner. Next, where any asset is acquired by way of gift or inheritance. See, someone gifted me laptop. That laptop I am using in my profession. Whenever I use laptop in my profession, I need to add to block of assets. Now, then cost of laptop is equal to written down value in the hands of previous owner. Okay, next. If you remember, in capital gains, exceptions to definition of transfer, certain transactions are there. Whenever you transfer capital asset from amalgamating company to amalgamated company, it is not transfer. Whenever you transfer capital asset from demerged company to resulting Indian company, it is not transfer. Whenever you transfer capital asset from holding company to subsidiary company or subsidiary company to holding company, it is not treated as transfer and no capital gains are required to be calculated. In all those cases, cost of additions is equal to written down value to the previous owner. Are you able to understand? See, capital asset transferred from amalgamating company to amalgamated company. Is it a transfer? It is not treated as transfer and no capital gains are required to be calculated. Capital asset transferred from demerged company to resulting company. Is it transfer? It is not treated as transfer. Capital asset transferred from holding company to subsidiary company or subsidiary company to holding company. Is it treated as transfer? It is not treated as transfer. Okay, some conditions are there. If those conditions are satisfied, it is not treated as transfer. Now, in the books of recipient, cost of additions is equal to WDV in books of transfer or written down value in books of transfer. What do you mean by this? Let's say Vodafone got merged in VI. Idea got merged in VI. In books of VI, cost of additions is equal to written down value in books of Vodafone or Idea. Are you able to understand? So, in the hands of recipient, in all these transactions, in the hands of recipient, cost of additions is equal to written down value in the books of transfer. Are you able to understand? Asset used for business transferred earlier and reacquisition of the same. See, whenever you are using one asset in your business, if you sell the asset after 2-3 years, if you buy back the same asset, if you reacquire the same asset, upon reacquisition, at the time of reacquisition, cost of additions is equal to written down value at the time of original transfer or reacquisition price, whichever is lower. So, sale and purchase back of same asset. So, whenever you sell and reacquire the same asset, upon reacquisition, cost of additions is equal to reacquisition price or written down value at the time of original transfer, whichever is lower will be taken as cost of additions. Next. Sale of asset to lessor and leasing back. This is nothing but sale and lease back. I have one building. I wanted to claim extra expenditure. I am not satisfied with the depreciation. Depreciation is only 2 lakhs. I wanted 4 lakhs expenditure. So what I did, I have sold my building and I have leased back the same building and I have written lease agreement for 4 lakh rupees. Now I can claim 4 lakh rupees as expenditure. I am not giving building to him. It is only paperwork. I have done, I have prepared contracts, I have prepared agreements. I am only using the building, but I have prepared the agreement that I have sold the building to him. Same building I have taken on lease. Okay, this is just a fictitious transaction to claim enhanced expenditure. So that's why in case of sale and lease back, cost of additions is equal to written down value in the books of lessee. Are you able to understand? See, let's say there is seller, there is buyer. Can we call buyer as lessor and can we call seller as lessee? Now, what seller is doing? Seller is selling asset and same asset is leased back. Now, in books of seller, cost of additions is equal to, in books of buyer, cost of additions is equal to written down value in books of seller or lessee. Did you understand? In case of sale and lease back, cost of additions is equal to written down value in books of seller or lessee. 11th point, hold on, I will explain 12th point. Asset brought into India by a non-resident. Whenever any asset is purchased by non-resident and non-resident brings that asset into India and in India he uses that asset for business, then cost of additions is equal to original cost minus notional depreciation. Are you able to understand? That means what? Let's say Sundar Pichai came to India and he started Sundar's Google. He started his own company in India. Now, Sundar is having one personal supercomputer. That personal supercomputer is used in Sundar's business. So, whenever like non-resident brings his personal asset into business, in business cost of addition is equal to actual cost of that personal asset minus notional depreciation from date of its purchase. That means how many years that is used for personal purposes. For those many years, we will calculate notional depreciation, we will reduce notional depreciation. After reducing notional depreciation, whatever the balance written down value is there, that will be treated as cost of additions. Okay. Next, any building, if building is used for personal purpose and later on brought into business, then cost of additions is equal to original cost of building minus notional depreciation for personal purpose. So, for how many years you use the building for personal purpose, for those many years you will provide notional depreciation. Whatever the balance written down value is there, that will be added as cost of additions. Are you able to understand? Let's say in 2019 I purchased building for 50 lakhs. In 2021 I started CA practice. In CA practice I started using this building. Now, in CA practice, cost of additions is equal to 50 lakhs minus depreciation for 1920, depreciation for 2021. Okay. Depreciation 1920, depreciation 2021 will be reduced. And whatever the balance written down value is there, that will be treated as cost of additions. Now, did you understand? Next, subsidy. I have discussed with you, if subsidy is received, then subsidy amount will be reduced from cost of additions. However, if composite subsidy is received, what do you mean by composite subsidy? If subsidy amount is received for more than one asset, then we call that subsidy as composite subsidy. I will tell one example. Let's say I am buying two plant and machinery A, plant and machinery B. Let's say cost of plant and machinery A is 40 lakhs, cost of plant and machinery B is 10 lakhs. I received subsidy, not for single plant, subsidy for both plant and machinery is 3 lakh rupees. Now, how to reduce 3 lakh rupees? Wait 1 minute. Where is my calculator? Subsidy is 3 lakh rupees. Now, we have to apportion the subsidy proportionately between two plant and machinery. So, how much is subsidy? Subsidy is 3 lakh rupees, right? Apportion subsidy proportionately. 3 lakh into 40 lakh by 50 lakh. How much? 2.4 lakhs. 0.6 lakhs. Correct. Now how much? 40 minus 2.4, 37.6 lakhs. 10 minus 0.6, 9.4 lakhs. Are you able to understand? This is how you are going to calculate. So whenever you receive composite subsidy, divide that composite subsidy among all assets in proportion to their value. Are you able to understand? Next, other subsidies. See, if you receive subsidy and that subsidy is directly relating to cost of the asset, then only that subsidy will be reduced from cost of the asset. For example, my business is running in losses. I received subsidy from government to bring my business into profit. Now, government is giving subsidy not for plant and machinery. Government is giving subsidy to get me into profits, from losses to get me into profits. Now, whatever subsidy given by government, it is not relating to plant and machinery, then why will you reduce it from cost of asset? You will not reduce it from cost of the asset. So, the point is, only when subsidy is clearly received with regard to plant and machinery, then only it will be reduced from cost of plant and machinery. Are you able to understand? Next, we have to discuss capital gains in case of depreciable assets. The thing is, to calculate and reduce depreciation, two conditions are required to be satisfied. Condition 1, there should be assets in the block. Condition 2, block shall have positive value. Only if these two conditions are satisfied, then only you will calculate depreciation, and depreciation will be reduced from block of assets. Otherwise, depreciation will not be reduced from block of assets. Just think logically. There are no assets in the block. If there are no assets in the block, how can you calculate depreciation? You should not calculate depreciation. In that case, you will calculate capital gains. Are you able to understand? So, depreciation is governed by section 32. Capital gains on depreciable assets, okay, that is governed by section 50. Section 32, section 50, both are mutually exclusive. What do you mean by mutually exclusive? If you are claiming depreciation under section 32, then you will not calculate capital gains. If you are not claiming depreciation under section 32, then you will calculate capital gains. So, you have only two options. Either claim depreciation or calculate capital gains in case of depreciable assets. You cannot do both things at a time. You cannot calculate depreciation and you cannot calculate capital gains. Both things you cannot do at once. Are you able to understand? Either you calculate depreciation and claim depreciation, or you will calculate capital gains in case of depreciable assets. Both are mutually exclusive. Now, For example, condition 1, condition 2. Condition 1, there should be assets in the block. Condition 2, block shall have positive value. The thing is, there are assets in the block, but block is not having positive value. Now, can you calculate depreciation? You cannot calculate depreciation. You will calculate capital gains. Are you able to understand? There are assets in the block. Block is also having positive value. Now, you will calculate depreciation. You will not calculate capital gains. Next. There are no assets in the block, but block is having positive value. If there are no assets, then will you calculate depreciation? You will not calculate depreciation. You will calculate capital gains. Next. There are no assets in the block. Block is also not having positive value. Will you calculate depreciation? No. In this case, you will calculate capital gains. Are you able to understand? That means what? Only if there are assets and if those assets are having positive value, then only you are going to calculate depreciation. In remaining all other cases, you will not calculate depreciation. You will calculate capital gains. Are you able to understand? I will tell one small example for your better understanding. There is plant and machinery 15% block. Okay, opening written down value 4 assets 5 lakh rupees. Additions 2 assets 1 lakh rupees. Now total 6 assets 6 lakhs less sale value. 3 assets are sold. They are sold for 2,50,000 rupees. Now how much is balance? 3 assets are there, 3,50,000 is there. Now whether condition 1 is satisfied? Yes, there are assets in the block. Whether condition 2 is satisfied? Yes, block is having positive value. In this case, you will calculate depreciation. You will not calculate capital gains. Okay, 3,50,000 on 3,50,000 you are going to calculate depreciation. Okay, now second example. Furniture 10% block. Opening written down value 3 furniture are there 1,50,000. Add additions. 2 furniture are purchased for 80,000 rupees. Now how many? 5 furniture are there 2,30,000. Less 4 furniture are sold for 6 lakh rupees. 4 furniture are sold for 6 lakh rupees. Now how many assets are there balance? 1 asset is there. If you reduce 6 lakhs, 2,30,000 minus 6 lakhs, how much? 3,70,000 negative value. Tell me one thing, for asset there will be positive value. Will there be any negative value for asset? No, right? So here you should not calculate depreciation. Condition 1 satisfied, there are assets in the block. But whether condition 2 is satisfied? No, block is having negative value. If block is having negative value, will you calculate depreciation? You will not calculate depreciation. In this case, you are required to calculate capital gains. Are you able to understand? So, how to calculate capital gains? Depreciable assets are always treated as short-term capital assets. So, we will calculate short-term capital gain or short-term capital loss. What is to be taken as full value of consideration? Sale value is to be taken as full value of consideration. How much is sale value? 6 lakhs, correct? 6 lakhs is sale value. What is to be taken as cost of acquisition? Opening written down value plus additions is to be taken as cost of acquisition. How much is opening written down value? 1,50,000. Additions 80,000. 2,30,000 is cost of additions and 3,70,000 will be treated as short-term capital gain. Are you able to understand? Did you get clarity? So very simple. There should be assets. Block shall have positive value. If these two conditions are satisfied, you will claim depreciation. If any one of the conditions are not satisfied, in that case, you will calculate capital gains. If block is having negative value or if there are no assets in the block, in that case, don't calculate depreciation, calculate capital gains. Okay. While calculating capital gains, what is to be taken as full value of consideration? Sale value of asset is to be taken as full value of consideration. What is to be taken as cost of acquisition? Opening written down value plus additions is to be taken as cost of acquisition. Thereby, you are going to calculate short-term capital gain or short-term capital loss. Depreciable assets always treated as short-term capital assets. Okay. So did you get clarity? Next. Next concept is apportionment of depreciation. See, amalgamation, demerger, conversion of sole proprietorship into company, conversion of private limited company into LLP. All these conversions, if conversion happens at the beginning of the year, no problem. We will calculate total depreciation for new entity. But if conversion takes place, let's say Idea got merged into VI. This merger happened on 10th November 2025, okay, or 10th November 2024. Whenever merger takes place in the middle of the year, then there is problem. If merger takes on 1st April, for example, if merger takes place on 1st April 2024, then total depreciation you will allocate for VI. There is no concept of idea, correct? However, if merger takes place in the middle of the year, then from 1st April 24 up to 31st October 24, okay, you will allocate depreciation. Allocate depreciation for idea. From 10th November 24 to 31st March 2025, you are going to allocate depreciation for VI. Are you able to understand? That means whenever conversion takes place in the middle of the year, first calculate depreciation for the whole year. Assume asset is owned by single person, calculate depreciation for whole year. Whatever the depreciation for whole year is there, apportion the depreciation between predecessor and successor in the ratio of number of days of usage. How many days that asset is used by predecessor, how many days that asset is used by successor. In that ratio you are going to apportion. Are you able to understand? So 1st April 24 to 31st October 24, how many days? April 30, May 31, June 30, July 31, August 31, September 30, October 31, 214 days, 151 days. So in the ratio of 214 is to 151, you are going to apportion the cost of the, you are going to apportion the depreciation. Are you able to understand? Apportionment of depreciation. I hope you got clarity about apportionment of depreciation. Now shall I explain unabsorbed depreciation? Very, very important. Unabsorbed depreciation. Any doubts till now? Next, unabsorbed depreciation. See, if there are no net profits to set off the depreciation, or available net profits are not sufficient to set off the depreciation, then that concept we call as unabsorbed depreciation. Let's say depreciation is 12 lakhs. In P&L account, sales 120 lakhs, Expenses 130 lakhs. Expenses before depreciation 130 lakhs. Now there is net loss of 10 lakhs. Are there any profits to claim depreciation? There are no profits to claim depreciation. So this 12 lakhs we call as unabsorbed depreciation. Are you able to understand? So if no profits are available to set off the depreciation, whatever the depreciation that could not be set off is there, that we call as unabsorbed depreciation. Are you able to understand? Or case 2, depreciation is 12 lakhs. P&L account, sales 130 lakhs, expenses before depreciation 125 lakhs. Now how much net profit is available? 5 lakhs net profit is available. You have a depreciation of 12 lakhs. Out of 12 lakhs, you can claim depreciation only 5 lakhs. 5 lakhs you can set off. But remaining 7 lakhs, you cannot set off. Whatever the 7 lakhs that you could not set off is there. This also we can call as unabsorbed depreciation. Are you able to understand? So very simple. If there are no profits to set off depreciation, or if available profits are not sufficient to set off depreciation, then whatever that depreciation that could not be set off is there, that we call as unabsorbed depreciation. Are you able to understand? So it exists if there are no profits or existing profits are not sufficient to set off depreciation. Sir, what is tax treatment of unabsorbed depreciation? See, whatever unabsorbed depreciation is there, first, this will be set off against other PGBP income. If you have other business, in other business if you have profits, you can set off with other business profits. After setting off with other business profits also, still you have unabsorbed depreciation. Then you can set off against other heads of income except salary. You can set off against other heads except salary and winnings. Except salary and winnings. For example, let's say unabsorbed depreciation is 80 lakhs. Other business profits are only 10 lakhs. So 80 lakhs minus 10 lakhs. How much? 70 lakhs unabsorbed depreciation is there. Let's say income from house property 20 lakhs is there. You will set off against income from house property 70 lakhs minus 20 lakhs. Still unabsorbed depreciation is 50 lakhs. This 50 lakhs you will carry forward to subsequent years. Are you able to understand? So very simple. First set off unabsorbed depreciation against other business profits. After doing that set off, still there is unabsorbed depreciation. Then set off that unabsorbed depreciation against other heads of income, interhead set off, either with salary, either with house property, capital gains, other sources. You cannot set off against salary income, you cannot set off against winnings. After setting off against other heads also, still there is balance unabsorbed depreciation that you will carry forward to subsequent years. Are you able to understand? Next. In subsequent years, whatever the net profit is there, net profit of subsequent years, first priority is current year depreciation. That means first you will set off next year depreciation. Second priority is brought forward losses. Then till if there are profits, then third priority is unabsorbed depreciation. Okay, this brought forward unabsorbed depreciation, that you will set off as third priority. That means this year there is unabsorbed depreciation. You set off against other business income, you had set off against other heads of income. Still balance unabsorbed depreciation is there, that you will carry forward to subsequent years. In subsequent years, if there are profits, first will you set off brought forward unabsorbed depreciation? No. First you will set off that year depreciation. Second you will set off brought forward losses. Still if there is any profits available in next year, against those profits you will set off unabsorbed depreciation. That means priority of unabsorbed depreciation is third priority. Next. Sir, how many years unabsorbed depreciation can be carried forward? Unabsorbed depreciation can be carried forward for unlimited period. Are you able to understand? So this is the concept of unabsorbed depreciation. I hope you are clear with unabsorbed depreciation. Next, asset partly used for business and partly for personal purpose. What do you mean by this? Let's say I have one car. Car I am using for profession purpose and car is also used for personal purpose. Now, for example, 65% I am using for profession, 35% I am using for personal purpose. Let's say depreciation on car is 1,80,000. Now, can I claim 1,80,000 as expenditure in P&L account? No. Out of 1,80,000, how much is for profession purpose? How much is for personal purpose? Profession purpose 65%, personal purpose 35%. 1,80,000 into 65%, 1,17,000. Only 1,17,000 is allowed as deduction in P&L account. That means asset partly used for personal purpose, partly used for business purpose or profession purpose. Only business or profession purpose depreciation is only allowed as deduction in P&L account. Are you able to understand? And only in block also you will provide depreciation 1,17,000 only. Are you able to understand? That means whatever the profession related depreciation is there, only the depreciation amount will be reduced from block. Only that amount will also be debited to P&L account. Are you able to understand? Next, if asset is used to earn composite income. You know composite income, right? Let's say there are three businesses: rubber, tea, coffee. In case of rubber, ratio is 65-35. In case of tea, ratio is 60-40. In case of coffee, two activities are there: growing, curing. Then ratio is 75:25. Growing, curing, roasting, grounding. If four activities are there, then ratio is 60:40. So whenever we earn composite income, we will divide that composite income into agricultural income and business income. How to remember which is agricultural income, which is business income? Whichever is having highest ratio is agricultural income, lowest ratio is business income. Are you able to understand? Now the point is, let's say I am using one machine. That machine I am using for agricultural purposes. I am also using that machine for business purposes. Basically that machine is used to earn composite income. In that case, depreciation on total asset, okay, don't divide. Depreciation on total asset will be reduced while calculating PGBP income. Are you able to understand? Please reduce total depreciation, okay. So after reducing total depreciation, whatever the income is there, you will divide that income into agricultural income and business income based on the ratio. Are you able to understand? So the point is, from sale, you will reduce agri expenses, you will also reduce business expenses, and you will reduce total depreciation. After reducing all this, whatever the income is there, that income is to be divided as agricultural income and business income. Are you able to understand? So you are doing the division, you are doing the split, not at the beginning but at the end. That's why total depreciation is allowed as deduction. So whenever you are using asset for business purpose as well as for agricultural purposes, total depreciation claim as deduction. After claiming total depreciation, whatever the balance profits are there, they will be divided into agricultural income and business income. Okay. Next, power sector undertakings. See, power sector undertakings have two options. Either they can follow straight line method or they can follow written down value method. If they follow straight line method, depreciation will be calculated for each asset individually. If they follow written down value method, then depreciation will be calculated block wise. For each block, depreciation will be calculated. See, accounts, nothing but. In accounts, for each asset we are going to calculate depreciation, right? In the same way, we calculate depreciation for each asset individually if power sector undertakings are following straight line method of depreciation. If they are following written down value method of depreciation, depreciation will be calculated block wise. Okay. Now, let's say I will take one example. Through that example, I will explain very easy, simple. Let's say cost of asset is 10 lakhs. Straight line method used, like useful life is 10 years. Then how much is the depreciation? Depreciation will be 10 lakhs divided by 10 years. For each year, depreciation is 1 lakh, correct? So from this we need to reduce depreciation. For example, I want written down value after 2 years. How to calculate written down value? We will provide depreciation for 2 years. Depreciation for 2 years is 2 lakhs. Written down value is 8 lakhs. Okay, now 3 cases. Case 1, sold for 6 lakh rupees or sold for 5 lakh 50,000. Case 2, sold for 9 lakhs. Case 3, sold for 11 lakh 70,000. In case 1, 8 lakhs worth of asset is sold for 5 lakh 50,000. Is there surplus or shortfall? There is shortfall. How much is shortfall? 8 minus 5.5. 2.5 lakhs is shortfall. Whatever the shortfall is there, that will be debited to P&L account. Are you able to understand? Next. If it is sold for 9 lakhs, then there is surplus. How much is surplus? Surplus is 1 lakh. 8 lakhs worth of asset is sold for 9 lakhs. 1 lakh is surplus. This surplus will be credited to P&L account. Okay. Next. Here 8 lakhs worth of asset is sold for 11 lakh 70,000. 11 lakh 70,000 minus 8 lakhs. How much? 3 lakh 70,000. See, asset cost only 10 lakhs, but it was sold for 11 lakh 70,000. Over and above cost of asset, whatever the extra amount at which it is sold. For example, in first year only, I purchased it for 10 lakhs, I sold for 11 lakh 70,000. Whatever extra 1 lakh 70,000 that I have received, is it revenue receipt? No, it is capital receipt, correct? So, out of 3 lakh 70,000, 1 lakh 70,000 is taxable as capital gains. Balance 2 lakhs, it will be credited to P&L account. So remember students, above cost of the asset, if any sale amount is received, that will be treated as capital gains. Cost of the asset is only 10 lakhs. Above 10 lakhs, how much is the sale value received? 1 lakh 70,000. That will be treated as capital gains, and 2 lakhs will be treated as 2 lakhs will be credited to P&L account. Are you able to understand? So this is the tax treatment whenever assets are sold by power sector undertaking following straight line method of depreciation. If they follow written down value method, section 50 we have discussed. If they follow straight line method, in this way we are going to calculate capital gains. Okay, simple. Shortfall, terminal depreciation allowed as deduction. Surplus, to the extent of deduction claimed earlier, it will be taxable under PGBP. Sale price minus cost, it will be taxable as short-term capital gain. Okay. So transitional depreciation, this is not that much important. You can study on your own, you will understand. So this is all relating to depreciation. See, in PGBP, major discussion will be relating to depreciation concept only. At the same time, we cannot ignore it is such an important topic. I hope you are clear with depreciation. Yeah, now we will discuss 33AB, 33ABA. Are you clear till here? Next, 33AB, 33ABA. First 33AB, both are similar only. I will explain 33AB. Same concept is applicable for 33ABA. If you are in the business of tea, coffee, rubber, then you can claim deduction under section 33AB. There is one board called tea, coffee, rubber board. Tea, coffee, rubber board prescribes, if you like every year, if you deposit any money in NABARD account, you know NABARD, right? National Bank for Agricultural and Rural Development. If any amount is deposited in NABARD account or any account referred by tea, coffee, rubber board, whatever the amount deposited, that amount is eligible for deduction under section 33AB. Now, how much amount is eligible for deduction? Actual amount deposited in NABARD account or any other account prescribed by tea, coffee, rubber board, or 40% of net profits before deduction under section 33AB and before set off of brought forward losses. Whichever is lower is eligible for deduction under section 33AB. So, when can you claim deduction under section 33AB? You have to deposit money where either in NABARD account or any other account prescribed by tea, coffee, rubber board. How much amount is eligible for deduction? Actual amount deposited or 40% of PGBP income, whichever is lower is eligible for deduction. Sir, is there any time limit to deposit? Yes. You have to deposit before expiry of 6 months from end of previous year or ITR due date, whichever is earlier. So, see, end of previous year, 31st March 2025. From 31st March 25, 6 months means 30th September 2025 or ITR due date, whichever is earlier. Are you able to understand? So generally ITR due date is 31st July or 31st October. That ITR due date or 30th September, whichever is earlier, you should deposit money. Then only that money is eligible for deduction under section 33AB. Okay. Now, you are depositing money in NABARD account, you are claiming deduction under section 33AB. Sir, what we have to do with the money deposited in NABARD account? Whatever the money deposited in NABARD account is there, that money you should use for buying new plant and machinery. That money you should use for prescribed purposes. Tea, coffee, rubber board will tell for which purpose you should use that money. For that purpose only you should use the money. If you misutilize the money, in the year of misutilization, whatever the misutilized money is there, that misutilized money is taxable as your income. Are you able to understand? Next, you are withdrawing money, withdrawal from deposit account. If you withdraw money in the year of withdrawal, you should use this money for authorized purposes. If you do not use the money for authorized purposes, then whatever the unutilized money is there, that is taxable. Let's say in NABARD account, I deposited 15 lakhs. Now, in current year, I withdrawn 6 lakhs. In this year only, 6 lakhs I have to use for authorized purposes. If I do not use for authorized purposes, let's say out of 6 lakhs, 4 lakhs is utilized. 2 lakhs is unutilized. At the end of the year, whatever the withdrawn and unutilized amount is there, that is taxable. 2 lakh rupees is taxable. Are you able to understand? Next. On closure of the business, if you withdraw money, then it is taxable as PGBP income. Even at the time of dissolution, dissolution means what? Partnership firm is getting divided. Okay, so at the time of dissolution of firm also, if you withdraw money from NABARD account, withdraw money from deposit, then it is taxable as PGBP income. After death of taxpayer, if their family members withdraw money from NABARD account, it is not taxable. Are you able to understand? Next, at the time of partition of HUF, division of HUF, you have withdrawn money from NABARD account. In that case also it is not taxable. At the time of liquidation of company, company got liquidated, amount deposited in NABARD account is withdrawn. At the time of withdrawal, is it taxable? No, it is not taxable. Okay. Aishwarya is asking, is there any lock-in period, sir? I did not understand your question. Yeah, got it. Lock-in period is there. Amount deposited in NABARD account, you should use for buying new plant and machinery. That new plant and machinery should not be transferred before expiry of 8 years. That means new plant and machinery should be used for 8 years. Within 8 years, if you sell plant and machinery, whatever the money that you have received, that money is taxable under PGBP. Are you able to understand? So this is the concept relating to 33AB. 33ABA, same concept, but 33ABA deduction is available if SSE is engaged in the business of prospecting, extraction and production of petroleum. So those who are engaged in the business of petrol, okay, they can claim deduction under section 33ABA. Where they have to deposit money? They have to deposit money with SBI or site restoration account. Is there any time limit? Yes, there is time limit. Before end of previous year, they have to deposit the money. Such money is eligible for deduction under section 33 ABA. How much amount is allowed as deduction? Actual amount deposited or 20% of net profit, whichever is lower will be allowed as deduction. Are you able to understand? So, actual amount deposited in account opened with SBI or 20% of net profits, whichever is lower is eligible for deduction. Okay. Now, whatever the amount deposited in SBI account, that should be used for authorized purposes only. If you do not use for authorized purposes, if you misutilize the money, amount misutilized is taxable as PGBP income. Next, if you withdraw money from SBI account, you should spend in current year only for authorized purposes. If you do not spend, whatever the unutilized money is there at the end of the previous year, that is taxable as PGBP income. Okay. So this is all about 33AB and 33ABA. Next, section 35, scientific research. Scientific research expenditure. See, there are two types of scientific research expenditure. In-house scientific research, contributions or donations. In-house scientific research means what? Within your business only you are doing scientific research. That is allowed as deduction. See, scientific research is costly affair. Sometimes you will not have money to do scientific research. Then you will give donation to Scientific Research Association. Even donation given to Scientific Research Association is also allowed as business expenditure. Are you able to understand? That means what? Even donations given to Scientific Research Association, those donations are eligible for deduction. But these donations are available as deduction only under optional tax rates. If you are paying taxes under 115 series, 115 BAA, 115 BAB, 115 BAC, then donation given to Research Association is not allowed as deduction. Donation given to Research Association is allowed as deduction only under optional tax rates. Next, in-house scientific research. In-house scientific research means what? Within the business only you are doing scientific research. Okay. Now, you started business. Business started on today, let's say 15th October 2025. Now, before commencement of business 3 years, that means 16th October 22. During this period, if you incur any scientific research expenditure, whether that scientific research expenditure is revenue expenditure or capital expenditure, total expenditure is allowed as deduction in previous year 25-26. Are you able to understand? That means not only current year scientific research expenditure, even before starting of business for a period of 3 years, if you incur any scientific research expenditure, that scientific research expenditure is allowed as deduction in the year in which you started the business. Are you able to understand? So, and after starting the business, if you incur any scientific research expenditure, that can be either revenue expenditure or capital expenditure, that is allowed as deduction in 25-26. Are you able to understand? After you start business, every year, whatever the scientific research expenditure that you incur, whether it is revenue expenditure or capital expenditure, total expenditure is allowed as deduction on every year. But even before starting of business, if you incur any scientific research expenditure, that scientific research expenditure is also allowed as deduction in the year in which you have started the business. Are you able to understand? In 26-27, you have incurred scientific research expenditure, that is allowed as deduction in 26-27. So every year, whatever the scientific research expenditure you incur, that is allowed as deduction in that year. But there is one point here. Before commencement of business, revenue expenditure means only material cost, salaries. Only material cost, salaries. After commencement of business, revenue expenditure means any revenue expenditure. Are you able to understand? Here, capital expenditure excludes land. What it means? For scientific research, if you buy any land, land is not allowed as deduction. Land is capital expenditure only, but land is not a depreciable asset. So, whatever the land cost is there, that is not allowed as deduction in P&L account. Are you able to understand? Here also capital expenditure excludes land. For scientific research, if you buy any land, that land is not allowed as deduction in P&L account. So if you are paying taxes, next, this is all about in-house scientific research. If you give contributions or donations, important, only if you give donation to approved research association, very important, approved. Only if donation is given to approved association, then only the donation is eligible for deduction. Otherwise, such donation is not eligible for deduction. So, donation given to approved research association or approved university, approved college, such donation is eligible for deduction. Otherwise, such donation is not eligible for deduction. Are you able to understand? So, approved research association, approved Indian company, approved college, only donations given to approved associations is eligible for deduction. Otherwise, they are not eligible for deduction. Another important point, donation given to approved association is available only under optional tax rates. If you are paying taxes under 115 series, donation given is not eligible for deduction. If you are paying taxes under 115 BAA, BAB, then donation given to approved research association not eligible for deduction. Are you able to understand? Sale of scientific research asset. See, in 23-24, you purchased one laptop, 80,000 for scientific research. What you will do? In P&L account, total 80,000 you will claim as deduction, right? 80,000 you will claim as deduction in P&L account. In 24-25, that laptop became outdated. Now you have two options. Option 1, sell laptop. Option 2, use in other department. It is outdated, you cannot use in scientific research department. Now you will use in other department. Okay, accounts department, finance department, like that. If you sell laptop, you will get sale proceeds, right? Let's say you sold for 90,000. Out of 90,000, how much is the deduction claimed earlier? Deduction claimed earlier is 80,000. So 80,000 will be credited to P&L account. How much is balance? Balance is 10,000. That 10,000 will be taxable as capital gains. Are you able to understand? That means whenever you sell asset directly from scientific research department, whatever the amount that you receive, out of that amount, to the extent of deduction claimed earlier, it will be credited to P&L account. Balance amount, it will be taxable as capital gains. Is it clear? If asset is used in other department, that means what? You bought asset for scientific research department. Now that asset is outdated. When that asset is outdated, you are going to use that asset in other department. Whenever you use the asset in other department, you will add the asset to block of asset. Add to block of asset. But you will add at cost 0 rupees. You already claimed 100% expenditure in 23-24. Now, when you are adding that laptop in general business, you will add it to block of assets. But to block of assets, you will add it 0 rupees. Are you able to understand? Why you are adding at 0 rupees? Suppose you added at 20,000 rupees. If you add it at 20,000 rupees, that on that 20,000, you will provide depreciation. If you provide depreciation, it will lead to double deduction. So to prevent double deduction, it will be added at 0 rupees. You already claimed 100% deduction. Now no more deduction is available. That's why you are going to add laptop at 0 rupees. Are you able to understand? So this is the concept of section 35 scientific research. Now let's take break for some time. Okay. Hello CA final students. I have done PGBP revision of part 1, part 2. Now I am starting part 3. In part 2, I have discussed till section 35, scientific research expenditure. Now let us start discussing section 35 ABA, 35 ABB. My dear students, if you want this material is available in my website. You can download from there. Okay. Now, see, 35 ABA, 35 ABB, it's all about telecommunication spectrum or telecommunication license fees. See, what is the tax treatment? Telecommunication license fees, or you can call it as spectrum. Here, two things are there. If you buy license before commencement of business, separate treatment is there. If you buy license after commencement of business, separate treatment is there. If license bought before starting of business, that means before commencement of business, then deduction allowed. Deduction is allowed from previous year in which business starts till previous year in which business expires. Okay. Second, if license bought after starting of business, after commencement of business or after starting of business, then deduction is allowed starting from previous year in which license fees is paid. till previous year in which business expires. For example, let's say there is new company Geo Limited. Geo Limited purchased license in previous year 15-16. But Geo Limited did not start in 15-16. Let's say Geo Limited started in previous year 16-17. So Geo Limited purchased the license before starting the business. In that case, deduction is allowed from previous year in which business is started. When business is started in 2016-17. Are you able to understand? So let's say in 15-16, license fees is paid for 10 years. That means till 25-26. No. Or for example, to be more precise, license fees was paid on 1st April 2015. Now, when license will end? License will end on 31st March 2025. So, here deduction is allowed from 2016-17 to 2024-25. That means over a period of 9 years, deduction is allowed. Okay. So, how much license fees is paid? 80 lakhs. 80 lakhs divided by 9 years. How much? 8,88,888 will be allowed as deduction over a period of 9 years. Are you able to understand? For example, after starting the business, if license fees is paid, let's say business started in previous year 2001-2. License fees paid on 1st April 2015. In this case, the year in which license fees is paid, when license fees is paid, previous year 15-16 till previous year 24-25, deduction is allowed. That means deduction is allowed over a period of 10 years. 80 lakhs divided by 10 years. Every year 8 lakhs will be allowed as deduction. Very simple. When license fees is paid, if license fees is paid before commencement of business, business did not start, so the year in which business starts, from that year you will claim the deduction. If license fees is paid after starting the business, then the year in which license fees is paid, from that year only you will start claiming the deduction. Are you able to understand? Let's say license fees 80 lakhs. It is duration, tenure is 10 years. Now, how much is written down value after 2 years? How much written down value? Cost 80 lakhs less deduction for 2 years. How much will be the deduction? Deduction for 2 years is 16 lakhs, correct? Written down value is 64 lakhs. Okay. Now, full license was sold. License was sold. 3 cases. Case 1, it was sold for 58 lakhs. Case 2, it was sold for 72 lakhs. Case 3, it was sold for 90 lakhs. Now, in case 1, it was sold for 58 lakhs. Is there surplus or shortfall? There is shortfall. How much is shortfall? Shortfall is 6 lakhs. That will be debited to P&L account. Are you able to understand? Next. In case 2, is there shortfall or surplus? Written down value is 64 lakhs, but it was sold for 72 lakhs. When it is sold for 72 lakhs, it is surplus. How much is surplus? Surplus is 8 lakhs. This 8 lakhs will be credited to P&L account. Okay, next. In case 3 also surplus, 90 minus 64, 26 lakhs. See, license is purchased for 80 lakhs. It was sold for 90 lakhs. That means over and above cost it was sold. Cost is 80 lakhs. It is sold for 90 lakhs. Over and above cost, whatever the extra sale price received is there, that is capital receipt and it is taxable under capital gains. So out of 16 lakhs, 10 lakhs is taxable under capital gains. Remaining 16 lakhs, it is credited to P&L account. Are you able to understand? This is in case of sale of full license. Are you able to understand? Next. Shall I explain case of sale of part of the license? Now, written down value is 64 lakhs. See, whatever the license is there, license is for whole India. Now, South India license, that means part of the license. South India license, nothing but part of license sold for 50 lakhs. It is sold for 50 lakhs. Case 1, 50 lakhs. Case 2, 68 lakhs. Case 3, 85 lakhs. Now, in case 1, it is sold for 50 lakhs. How much is balance amount? 14 lakhs. That 14 lakhs is allowed as deduction. See, here full license is not sold, only part license is sold. Whenever part of the license is sold, whatever the unamortized amount is there, this 14 lakhs we call as unamortized amount. Okay. That unamortized amount is allowed as deduction over balance number of years. How many are balance years? Balance years are 8 years. So, each year how much deduction is allowed? 14 lakhs divided by 8. 1,75,000 is allowed as deduction. In case 2, there is surplus na. Surplus 4 lakhs. That will be credited to P&L account. Okay. In case 3 also there is surplus 21 lakhs. Correct. But see, cost of license is only 80 lakhs. It was sold for 85 lakhs. Over and above cost, extra money is received. That extra money we call as capital receipt. So out of 21 lakhs, 5 lakhs is taxable as capital gain. Remaining 60 lakhs, it will be credited to P&L account. So did you understand now the example? Whenever full license is sold, if there is shortfall, debit to P&L account. If there is surplus, then over and above cost, if there is surplus, capital gain. Balance surplus, it will be credited to P&L account. Okay. Next. If part license is sold, whatever the unamortized amount is there, that unamortized amount is allowed as deduction over a period of time, over balance useful life of the license. Okay. Balance life of the license. And see, if you observe carefully, case 2, case 3 are same when it comes to full license or part license. The only change is case 1 is changing. Okay. When full license is sold, in case 1 it will be debited to P&L account straight away. When part license is sold, whatever the shortfall is there, that will be allowed as deduction over remaining life of the license. Did you understand? So this is the concept of sale of telecommunication license or spectrum. Next, expenditure on rural development program. Very simple. If any expenditure is spent on rural development program or National Urban Poverty Eradication Fund, whatever the amount spent is there, such amount is allowed as deduction. Okay. 100% amount contributed is allowed as deduction. Next, 35CCC, Notified Agricultural Extension Project. See, there are two sections, 35CCC, 35CCD. 35CCC is eligible for all SSEs, but 35CCD is eligible only for company SSEs. Please remember this difference. Okay. Anyone can claim deduction under 35CCC, but only company SSEs can claim deduction under 35CCD. Are you able to understand? So, if any amount is spent for Notified Agricultural Extension Project, whatever the amount spent, 100% of the amount is eligible for deduction. Okay, whether it is revenue expenditure or capital expenditure, other than land and building. If you incur capital expenditure of land and building, they are not allowed as deduction. Next, Notified Skill Development Project. If any expenditure is spent on skill development project, only for company SSD, amount contributed is eligible for deduction. Whether that expenditure is revenue expenditure or capital expenditure, other than land and building, is allowed as deduction. Another important point. If SSC is paying taxes under 115 series, 35CCC is not allowed as deduction. Similarly, 35CCD is eligible only for companies. So if company is paying taxes under 115 BAA or 115 BAB, then 35CCD deduction is not available. Okay. So remember, 35CCC, 35CCD available only under optional tax rates. They are not available under default tax rates. If anyone is paying taxes under 115 series, then 35CCC and 35CCD deduction is not available. Are you able to understand? Shall I explain further? 35AD, very important. सबसे ज़्यादा important. Shall I start 35AD? Now, see, there are list of 14 businesses covered under section 35AD. How many? 14. If you start these 14 businesses, there is specified date, okay? If that business, specified business starts after specified date, then that specified business is eligible for deduction under section 35AD. Sir, what is the importance of 35AD? If you start specified business after specified date, then not only revenue expenditure, even capital expenditure also you can claim as deduction under section 35AD. Let's say hotel is specified business. Today I started hotel. In that hotel, not only revenue expenses, whatever the capital expenses that I spent in current year, all capital expenses also I can claim as deduction under section 35AD. Normally, we will recognize capital expenditure as asset. Next, on that capital expenditure, we will provide depreciation over a period of time. But if you are starting specified business now, after specified date, 100% of the capital expenditure, the year in which you incur, in that year only you can claim it as deduction. Okay, that is the advantage of 35AD. Now, what are the businesses? Laying and operating a cross-country natural gas pipeline. Next, cold chain facility, warehousing facility for storing agricultural produce. Very important. For storing finished goods, you have constructed warehouse. You are into the business of construction of warehouses and giving warehouses on rent for storage of finished goods. Now, whether your business is eligible for deduction under 35AD? No. Only warehousing businesses, warehousing facility that is meant for storage of agricultural produce, that is only eligible for deduction under section 35AD. Paddy is agricultural produce. Rice is not agricultural produce. Okay. Sugar cane is agricultural produce. Sugar is not agricultural produce. Okay. Like groundnuts, they are agricultural produce. Groundnut oil is not agricultural produce. Okay. If you construct warehouse and if you give that warehouse on rent for groundnut oil storage, that is not eligible for deduction under section 35AD, because groundnut oil is not agricultural produce. Raw groundnut is treated as agricultural produce. Next, hotel of 2-star or above category. So if you construct hotel of minimum 2-star rating, then that hotel will be treated as specified business, and if that hotel starts after 1st April 2010, that hotel is eligible for deduction under section 35AD. Next, hospital business. Hospital containing minimum 100 patient beds. So if you construct any hospital that consists of minimum 100 patient beds, that hospital is also treated as specified business, and in that specified business you can claim 100% deduction under section 35AD. Next, if you are into the business of construction of houses under slum redevelopment scheme or affordable housing projects. So two things, your main business is constructing houses. You do not construct houses privately, you will construct houses only for government. Under which schemes? Slum redevelopment scheme, affordable housing scheme. Okay, then your construction business will be treated as specified business, then that construction business is eligible for deduction under section 35AD. Are you able to understand? Next, production of fertilizer in a new plant or in a newly installed capacity in an existing plant. So like if you are into the business of production of fertilizer, even that fertilizer production business is also treated as specified business and is eligible for deduction under section 35AD. Next, inland container depot or container freight station, that business is also treated as specified business. Beekeeping and production of honey. So if you are into the business of honey bee keeping to extract honey. Okay, even that honey bee keeping business is also treated as specified business, and if that business starts after 1st April 2012, such business is eligible for deduction under section 35 AD. Next, setting up and operating a warehousing facility for storage of sugar. See, sugar is not agricultural produce. That's why he mentioned separately. Not only for sugar cane, even for storage of sugar, if you construct warehouse and if you give that warehouse on rent and are earning rental income, even that warehouse renting business is also treated as specified business. So there is interlink. You can keep third point and uh, 11th point. There is interlink. Third point, warehousing business for storage of agricultural produce. 11th point, warehousing facility for storage of sugar. Next, laying and operating slurry pipeline for transportation of iron ore. So iron ore basically in liquid form. So if you construct pipeline for transportation of iron ore, so your main business is you will give pipeline on rent for transportation of iron ore. Even that business is also treated as specified business, and if that business starts after 1st April 2014, that business is eligible for deduction under section 35 AD. Next, developing or maintaining infrastructure facility. Nothing but if you are into the business of constructing airports, seaports for the purpose of government, then also your business will be treated as specified business. You can see infrastructure facility, it is given here. Okay. So all these 14 businesses are specified businesses. In these 14, if you start these 14 businesses on or after specified date, then those 14 businesses are eligible for deduction under section 35 AD. Okay. Which expenses are allowed as deduction? 100% of capital expenditure is allowed as deduction other than three assets. What are they? Land, goodwill, financial assets. I am sorry, it is missing. Please write down financial assets. So in specified business, whatever the capital expenditure that you incur, 100% capital expenditure is allowed other than three assets. What are they? Land, goodwill, financial assets. Other than these three assets, remaining all capital expenditures are allowed as deduction. Are you able to understand? Next. Let's say today you started specified business. Let's say on 15th October 25, you started specified business. Not only current year, before commencement of specified business, whatever the expenditure that you incur, whether it is capital expenditure or revenue expenditure, okay, 100% of the expenditure is allowed as deduction in previous year 25-26. Are you able to understand? So 3 years time limit is not applicable. 3 years time limit is applicable only for scientific research. For specified business, 3 years concept is not applicable. From last 10 years, you are constructing one project for the purpose of specified business. Last 10 years construction expenses, you can claim as deduction in 25-26. Okay. So before starting specified business, whatever the expenditure that you incur, capital expenditure or revenue expenditure, 100% of the expenditure is allowed as deduction in the year in which you started the business. But only condition is in balance sheet, whatever the expenditure that you have incurred, okay, that should be recognized as capital expenditure. So in accounts books, if you recognize that capital expenditure as asset, then you can claim 100% deduction in the year of commencement of business. Okay. You can read these points, you will understand. Next. Specified business loss can be set off only against specified business profits. Okay. Can you set off specified business loss with non-speculative business profits? You cannot do set off. So we can tell specified business loss is identical loss. What do you mean by identical loss? That type of loss can be set off only against that type of profits. Okay, specified business loss can be set off only against specified business profits. Are you able to understand? Another important point, let's say there is 5-star hotel 1, hotel Novotel, and there is another hotel, 5-star hotel ITC. Now, Novotel started in 2014-15, ITC started in 2005-6. Now, ITC started in 2005-6, but what is the criteria? Hotel should be started after 1st April 2010, correct? So, whether ITC is eligible for deduction under section 35AD? No, ITC is not eligible for deduction under section 35AD. However, Novotel started in 14-15. Novotel is eligible for deduction under section 35AD. Now my question is whether ITC loss, let's say, no, not ITC loss, there is Novotel loss. Novotel loss 8 lakhs. ITC is in profits. Profits 10 lakhs. My question is whether 8 lakhs loss, can it be set off against 10 lakhs profits or not? Did you understand the question? Can you set off 8 lakhs loss with 10 lakhs profits? Answer is yes. Many students will tell answer no, but answer is yes. The reason is every hotel business is specified business. But if hotel starts before 1st April 2010, it is not eligible for deduction under section 35AD. If hotel 2-star or above, if it starts after 1st April 2010, then it is eligible for deduction under section 35AD. So both are specified businesses only. Novotel is specified business, ITC also specified business. As both are specified businesses, you can set off Novotel loss with ITC profit. Are you able to understand? See, whether deduction is available under 35AD or not, that is secondary. First of all, are they specified businesses or not? ITC is specified business, Novotel is also specified business. Once both are specified businesses, one specified business loss, you can set off against another specified business profit, even though other specified business is not eligible for 35AD deduction. Are you able to understand? I hope now you got clarity. You can read this point, second note point, any loss from specified business can be set off against profit of another specified business, even though such another specified business was not eligible for deduction under section 35AD. Very, very important. Even though other is not eligible for deduction under section 35AD. Next. If SSE is paying taxes under 115 series, then SSE cannot claim deduction under section 35AD. So, if SSE is paying taxes under 115 BAA, BAB, BAC, then SSE cannot claim deduction under section 35AD. Here also, that 40A3 concept is applicable. Per person per day, you should not make cash payment of more than 10,000 rupees. If you make cash payment, if it is revenue expenditure or capital expenditure, that is not allowed as deduction in P&L account. Okay, so per person per day, you should make payment only through bank transaction if amount of payment is more than 10,000 rupees. Next, like existing hotel, you changed colors and you started it as new business. Can it claim deduction under section 35AD? No, it cannot claim. So if any existing business was set up by splitting up or reconstruction of existing business, then that business is not eligible for deduction under section 35AD. Are you able to understand? You are starting specified business after specified date. Okay. specified business after specified date. The point is, whatever the plant and machinery that you purchase, out of plant and machinery, 80% of plant and machinery should be new plant and machinery. 20% of plant and machinery can be second hand. Okay, can be second hand. But if more than 20% plant and machinery is second hand, then you cannot claim deduction under section 35 AD. 35 AD deduction is not available. So not only starting specified business, in that specified business you should purchase new plant and machinery, then only 35 AD deduction is available, otherwise 35 AD deduction is not available. Are you able to understand? So you can purchase second hand. Up to 20% value of plant and machinery can be second hand. If more than 20% value of plant and machinery is second hand, then you are not eligible to claim deduction under section 35 AD. Here there is one note point. What is the note point? If you import second hand plant and machinery, importing second hand plant and machinery into India is not treated as second hand plant and machinery. It will be deemed as first hand plant and machinery only. So if you import second hand plant and machinery from outside India, it is not second hand plant and machinery. It will be deemed as first hand plant and machinery only. But there is one condition. The only condition is on importation of second hand plant and machinery, you should not, like no other person should have claimed depreciation in India. If any person already claimed depreciation on it in India, then it will not be deemed as first hand. It will be treated as second hand plant and machinery only. Are you able to understand? I will tell one example. Let's say Ambani. And let's say Tesla is there. Tesla sold one car to Reliance Inc, US company. From US company, that car is imported to India. Now, already car is used by Reliance Inc. So, he is first hand. Ambani is second hand. Even though Ambani is second hand, as it is imported from outside India, it will not be treated as second hand. It will be deemed as first hand plant and machinery. Okay. Now, later on, I purchased Tesla car from Ambani. Now, Ambani in his books on Tesla car, he will provide depreciation. Na? Whenever I purchase car from Ambani, it is third hand, correct? Now, whether third hand car is deemed as first hand plant and machinery? No, it will not be deemed as first hand plant and machinery. It will be treated as second hand plant and machinery only. Are you able to understand? Why? Because in India, already Ambani claimed depreciation on that asset. Once depreciation is claimed in India on that asset, afterwards if I purchase it, it will not be deemed as first hand plant and machinery. It will be treated as second hand or third hand plant and machinery only. So, when you import goods from outside India, even though you are importing second hand, it will be deemed as first hand, provided no depreciation should be provided in India. If already depreciation is provided in India and you are importing goods, importing plant and machinery to India from outside India, still it will not be deemed as first hand. It will be treated as second hand plant and machinery only. Okay. Next, write one note point. If you claim deduction under section 35 AD, deduction under section 80 JJAA is not available. Okay. So once you claim deduction under 35 AD, 80 JJAA deduction is not available. Next, whenever you buy any asset for specified business, you should use that asset for specified business only. But if you sell that specified, like that asset, if it is demolished, destroyed, discarded or transferred, then whatever the amount received is there, that is taxable under PGBP. Are you able to understand? For example, in 23-24, you bought one air conditioner, 40,000 rupees. What you will do? In P&L account, you will claim 40,000 as deduction. In 24-25, you sold AC for 15,000 rupees. Now, whatever 15,000 is there, that should be credited to P&L account in previous year 24-25. So, whenever you buy any asset for specified business, in the year of purchase only, you will claim 100% expenditure. Subsequently, whenever you sell, whatever the sale proceeds that are received, those sale proceeds should be credited to P&L account. Are you able to understand? Let's say I am having two businesses. For example, I am having hotel business, 3-star hotel. I am also having education business. Now, hotel is specified business? Yes. Whether education is specified business? No, education is non-specified business. I purchased one laptop in hotel. I purchased one laptop in hotel. Now, I purchased it for 70,000 rupees. I purchased in 23-24. What I will do in P&L account 23-24, I will claim it as deduction, total 70,000. Correct? Once you buy any asset for specified business, you should use it in specified business for 8 years. Before 8 years, if you transfer the asset from specified business to non-specified business, for example, in previous year 25-26, I transferred a laptop. Laptop is transferred from hotel business to education business. That means what? Initially, I purchased the laptop for hotel business, specified business. I claimed 100% deduction. Now, I have to use laptop in hotel business for 8 years. Within 8 years, if I shift the laptop from hotel business to education business, then in 25-26, in P&L account, whatever the expenditure that I have claimed, total expenditure will be credited to P&L account. Are you able to understand? Next, accumulated depreciation will be allowed. Accumulated depreciation. How much is cost? 70,000. If it is used in education business only from beginning onwards, how much depreciation will be provided in 23-24? 70,000 into 40%, 28,000. How much is written down value? 42,000. How much depreciation will be provided for 24-25? 16,800. How much is balance? 25,200. So how much is total depreciation? 28,000 plus 16,800, 44,800. Accumulated depreciation will be allowed as deduction. Are you able to understand? That means what? Initially, you bought it for specified business. You should use for 8 years. But did you use for 8 years? You did not use for 8 years. Within 8 years only, you shifted the asset from specified business to non-specified business. Now you have to change the treatment. Earlier you claimed 100% deduction. Now reverse 100% deduction. If from beginning onwards, if you use the laptop for education business, how much accumulated depreciation you would have claimed as deduction? That much accumulated depreciation you can now claim as deduction. Is it clear? Did you get clarity? This is all about 35 AD, very, very important. I hope you are enjoying the session. Many intricate points we are discussing. Next, shall we discuss section 35D? See, telling regular class, telling revision class or marathon is different. Regular class, aram se, okay, slowly we will tell. we will take lot of time. In between, we will have some fun jokes. But telling revision class, it will be very fast and it drains lot of energy. Next, preliminary expenses. You all know preliminary expenses. Before starting the business, whatever the expenditure incurred for preparation of MOA, AOA, preparation of agreements, preparation of project report, all these expenses we call as preliminary expenses. Now, preliminary expenses are allowed as deduction, but preliminary expenses are not allowed as deduction in a single year. Basically, preliminary expenses are allowed as deduction over a period of 5 years in 5 equal installments. Okay. Next, everyone cannot claim preliminary expenditure as deduction. Only Indian company or person resident in India can claim preliminary expenditure as deduction. Okay. So non-residents, foreign companies, they cannot claim preliminary expenditure as deduction. Only residents or persons, Indian companies or domestic companies, they only can claim preliminary expenditure as deduction. Now, how much preliminary expenditure is allowed? Generally, whatever the actual preliminary expenditure is there, actual preliminary expenditure is not allowed as deduction. Actual preliminary expenses are 5% of cost of project. Whichever is lower will be allowed as deduction. What do you mean by cost of project? Here I have given cost of project means the year in which you start the business. In that year, you will prepare balance sheet. Now, at the end of the year, in balance sheet, whatever the value of assets is there, that value of assets we call as cost of project. Are you able to understand? So, actual cost of fixed assets as on the last day of the previous year in which business commences, that we call as cost of project. So please remember, actual preliminary expenditure not allowed. Actual preliminary expenditure or 5% of cost of project, whichever is lower will be allowed as deduction. But in case of Indian company, preliminary expenditure is allowed. That calculation we do in 3 steps. Step 1, 5% of cost of project or 5% of capital employed, whichever is higher. Step 2, actual preliminary expenses. Step 3, step 1 or step 2, whichever is lower. I will tell one example. Let's say cost of project is 100 crores. Capital employed is 90 crores. Actual preliminary expenditure is 8 crores. Now, whether 8 crores is allowed as deduction, let us do. Step 1. What is step 1? 5% of cost of project or 5% of capital employed, whichever is higher. Correct? Cost of project 100 crores. 100 crores into 5%, it will be 5 crores. Or 90 crores into 5%, how much? 4.5 crores. Out of these two, whichever is higher means 5 crores. Step 2. Actual preliminary expenditure, how much? 8 crores. Step 3, deduction eligible. How much expenditure is eligible for deduction? Step 1 or step 2, whichever is lower. That means 5 crore or 8 crore, whichever is lower, only 5 crores is eligible for deduction. How much is actual preliminary expenditure? 8 crores. Can you claim 8 crores as deduction? No, only 5 crores is allowed as deduction. Another important point, 5 crores not allowed as deduction in single year. 5 crores will be allowed as deduction in 5 years in 5 equal installments. Are you able to understand? So 5 crores divided by 5 years, each year 1 crore will be allowed as deduction. Are you able to understand? So preliminary expenditure is not allowed as deduction in a single year. Preliminary expenditure is allowed as deduction over a period of 5 years in 5 equal installments. Okay. Next. Many students think that only for new business there will be preliminary expenditure. But your notion, your contention is not correct. Even in case of existing business, there will be preliminary expenditure. Even in case of existing business, if you are starting new unit or if you are starting new branch, with regard to that new unit or with regard to that new branch, if you incur any preliminary expenditure, that preliminary expenditure will be allowed as deduction. Are you able to understand? Setting up of a new unit, expenses incurred till new unit commences production or operation. So even for existing business also 35D deduction is available. When if existing business starts a new branch or starts new unit, for starting that new branch or new unit, whatever the preliminary expenditure incurred is there, that is eligible for deduction under section 35D. Total expenditure is not eligible. Again, this formula, as per this formula, preliminary expenditure will be allowed, and that preliminary expenditure is allowed over a period of 5 years in 5 equal installments. Okay, so this is the concept of section 35D. Here there is one small mistake. Amortization of expenses of amalgamation or demerger, it is not section 35D, it is section 35DD. Please change the section number, it is editing mistake, I am sorry. So whenever amalgamation is done, there will be amalgamation expenses. You all know, if two companies wants to get amalgamated, they need to take approval of NCLT, National Company Law Tribunal. So for getting approval from NCLT, there will be amalgamation expenses. You need to pay professional fee, you need to pay fees to the NCLT. So whatever amalgamation expenses are there, amalgamation expenses are allowed as deduction under section 35DD. Okay. And amalgamation expenses are eligible for deduction only for Indian company. Foreign company cannot claim amalgamation expenses as deduction. Next, Indian company, whatever the amalgamation expenses are there, they are not allowed as deduction in a single installment. Amalgamation expenses are allowed as deduction over a period of 5 years in 5 equal installments. Are you able to understand? Section 35DDA, very important, write down cash basis. Cash basis. VRS expenditure, you all know VRS compensation, right? VRS compensation is expenditure to employer and income to employee. Okay, that income to employee is taxable under salaries. Whatever expenditure to employer is there, that is allowed as deduction under section 35DDA. Okay. Now, VRS compensation, it is not allowed as deduction on accrual basis. Even though company is following accrual basis, still VRS compensation is allowed as deduction on cash basis. That means the year in which you pay VRS compensation, from that year onwards, VRS compensation is allowed as deduction. That is point number 1, allowed only on cash basis. Point number 2, VRS compensation is very huge amount. It is not allowed as deduction in a single year. VRS compensation is allowed as deduction over a period of 5 years in 5 equal installments. Are you able to understand? Let's say in 23-24, VRS given, compensation 60 lakhs. In 24-25, compensation paid. Now tell me whether VRS compensation is allowed in 23-24. It is not allowed in 23-24, not on accrual basis. On accrual basis, it is not allowed as deduction. When it was paid in 24-25. So allowed as deduction from 24-25 onwards. Okay. So 60 lakhs divided by 5. What I told, VRS compensation allowed on cash basis. Point number 2, not allowed in single installment. It is allowed as deduction over a period of 5 years. 60 lakhs divided by 12 lakhs. 5 years, 12 lakhs. So every year 12 lakhs will be allowed as deduction. Are you able to understand? Now some students will get doubt. Sir, what if compensation is paid in installments? For example, it will be interesting. Listen, 60 lakhs. In 24-25, 30 lakhs was paid. In 25-26, 20 lakhs was paid. In 26-27, 10 lakhs was paid. Okay. Now, for each installment allowed as deduction in separate 5 years. Okay. Now, 30 lakhs by 5 years. How much? 6 lakhs. 20 lakh by 5 years. How much? 4 lakhs. 10 lakh by 5 years. How much? 2 lakhs. So, let's write down 24-25, 6 lakhs, 25-26, 6 lakhs, 26-27, 6 lakhs, 27-28, 6 lakhs, 28-29, 6 lakhs over. Now, this 4 lakhs, when it was paid 25-26, so is it allowed as deduction in 24-25? No, it is not allowed as deduction in 24-25. It will be allowed as deduction from 25-26 onwards. So each installment in which year it is paid from that year onwards allowed as deduction over a period of 5 years. Are you able to understand? So like 4 lakhs, 4 lakhs, 4 lakhs, 4 lakhs. In 29-30, another 4 lakhs will be allowed as deduction. Okay. 10 lakhs. When it was paid in 26-27. So starting from 26-27, that 10 lakhs will be allowed as deduction. Not allowed in 24-25, not allowed in 25-26. Allowed from 26-27 onwards. Are you able to understand? So previous year 30-31. So each year how much is allowed as deduction? 6 lakhs, 10 lakhs, 12 lakhs, 12 lakhs, 12 lakhs, 6 lakhs, 2 lakhs. Okay. I hope you got clarity now. 35 DDA. Next, amortization of expense incurred for prospecting of minerals. See, if you are into minerals business, coal, limestone, like that, if you are into minerals business, for the purpose of prospecting of minerals, if you incur any expenditure, okay, either in the year in which you started the business, during the year of commercial production, or 4 years immediately preceding that year. For example, in 24-25, you started minerals business. See, before starting minerals business only, you are prospecting minerals. Now, expenditure incurred in 24-25 plus expenditure incurred in last 4 years. 4 years means 23-24, 22-23, 21-22, 20-21. All this expenditure, let's say expenditure is 80 lakhs. So whatever the expenditure incurred for prospecting minerals, the year in which you start the business, that year plus last 4 years, during these 5 years, whatever the expenditure that you incur for prospecting minerals is there, that is not allowed as deduction in single installment, that is allowed as deduction over 10 years. Allowed as deduction for 10 years. Okay. You can see allowed over a period of 10 years starting from the year in which commercial production is started. So when commercial production is started in 24-25. So starting from 24-25, that expenditure will be allowed as deduction over a period of 10 years. Okay. Next, we will discuss section 36. Multiple points are there in 36. Then we will discuss section 37. I know it is taking time, but I am not compromising on revision. Whatever I do, I wanted to do it, very comfortably. So even though it is taking little bit time, it's okay because quality is important. I hope you are absorbing the concept well. Okay. Next, we will start with deductions under section 36. Insurance premium. See, in business you will pay insurance premium, right? For raw materials, for finished goods, you will take stock insurance. Whatever the stock insurance that you pay, that stock insurance is allowed as deduction under section 36. Are you able to understand? So, if you take any insurance, either for stocks and stores, stores means what? Inputs, raw material, okay? Stocks means output. So, whatever the expenditure, stock insurance premium that is paid for raw material and finished goods is there, that stock insurance premium is business expenditure and is allowed as deduction under section 36. Next, if any insurance premium is paid by Federal Milk Cooperative Society on lives of cattle owned by members of Primary Milk Cooperative Society. See, in our villages we can see all farmers will come together and they will form cooperative society. Farmers will have buffaloes. Through buffaloes, they will do daily milking and they will supply that milk to cooperative society. Now, cooperative society is not owning buffaloes. Cooperative society members, farmers are owning the buffaloes. Still, if cooperative society pays any insurance premium against life of buffaloes, that insurance premium is business expenditure and it is allowed as deduction under section 36. Okay. Next, health insurance premium. Obviously, many corporates will pay health insurance premium for its employees. Whatever the health insurance premium paid by employer is there, it is genuine business expenditure to employer and such expenditure is allowed as deduction under section 36. Are you able to understand? But the only condition is that insurance premium should be paid any mode other than cash. So if employer is paying health insurance premium, he should pay health insurance premium by way of bank transaction. Then only it is eligible for deduction. Otherwise, it is not eligible for deduction. Next, bonus or commission. See, bonus or commission or expenditure, they are allowed as deduction as per section 43B. What 43B says? 43B allowed as deduction on cash basis. So, whatever the bonus, whatever the commission is there, bonus or commission is allowed as deduction only if they are actually paid to employees. Otherwise, they are not allowed as deduction. Okay. Interest on borrowed capital. First of all, if you take loan for personal purposes, on that loan, if you pay interest, it is personal purpose interest. Personal purpose interest is not allowed as business expenditure under PGBP. So very important, you have to take loan for business. Then only interest paid is eligible for deduction under section 36. If you take loan for personal purposes, interest paid is not eligible for deduction. Are you able to understand? Next. Once you take loan for business, in business, why you are using that loan, that is not relevant. In business, whether you are using loan for working capital purpose, whether you are using loan for purchase of asset, whether you are using loan for payment of salaries, whether you are using loan for purchase of raw material, purpose is irrelevant. Once you use the borrowed money for business purpose, sufficient, you can claim interest as expenditure. Are you able to understand? Purpose of borrowing is irrelevant. Why you borrowed money? Irrelevant. What is relevant is, did you use that money for business or not? If you use that money for business, you can claim expenditure as deduction. Are you able to understand? Interest expenditure. Next. Only interest paid to third party is eligible for deduction. If you pay interest to yourself, interest on proprietor's capital, that is not eligible for deduction. So in case of sole proprietor business, if sole proprietor himself pays interest to him, okay, interest paid to self, not allowed as deduction. However, in case of partnership form is different, partners are different. Both are having separate legal entity. So if partnership firm pays any interest to partner, that interest is eligible for deduction, but subject to section 40B. Are you able to understand? Next. In morning class, part 2, I have explained, whenever you buy any asset, for buying asset, you have taken any loan. Interest from date of taking loan up to the date asset is put to use, that interest will be capitalized. That interest is required to be added to the cost of the asset. Correct? So that's what. So if you take any loan for buying asset, from date of taking loan up to the date asset is put to use, that interest will be capitalized. After asset is put to use, that interest will be debited to P&L account. Okay. Next, there are some loans. If you take loan from scheduled bank, cooperative bank, NBFC, then you have to pay interest now. That interest is allowed as per section 43B. That means only if you pay interest, that interest will be eligible for deduction. Otherwise, such interest is not eligible for deduction. These are the concepts relating to interest on borrowed capital. Okay. Shall we discuss further? Next, discount on zero coupon bonds. See, there is no interest that is paid on zero coupon bonds. If you buy zero coupon bonds, you will not get interest income. Sir, then why will anyone purchase zero coupon bonds? Zero coupon bonds are always issued at discount and are redeemed at face value. So, for example, zero coupon bonds are there. Okay. Face value 100 rupees, but they are issued for 60 rupees. Now, how much is discount? In this case, discount is 40 rupees. This discount 40 rupees is expenditure to issuer and income to buyer. Such income to buyer is taxable under capital gains. And whatever expenditure to issuer is there, expenditure to issuer is allowed as deduction proportionately. Allowed as deduction over lifetime of zero coupon bonds proportionately. Proportionately. That means whatever the life of zero coupon bonds is there, let's say life of zero coupon bonds is 5 years. The date on which zero coupon bonds are issued, from the date over a period of 5 years, that discount will be allowed as deduction. Okay, proportionate. So did you understand? You can see over period of life of the bond. Next, employer's contribution to recognized provident fund and approved superannuation fund allowed as deduction to the extent it is required by law. See, as per law, employer should contribute 12% to employee provident fund, but employer contribution to recognized provident fund is 15%. See, as per EPF Act, how much employer should contribute? 12%. Why is employer contributing extra 3%? In this case, out of 15%, 12% is allowed as deduction. Whatever balance 3% is there, that will be disallowed. Are you able to understand? So, employer contribution as required by law. If that much amount is contributed, allowed as expenditure. If employer contributes extra contribution, that is not allowed as expenditure to employer. Are you able to understand? Next. You know NPS, right? Recently, 80 CCD deduction is available for NPS. Even for NPS also, employer can contribute up to 14% of salary. If employer contributes up to 16% of salary, okay, then out of 16%, 14% will be allowed as deduction. Remaining 2% will be disallowed. So did you understand? I hope you got clarity. Ah, okay, let's take some small break. Hello CMA final students. In last class, we discussed till this point. Now, let us start discussing further concepts. Employee contribution towards welfare schemes. See, you know PF contribution, right? Every month, employer will contribute 12%. Employee will also contribute 12%. Employee contribution 12%. Actually, what happens? Let's say salary of employee is 1 lakh rupees. Now, from that 1 lakh rupees, employer will deduct employee contribution 12%. And only 88,000 will be paid to employee. Correct? Now, in employer P&L account, whenever employee contribution is deducted, immediately whatever the employee contribution that is deducted is there, that should be recognized as income 12,000 rupees. Are you able to understand? So employee contribution, whenever employer reduces employee contribution in employer books of accounts, in employer P&L account, employee contribution will be recognized as income. Now see, employee money is deducted by employer 12,000 rupees. There are chances employer will misutilize this 12,000 rupees. So as employer may misutilize this money, the rule is written like this. Whatever the employee money deducted by employer is there, employer should deposit this money to employee provident fund within the due date as per EPF Act. If employee money is deposited by employer within the due date, then 12,000 rupees is allowed as expenditure. In that way, it gets knocked off. Okay. However, this is when if deposit is done within due date as per EPF Act, within due date as per EPF Act. However, this is case 1, case 2. Whenever employee contribution is deducted, it will be recognized as income. However, if employer deposits employee contribution after EPF due date, then whatever 12,000 rupees expenditure is there, that is not allowed as deduction. Okay, if expenditure is not allowed, only income will be there. Only income will be there, expenditure will not be allowed. In that case, employer need to pay tax on 12,000 rupees. Are you able to understand? So, employer will feel scared. Why employer feels scared? Because employer, he is taking employee contribution. Now, employer should deposit this money to EPF authorities within the due date. Then only 12,000 is allowed as expenditure. Total will get knocked off. If employer fails to deposit that money within the due date, and if employer misutilizes the money, whatever the money that is misutilized is there, whatever the money that is not deposited in EPF authorities within the due date is there, that is not allowed as expenditure. If it is not allowed as expenditure, 12,000 will be recognized as income and no expenditure will be allowed. On this 12,000, employer is required to pay tax. Are you able to understand? So you can read here, first employee contribution is recognized as income. If employer pays employee contribution before the due date as per EPF Act, then it is allowed as expenditure, otherwise it is disallowed. It is not allowed as expenditure. Hi Mahadevan, happy morning. So I hope you got the clarity. Next, deduction of animals used in the business. See, we cannot recognize animals as assets in the books of accounts as per income tax provisions. So whenever you buy any animal otherwise than stock in trade, see, your main business is event management business. In event management business, you bought 2 horses so that you can use those 2 horses to take bride and bridegroom on ride. Okay, so your main business is conducting events. For conducting events, you bought 2 horses. Now, in your event management business, horses are not stock in trade, horses are asset. Now, let's say you bought 2 horses. 2 horses for rupees 20 lakhs. Now, can you claim depreciation on animals? You cannot claim depreciation on animals. Now, your doubt is, sir, when 20 lakhs will be allowed as deduction? 20 lakhs will be allowed as deduction, not in the year of purchase. Additionally, no depreciation will be allowed as deduction on 20 lakhs. Sir, then when 20 lakhs will be allowed as deduction? 20 lakhs will be allowed as deduction in the year of sale of animal, or in the year of sale of dead body of animal. So the year in which you sell the animal, or the year in which you sell the dead body of animal, in that year you have to recognize the expenditure. Let's say both horses died. After death of horses, you sold death body of horses, and on sale of dead bodies you received 50,000. Now expenditure, how much is allowed as expenditure? 20 lakhs minus 50,000, 19.5 lakhs will be allowed as deduction. Are you able to understand? I hope you got clarity. Yeah, one doubt is there for Mahadevan. Employee contribution won't be available even in the month of payment after due date. Yes. See, before EPF due date, you have to deposit money, then only it is allowed as expenditure. After EPF due date, even though you deposit, it is not allowed as expenditure. Even though you deposit before ITR due date, that is not allowed as expenditure. So for this purpose, the due date is EPF due date. Deposit before UPF due date, claim employee contribution as expenditure. Otherwise, it will never be allowed as deduction. Okay. I hope your doubt is clear. Yes, you can't claim later, Aishwarya. Don't get confused. In 43B, you can claim. This is different provision. This is section 36(1). EPF due date. Before EPF due date, you made payment, claim employee contribution as expenditure. Otherwise, it will never be allowed as deduction. So, did you understand in case of animals? No depreciation. Expenditure is not allowed as deduction. Expenditure is allowed only in the year of sale of animal or sale of dead body of animal. How much expenditure is allowed? Actual cost of animal minus amount realized on sale of animal. Next, bad debts. First of all, you gave 20,000 rupees for your friend loan. Your friend did not give you money. Those are bad debts. Those are personal nature of bad debts. Personal nature of bad debts are not allowed as business expenditure. Are you able to understand? Only business related bad debts are allowed as deduction. So please remember, your personal nature of bad debts not allowed as expenditure under PGBP. Next. Capital nature of bad debts are also not allowed as deduction in PGBP. I sold one house for 1 crore. Opposite party paid me 80 lakhs. He said 20 lakhs he will pay me in the next year. But he is not paying me 20 lakhs. 20 lakhs is bad debts. Sir, can I claim those 20 lakhs as expenditure in PGBP? No. Capital nature of bad debts not allowed as deduction under PGBP. First point, personal nature of bad debts not allowed. Second point, capital nature of bad debts are not allowed as deduction. So, the criteria is only revenue nature of bad debts are allowed as deduction under PGBP. Are you able to understand now? To claim bad debts, as deduction, earlier you should recognize that amount as income. Then only bad debts are allowed as expenditure. Otherwise, bad debts are not allowed as expenditure. In previous year 22-23, you have done credit sales. For credit sales, what is the entry that you will pass? debtor account debit to sales account, correct? 10 lakhs, 10 lakhs. So you will write sales 10 lakhs. In 23-24, he said, sir, I cannot give you 10 lakhs. I can only give you 7 lakhs. So he paid 7 lakhs. Balance 3 lakhs waived off. That means what? He said he cannot pay 3 lakh rupees. So we waived off 3 lakh rupees. Now 3 lakh rupees is lost to us, right? 3 lakh rupees are bad debts to us, right? So in 23-24 P&L account, we will claim bad debts 3 lakh rupees as deduction. So if you want to claim 3 lakh rupees as deduction, initially you should recognize this 3 lakhs as income. Are you able to understand? See, out of 10 lakhs, 7 lakhs he paid. 3 lakhs bad debts. But we do not know in 22-23 that he will not give money. That's why in 22-23, how much income we recognized? We recognized 10 lakh rupees income. That means this 3 lakh rupees was already recognized as income in 22-23 and it is not received in 23-24. It is waived off. So that's why those 3 lakhs will be treated as bad debts in previous year 23-24. Are you able to understand? So the point is, crux is, if you want to claim bad debts as deduction, that bad debts amount should be recognized as income in earlier years. Then only bad debts is allowed as deduction. Otherwise, bad debts is not allowed as deduction. Are you able to understand? So you can see debt should be incidental to business. It should have been taken into account in computing income of the SSC in previous year in which such debt is written off or in any earlier previous year. Exception: money lending business. See, in case of money lending business, what's their main business? They will give loans and they will collect money along with interest. Interest is the income. In case of money lending business, whatever the loan given, if loan is not recovered, unrecovered loan can be treated as bad debts, even though it is not recognized as income. Are you able to understand? So, if you want to claim bad debts as deduction in normal business, you should recognize that bad debt amount as income in earlier previous years. In case of money lending business, whatever the money that you gave, if that money do not come back, then whatever the money that could not come back is there, that you can claim as bad debts expenditure. Okay, give me 1 second. Am I audible now? Am I audible? Please confirm. Next, provision for bad debts not allowed as deduction. In accounts, you will write provision for bad debts, right? Provision for bad debts are not allowed as deduction except in case of banks. For certain banks, provision for bad debts is allowed as deduction. That concept I am going to discuss little later. Okay, next. Bad debts must be revenue in nature. I already told you, capital nature of bad debts are not allowed as deduction. Only revenue nature of bad debts are allowed as deduction. And if there is recovery of bad debts is taxable as deemed profits. See, today I claimed 3 lakhs as bad debts, but in 24-25 something happened and he came back to me. He gave me 1,20,000 rupees. Now there is a recovery of bad debts 1,20,000 rupees in 24-25. That is taxable as income. Recovery of bad debts 1.2 lakhs taxable as income. Are you able to understand? Another point, In accounts, whether you have written off the bad debts or not, that is not relevant. In income tax, you can straight away write off the bad debts. Another point, for example, in previous year 22-23, bad debts are 80,000. Now, out of 80,000, income tax officer allowed 45,000. Income tax officer disallowed 35,000. See, whenever bad debts are disallowed, if you disallow bad debts, expenditure decreases. If expenditure decreases, income increases, net profit increases, tax also increases. That means whatever 35,000 is there, 35,000 is already taxed in 22-23. Correct? Taxed in previous year 22-23. Next, in previous year 23-24, there is recovery of bad debts 50,000. How much is recovery of bad debts? 50,000. Out of 50,000, already on 35,000 you paid tax in 22-23, right? So out of 50,000, 35,000 is not taxable because 35,000 is disallowed in earlier year. If it is disallowed in earlier year, already expenditure decreased in earlier year, profit increased in earlier year, tax also paid in earlier year. So already 35,000 is taxed in earlier year. Now only balance 15,000 is taxable in 23-24. Are you able to understand? So the point here is, if any bad debts are disallowed in earlier year, on subsequent recovery of bad debts, out of 50,000, whatever the bad debts that are disallowed and taxable in 22-23 is there, that is not taxable in 23-24. Only balance 15,000 is taxable in 23-24. Are you able to understand? I hope you are clear. This is all about bad debts. Next, we will discuss provision for bad debts. See, generally, in case of normal business, provision for bad debts is not allowed as deduction. Only in case of banks, provision for bad debts is allowed as deduction. In case of any Indian scheduled bank or non-scheduled bank, cooperative bank, for these banks, how much provision is allowed? 8.5% of its total income before making deduction under this clause and before chapter 6A deductions, plus additional deduction 10% of aggregate average advances made by its rural branches. See, for scheduled bank, non-scheduled bank, cooperative bank, you can create provision for bad debts. But how much provision for bad debts is allowed as deduction? Actual provision for bad debts, or maximum 8.5% of total income before chapter 6A deductions, plus 10% of aggregate average advances by rural branches. Out of these two, whichever is lower, that lower amount will be allowed as deduction. That means you can create provision for bad debts, but maximum provision, how much you can create? 8.5% of total income before chapter 6A deductions. Before chapter 6A deductions means gross total income. So 8.5% of gross total income plus 10% of aggregate average advances given by rural branches. Okay, rural branches of the bank. This much, either step 1 or step 2, whichever is lower will be allowed as deduction for provision for bad debts. Are you able to understand? We will do one problem, you will get clarity. You can see, following are particulars in respect of scheduled bank incorporated in India. Provision for bad and doubtful debts under section 36(1) clause 7A up to assessment year 25-26. Assessment year 25-26 means previous year 24-25. How much? 100 lakhs. That means opening balance. Provision for bad debts, will it have positive balance, will it have debit balance or credit balance? Provision for bad debts will have credit balance, correct? Next, gross total income of assessment year 26-27 800 lakhs, aggregate average advances 300 lakhs, bad debts actually written off 210 lakhs. Now, provision for bad debts account, how much is opening balance? Opening balance 100 lakhs, correct? Now, how much provision we can create? Provision 8.5% of gross total income plus 10% of aggregate average advances, correct? How much is gross total income? It is given here 800 lakhs. 800 lakhs into 8.5% plus 10% of aggregate average advances. How much? 300 lakhs. 300 lakhs into 10%. How much? 68 lakhs plus 30 lakhs. 98 lakhs. So, what is the entry for provision for bad debts? P&L account debit to provision for bad debts account 98 lakhs, correct? So, here you will write, ledger posting, right? By P&L account, how much you will write? 98 lakhs. P&L account debit to provision for bad. Now, how much are actual bad debts? Actual bad debts are 210 lakhs. Actual bad debts 210 lakhs. Out of 210 lakhs, how much is the provision created? How much balance is available in provision? 198 lakhs. So 198 lakhs you can adjust against provision for bad debts. 198 lakhs will be adjusted against provision for bad debts. How much is balance? 12 lakhs. Those 12 lakhs will be debited to P&L account. So what is the entry that you will write? Provision for bad debts account debit 198 lakhs, P&L account debit 12 lakhs to bad debts account. How much? 210 lakhs. This is the entry that you will pass. So, in provision for bad debts, you will write to bad debts account 198 lakhs. So, this account will close. Whatever balance 12 lakhs bad debts are there, they will be debited to P&L account. Okay. They are recognized as expenditure in P&L account. I hope now you got clarity about provision for bad debts. Are you clear? In case of foreign bank, not only foreign bank, other banks. For other banks, provision for bad debts allowed is 5% of total income. Okay, 5% of total income. Simple. Scheduled bank in India, non-scheduled Indian bank, cooperative bank. 8.5% of total income plus 10% of aggregate average advances given by rural branches. In case of other banks, maximum provision for bad debts allowed as deduction is equal to 5% of total income. Okay. Next. Transfer to specific reserve. See, in case of some financial institutions which are engaged in providing long-term finance, what do you mean by long-term finance? Let's say, Housing Development Corporation, HUDCO is there. It is engaged in the business of giving housing loans. You all know, housing loans tenure will be around 10 years, 15 years, 20 years. So when it is in the business of giving housing loans, okay, then for Housing Development Corporation, it is providing long-term finance for more than 5 years. Such type of financial institutions, they can transfer some amount to some specific reserve. Whatever the amount transferred to specific reserve is there, that is allowed as deduction under section 36, subsection 1 clause 8. Are you able to understand? Now let us see. Financial corporation engaged in providing long-term finance. Long-term finance means giving finance for more than 5 years, 5 years or more. How much reduction is allowed? Actual amount transferred to special reserve, or 20% of PGBP income, or twice, 2 times of paid up share capital plus general reserves as on the last day of previous year minus opening balance of special reserve. Whichever is lower will be allowed as deduction. I know you are not comfortable. Let us do this problem. You are going to get the clarity. Okay. Atul Housing Finance Company Limited provides you the following particulars from its accounts for the year ended 31st March 2026 and seeks your opinion. Profit from business computed as per Part D, Chapter 4 of Act, but before claiming deduction. This is nothing but PGBP income. Next, paid up share capital 500 lakhs, general reserve 100 lakhs. This is opening balance of reserve 1100 lakhs. Now, how much is the amount allowed as deduction? Amount allowed as deduction is equal to 20% of PGBP income. How much is 20% PGBP income? 560 lakhs into 20%. How much? 112 lakhs, or 2 times of share capital plus general reserves minus opening balance. Now 2 into how much is share capital plus reserves and surplus? 500 plus 100, 600 lakhs, correct? 2 into 600 lakhs minus opening balance. How much? Opening balance is 1100 lakhs. So 1200 lakhs minus 1100 lakhs, 100 lakhs. So 112 lakhs or 100 lakhs or actual contribution, actual amount transferred. Whether actual amount transferred is given in the question. Okay, actual amount was not transferred. They are asking how much amount transferred is eligible for deduction. Okay, if they transfer 100 lakhs, whichever is lower, 100 lakhs is eligible for deduction. Are you able to understand? So now you got the point. Actual amount transferred or 20% of PGBP income or 2 times of share capital plus reserves and surplus minus opening balance of the reserve. Whichever is lower will be allowed as deduction. Okay. I hope after doing the problem you got clarity. Shall I explain further? Did you understand? Any doubt is there? Next, deduction of family planning expenditure. See, once upon a time there was heavy population in India. So Indian government decided we need to reduce the population. Indian government started creating family planning awareness programs. Now Indian government asked all the company SSEs, okay, all the company SSEs to educate their employees about family planning awareness programs. Now whatever the expenditure spent for creating awareness about family planning, even though it is not business expenditure, still that expenditure is specifically allowed as deduction under section 36 subsection 1 clause 9. Are you able to understand? Next, remember, whenever you see family planning expenditure is allowed as deduction only for company SSEs. For sole proprietor, if you see family planning expenditure, disallow that expenditure because family planning expenditure is eligible for deduction only for company SSCs. Next, for creating awareness about family planning programs and all, if you incur any revenue expenditure, 100% of the revenue expenditure is allowed as deduction. But if you incur any capital expenditure, then that capital expenditure for family planning awareness programs is not allowed as deduction in a single installment. That is allowed as deduction over a period of 5 years in 5 equal installments. Are you able to understand? So very simple. Family planning expenditure allowed as deduction only for company SSCs. If it is revenue expenditure, 100% allowed in the year in which you incur. If it is capital expenditure, not allowed as deduction in a single year. It is allowed as deduction over a period of 5 years in 5 equal installments. Okay. And whatever unabsorbed family planning expenditure, yesterday we discussed unabsorbed depreciation. Just like unabsorbed depreciation, unabsorbed family planning expenditure can be carried forward and set off in subsequent years. Okay. Next, securities transaction tax. Whenever you are buying shares or securities in stock market, or whenever you are selling shares or securities in stock market, then whenever you are buying shares through broker, you are required to pay securities transaction tax. Securities transaction tax is expenditure, right? Even though securities transaction tax is expenditure. First of all, whether shares and securities, what is the nature of shares and securities? See, I am CA in practice. If I buy shares, if I buy securities, they are not stock in trade to me, they are capital asset. So if shares and securities are capital asset to me, and if I pay securities transaction tax, that securities transaction tax is not allowed as expenditure under capital gains. So held as capital asset, not allowed as deduction under capital gains. However, if my main business is buying and selling shares, shares are treated as stock in trade. Securities are treated as stock in trade. So if I hold shares and securities as stock in trade, then whatever the securities transaction tax that I have paid, that is allowed as deduction under PGBP. Are you able to understand? Next, deduction of commodities transaction tax, CTT. See, generally when you are dealing in commodity derivatives, you are required to pay commodity transaction tax. Again same, if you are holding commodity derivatives as capital asset, its commodities transaction tax paid is not allowed as deduction under capital gains. However, if you are holding commodity derivatives as your stock in trade, then commodities transaction tax is allowed as deduction under PGBP. Are you able to understand? Simple. How we are holding the capital, how we are holding the asset. If you are holding the asset as capital asset, securities transaction tax, commodities transaction tax, not allowed as deduction under capital gains. If you are holding asset as stock in trade, then securities transaction tax, commodities transaction tax, allowed as deduction under PGBP. Are you able to understand? Next, purchase of sugarcane. See, generally, government will fix price of sugarcane. If you intentionally buy sugarcane at a price more than the price fixed by government, then excess expenditure is not allowed as deduction. Are you able to understand? See, common logic. We want to claim more expenditure. If we claim more expenditure, our expenditure increases. When our expenditure increases, net profit decreases. When our net profit decreases, tax also decreases. So, general phenomenon is we always try to claim more expenditure. If we claim more expenditure, our profit decreases, our tax also decreases. Correct? Now, the thing is, government fixed price, sugarcane 100 rupees, but I claimed as expenditure 112 rupees. Whether 112 rupees is allowed, out of 112 rupees, 100 rupees is allowed. Whatever the balance 12 rupees is there, that is disallowed. That is not allowed as deduction. Are you able to understand? So whenever you pay price, cooperative society, whenever it pays price for buying sugarcane, any price paid over and above the government price, that is not allowed as deduction. Next, section 37. Section 37 we call as residuary section. Till now, we have discussed section 30 to 36 expenses. There are some expenses which are not covered under section 30 to 36. Audit fees is there, it is expenditure, but in section 30 to 36, did we see audit fees? No. Next, traveling expenses are there. In section 30 to 36, did we see traveling expenses? No. Next, printing and stationery expenses are there. In section 30 to 36, did we see printing and stationery expenses? No. So, any expenditure that is not covered under section 30 to 36, remaining all expenses are allowed as deduction under section 37. Are you able to understand? So, we call section 37 as residuary section. Any expenditure that is not allowed from section 30 to 36, remaining all expenses are allowed as deduction under section 37. But there are some conditions. See, if you write list of expenses that are not covered under section 30 to 36, so many expenses will come. In Income Tax Act, they cannot write those many expenses. That's why in section 37, they have kept some conditions. If all these conditions are satisfied, then that expenditure is allowed as deduction under section 37. What are the conditions? Expenditure should not be covered under 30 to 36. Why? Because if any expenditure is already covered under 30 to 36, as per that section, expenditure is allowed. That's why any expenditure which is not covered under 30 to 36, that expenditure will be allowed as deduction under section 37. Are you able to understand? Next, expenditure should not be incurred. Expenditure should be incurred after business was set up. What do you mean by this? Preliminary expenditure is not allowed as deduction under section 37. Why? Because for preliminary expenditure, already deduction is allowed under section 35D. Already section 35D speaks about preliminary expenditure. So that type of expenditure is not allowed as deduction under section 37. Next, personal expenses are not allowed as deduction under section 37. We are discussing from the beginning. Only business related expenditure is allowed as deduction. So personal expenditure is not allowed as deduction under section 37. Capital expenditure is not allowed as deduction under section 37. Mahadevan, under which section, sir? I did not understand your question, Mahadevan. Please ask once again. Next, expenditure should not be a penalty. It should not be a penalty. If any expenditure is penalty, then it is not allowed as expenditure under section 37. So some conditions are there. It should not be covered under 30 to 36. It should not be a preliminary expenditure. It should not be a personal expenditure. It should not be a capital expenditure. It should not be a penalty. Any expenditure that satisfies all these conditions, then that expenditure you can claim as deduction under section 37. Are you able to understand? Explanation 1 to section 37. See, penalty. Generally, why will you pay penalty? Penalty is paid for violating provisions of any act. That act can be any law. That law can be either Indian law or foreign law. Indian law or foreign law. So, for violating the law, if you pay any penalty, such penalty is not allowed as deduction. Okay, that can be either Indian law or foreign law. But there is one exception. What is that exception? Penalty in the nature of compensation. That is allowed as deduction. Okay, penalty in the nature of compensation, that is allowed as. Sir, any example? Yes, interest on late payment of GST. See, if you pay GST amount lately to GST department, you have to pay interest. Why you are paying that interest? You are paying that interest to compensate the interest cost of the government. So it is also penalty, but why government is taking that penalty? Because government wants to compensate its interest cost. So whatever the penalty paid, that is in the nature of compensation. That penalty, this interest on late payment of GST, that is allowed as deduction. Are you able to understand? Normally, penalty is not allowed as deduction. But if penalty is in the nature of compensation, that is allowed as deduction. Okay. Next, disallowance of CSR expenditure. You know, section 135 of Companies Act tells some conditions. If those conditions are satisfied, that company is required to spend some amount for corporate social responsibility. So whatever CSR expenditure is there, CSR expenditure, it is not business expenditure and it is not allowed as deduction under PGBP. Not allowed as deduction under. So very simple. Companies Act says you should spend CSR expenditure. But that CSR expenditure, income tax says it is not business expenditure, it is not allowed as deduction. So it's like you cannot escape. As per Companies Act, you have to spend CSR expenditure. Income tax says it is not business expenditure. Under income tax, CSR expenditure is disallowed. It is not allowed as deduction. Okay. Next, you can read these points. I have given explanation, you will understand. Next, expenditure incurred by SSC on advertisement in any souvenir pamphlet like published by a political party. See, you have given advertisement in political party pamphlet, political party calendar. Even though it is advertisement expenditure, it is not treated as business expenditure. You could have given advertisement in newspaper. Why did you give advertisement in political party pamphlet, political party calendar? That means indirectly you are funding political party. So whatever the political party advertisement expenditure is there, that is not business expenditure, not a business expenditure, and it is not allowed as deduction. Are you able to understand? It's not allowed as deduction. Political party advertisement. But one thing, whatever the political party advertisement expenditure is there, that you can claim as deduction under section 80 GGB in case of company. Next, some important case laws. These are very important. These are very important for PGBP adjustment. If any expenditure is incurred for bypass surgery, it is not business expenditure, it is personal expenditure of the proprietor. That is not allowed as deduction. Next, cost of production of abandoned film. It is revenue expenditure and allowed as deduction. See, one movie shooting started. In the middle of the shooting, that movie was stopped. That movie was abandoned. That movie was give up. Now, whatever the cost of production of that abandoned film is there, it is treated as revenue expenditure and it is allowed as deduction. Next, customary expenses like puja, decoration. Obviously, in every business, daily puja will be conducted. Whatever the puja expenses are there, you should not say they are not business expenditure. It is customary. Okay, Indians, like we South Indians especially, we pray to God every day. So whatever the puja expenses that are done in the business, they are also treated as business expenditure and they are allowed as deduction. Next, breach of law, penalty disallowed. Breach of contract allowed as deduction. See, you violated income tax act, you paid penalty. Penalty is not allowed as deduction. But you violated one agreement. I said I will supply 10,000 tires after 2 months. But after 2 months, I could not supply 10,000 tires. I violated the contract. I violated the agreement. For violating the contract, if I pay any liquidated damages, if I pay any penalty, that penalty is business expenditure. That penalty is allowed as deduction. So simple. Penalty for breach of law. Is it allowed as deduction? No, not allowed. Penalty for breach of contract. Is it allowed as deduction? Yes, it is allowed as deduction. As simple as that. Okay. Next, CPE seminar fees. I think you all know, you are CA final students. Every chartered accountant, especially who is in practice, they need to have credit of 40 CPE hours every year. So whatever the CPE hours fees that is paid, it is business expenditure only and it is allowed as deduction under PGBP. Next, interest on loan taken for payment of income tax. My dear students, with regard to Income Tax Act, whatever the amount that you pay, income tax, surcharge, health and education cess, interest on late payment of advance tax, 234A, 234B, 234C, whatever the penalty, whatever the amount that you pay under income tax, that is not allowed as deduction under PGBP. Not only amount paid under income tax, if you under Income Tax Act, you have to pay penalty. For paying penalty, you have taken loan. On loan taken for paying income tax related payments, if you pay any interest, that interest is also not allowed as deduction. Are you able to understand? For example, yeah, late filing fees, that is also not allowed as deduction under section 234F. For example, I need to pay income tax 8 lakh rupees. I am not having 8 lakh rupees. So what I did, I took loan. I took loan of 8 lakhs. Using that loan, I paid income tax. Now, on this loan, I have to pay interest, right? Let's say I paid interest of 40,000. Now, this interest is interest on loan taken for payment of income tax, correct? Loan taken for payment of income tax. Now, whether this interest is allowed as deduction 40,000? No, that interest will be disallowed. Are you able to understand? So, income tax related payments, tax, surcharge, health and education cess, interest, late fees, penalty, all these are disallowed under PGBP. Additionally, if you take any loan for paying this tax, surcharge and health and education cess, interest paid on such loan, that is also not allowed as deduction. That is also disallowed. Next, dividend is appropriation of profit. Dividend is not allowed as expenditure. Next, tax audit fees, litigation fees of chartered accountant. Obviously, we do tax audits in our profession. Whatever the tax audit fees paid by client to us, it is income to us and the same is expenditure to the client. Such expenditure to the client is allowed as deduction. And we go to appellate tribunal, income tax appellate tribunal to defend the case on behalf of the client. Now, whenever we go to ITET, client will pay professional fees. Whatever the professional fees paid to the chartered accountant for or cost accountant for defending the case under income tax or GST, that fees is allowed as deduction. Okay. Next, plastic surgery expenses of TV or news reader. See, TV or news readers, they should look beautifully. For looking beautifully, if they get any plastic surgery done, it is business expenditure only. Such business expenditure is allowed as deduction. Next, subscription to gym by actress. See, actor, actress, daily they need to maintain their body. For maintaining their body, if they do gym, whatever the gym expenses that they have paid, it is business expenditure and it is allowed as deduction. Okay. Next, expenditure on electricity, telephone, postage, all these are also business expenses and they are allowed as deduction. Give me 1 second. I am sorry, it's urgent call, so I attended. Next, expenditure incurred by employer on training of apprentices. See, quite often many corporate companies, they will give training to their employees. whatever the expenditure spent on giving training to employees, that is business expenditure, and it is allowed as deduction. Next, audit fees paid, obviously business expenditure. Entertainment expenses, see, Diwali comes, they will distribute sweets. New Year comes, they will distribute cakes. So whatever the entertainment expenses that are incurred in the business, they are business expenditure only and they are allowed as deduction. Okay. Next, expenditure on temple in factory for recreation of employees allowable as expenditure. What do you mean by this? See, whatever the temple construction expenses in the factory are there, the temple construction will be added as building, and for maintenance of temple, daily puja will be done, flowers are required, whatever the revenue expenses that are incurred for maintaining the temple, they are also business expenditure and they are allowed as deduction. Next, royalty. See, royalty, why will you pay? If you are using know-how, copyrights, patents, then you will pay royalty. Whatever the royalty paid, it is business expenditure, it is allowed as deduction. Next, legal expenses to defend or maintain the title, it is business expenditure only and it is allowed as deduction. Next, legal and court expenditure spent for income tax or sales tax appeals are allowed as deduction. Next, legal expenses for making agreements, various deeds, etc. are allowed as deduction. See, we will draft partnership deed. See, business people, they wanted to enter into partnership. But do they know how to draft partnership deed? No. We will draft partnership deed and we will take professional fees. So any fees paid for drafting agreements or deeds, that is business expenditure and it is allowed as deduction. Okay. Next, compensation paid to an employee for injury during the duty. See, fire accident happened. Employee got injured. He admitted in hospital. Medical expenditure is paid by employer. It is business expenditure only and it is allowed as deduction. Next, expenditure incurred on employees' welfare, that is also allowed as deduction. Last one, very very important, super point, expenditure incurred on issue of shares, debentures. See, whenever you issue shares, whenever you issue debentures, some expenditure you will incur. For example, let's say you are increasing your share capital. Whenever you are increasing your share capital, first you have to increase your authorized share capital. When you increase your authorized share capital, you will pay stamp duty to Ministry of Corporate Affairs. Whatever the stamp duty that is paid for increasing share capital, that is share capital issue expenses. Whatever the share capital issue expenses are there, they are capital in nature. They are not allowed as deduction under PGBP. Are you able to understand? Next, with regard to issue of shares, you have altered memorandum of association, you have altered articles of association. For altering MOA, AOA, if you pay any professional fees, that is also capital in nature. So very simple, for issuing share capital, if you incur any expenditure, either for altering MOA, AOA or stamp duty, whatever the expenditure that you incur for issuing share capital, those expenses are capital in nature. They are not allowed as deduction under PGBP. Okay. So these are various case laws compiled as important points. Next, section 38, proportionate expenditure. You all know business expenditure, like any expenditure that is incurred partly for business purpose, partly for personal purpose. Only business related expenditure is allowed as deduction. Personal expenditure is not allowed as deduction. Correct? So that's all about section 38. So with this, we are done with expenditure part. So are you clear till here? Next, section 40 series are there, very very important. 40A1, 40A1A. Shall we continue with section 40 series or do you want break? Yes, we can continue. 40A1. Section 40A1, very simple. Payer, payee. Payer, any person who is required to deduct TDS. You have studied TDS provisions, right? So, any person who is required to deduct TDS is payer. Payee can be either non-resident or foreign company or person outside India. So, whenever payer is making payment to payee, payer making payment to payee, then two conditions are there. Condition 1, condition 2. See, there are TDS provisions. As per TDS provisions, when you are making payment to either non-resident or when you are making payment to foreign company or when you are making payment to person outside India, mandatorily you are required to deduct TDS. Condition 1, deduct TDS. What is due date? Due date for deduction of TDS is before end of previous year. Condition 2, deducted TDS. Let's say I paid 10 lakh rupees royalty to non-resident. On payment of 10 lakh rupees royalty under section 195, I am required to deduct TDS. I deducted 2 lakh rupees as TDS. Now whatever 2 lakh rupees that I deducted as TDS, I should not use those 2 lakhs for my personal purposes. Whatever 2 lakhs TDS that is deducted, that should be deposited to government. So deducted TDS should be deposited to government. For depositing that amount to government, what is due date? Due date is before ITR due date under section 139(1). Conjunction is and. That means you have to satisfy both the conditions. You have to deduct TDS before end of previous year. Condition 2, deducted TDS is to be deposited to government before ITR due date. Only if condition 1 and condition 2 are satisfied, then only 100% expense is allowed as deduction. Are you able to understand? If condition 1 is not satisfied or condition 2 is not satisfied or condition 1 and condition 2 is not satisfied, in these three cases 100% expenditure is disallowed. 100% expenditure is disallowed. Are you able to understand? That means what? You have to deduct TDS before end of previous year. Deducted TDS you have to deposit to government before ITR due date. Only when both these conditions are satisfied, 100% expenditure is allowed. Otherwise, 100% expenditure is disallowed in current previous year. Sir, is it disallowed forever? No, it is not disallowed forever. In future, whenever C1 and C2 are satisfied, in that year, again they are allowed as deduction. Again allowed as. Okay, let's say payment is relating to 24-25. Condition 1 not satisfied, condition 2 satisfied. Then will it be allowed as deduction in 24-25? Condition 1 not satisfied, not allowed in 24-25. But condition 1 and condition 2 are satisfied in 25-26. So in 25-26 they are allowed as deduction. Are you able to understand? Very simple. Payer is any person who is required to deduct TDS. Payee can be non-resident, foreign company or person outside India. Whenever you are making payment, on that payment, condition 1, you should deduct TDS. What is due date for deduction? Before end of previous year. Condition 2, after deducting TDS, you should deposit the TDS to government. What is due date? Before ITR due date. Whenever you satisfy both these conditions, 100% expenditure is allowed. Otherwise, 100% expenditure is disallowed in current year. It is not disallowed forever. In future, whenever both the conditions are satisfied, in that year, again that expenditure is allowed as deduction. Okay. I hope you are clear. Next, 40A1A. See, 40A1A same. 40A1 payment to non-resident foreign company person outside India. 40A1A speaks about payment to resident in India. In 40A1, if condition 1 is not satisfied or condition 2 is not satisfied or both condition 1 and condition 2 are not satisfied, 100% is disallowed, correct? But under 40A1A, if condition 1 is not satisfied or condition 2 is not satisfied or condition 1 and condition 2 are not satisfied, then 30% expenditure is disallowed. Are you able to understand? So that is the difference. 40A1A, payer is any person who is required to deduct TDS. Payee should be resident in India. For example, my client, he is Indian company. He is making audit fees to me. I am resident in India. Whenever he is paying audit fees, he is required to deduct TDS. If he do not deduct TDS or he deducted TDS but he did not deposit TDS, in that case 30% of audit fees is disallowed to my client. Are you able to understand? So whenever any payment is made to resident in India, again two conditions: deduct TDS before end of previous year, deposit TDS before ITR due date. If both these conditions are satisfied, 100% expenditure is allowed. Otherwise, 30% expenditure is disallowed. Are you able to understand? So in non-resident case, 100% expenditure disallowed. In resident case, 30% of expenditure is disallowed. Are you able to understand? Bonus shares issue expenses, they are treated as revenue expenditure allowed as deduction, because in case of issue of bonus shares, there is no inflow of cash. If there is no inflow of cash, then it is not treated as capital expenditure. There is no increase in share capital now in case of bonus shares. So if any expenditure is incurred for issuing bonus shares, it is revenue expenditure. I hope you understood 40A1 and 40A1A. Shall we see remaining post lunch at 2:30 p.m.? So yes, students, in last class we finished 40A1, 40A1A. Now let us start with 40A clause 2. Very simple. Whatever the payment that you pay under Income Tax Act, those expenses are not eligible for deduction under PGBP. So like under income tax, if you pay income tax, surcharge, health and education cess, penalty, late fees, all these are not allowed as deduction under section 37. Not only that, if you, for paying these amounts, if you take any loan, whatever the interest that is paid on loan is there, that interest is also not allowed as deduction under section under PGBP. Are you able to understand? So like very simple, income tax related payments are not allowed as deduction under PGBP, whether it is income tax liability, surcharge, health and education cess, penalty, late fees, interest on late payment of advance tax, all these amounts which you pay under income tax not eligible for deduction. For paying these amounts, if you take any loan, whatever the interest paid on such loan is there, even that interest is also not allowed as deduction under PGBP. Next, 40A clause 2B. See, state government undertaking, if it pays any payment to state government, any payment made by state government undertaking to state government, whatever the nomenclature, you tell the payment is service fees, you tell the payment is royalty, you tell the payment is fees, whatever the payment that is paid by state government undertaking to state government is there, that is not allowed as deduction under PGBP. Are you able to understand? See, normally what is happening, let's say Road Transport Corporation is there, RTC, RTC P&L account. Let's say RTC revenue is 800 crores. RTC expenses are 650 crores. Now there is net profit 150 crores. On 150 crores, RTC is required to pay tax, right? So RTC is state government undertaking. RTC is required to pay tax. Whenever tax is paid, amount will go to central government. So what state government undertakings are doing? They are writing royalty to state government 150 crores. And thereby they are making their net profit as 0. Are you able to understand? So it has become a loophole. Whatever the net profit of state government undertaking is there, they are transferring that net profit to state government. Thereby they are making their net profit as 0 and they are not paying income tax. So to prevent such loop, okay, to stop such kind of activities by state government undertaking, what provision was written? If any payment is made by state government undertaking to state government, that amount is not allowed as deduction under PGBP. Are you able to understand? I hope you understood the logic. What is provision? Any amount paid by state government undertaking to state government, that amount is not allowed as deduction. Any amount, you name it, royalty, fees, service charges, whatever the nomenclature you use, that amount is not eligible for deduction. Okay. Next, 40A clause 3. Any salary payable outside India to a non-resident shall be disallowed if tax has not been deducted or paid. What do you mean by this? Let's say there is payer, payer is employer. There is payee, payee is non-resident employee. So, whenever employer pays salary to employee, so whenever salary is paid to non-resident employee, two conditions are required to be satisfied. Condition 1, TDS is required to be deducted. Okay. Due date is before end of previous year. Condition 2, deducted TDS is to be deposited to government. What is due date? ITR due date. Before ITR due date, you have to deposit TDS to government. So, what is the conjunction? And only if both conditions are satisfied, condition 1 and condition 2 satisfied, 100% expenditure is allowed as deduction. Are you able to understand? If condition 1 is not satisfied, or if condition 2 is not satisfied, or if condition 1 and condition 2 is not satisfied, then 100% expenditure, 100% salary is forever disallowed. Very, very important. Forever disallowed. That means in future, whenever both the conditions are satisfied, can you claim salary paid to non-resident as deduction? You cannot claim. Are you able to understand? Under 40A1, 40A1A, it is not forever disallowed. Whenever in future both the conditions are satisfied, in that year it is allowed as deduction. But under section 40A clause 3, whenever you are making salary payment to non-resident, you should deduct TDS, you should deposit TDS to government. If you fail, like both the conditions are to be satisfied, then only 100% salary paid to non-resident is allowed as deduction. If condition 1 is not satisfied or condition 2 is not satisfied, or if both conditions are not satisfied, in that case 100% salary paid to non-resident is forever disallowed. Very strict provision, because you are making payment to non-resident, mandatorily you should deduct TDS, you should deposit deducted TDS to government. Otherwise, salary paid to non-resident not allowed as deduction. Are you able to understand? Yeah. ITR due date under section 139(1). Okay. Next, 40A4, any contribution to provident fund or fund established for the benefit of employees of the SSC unless SSC has made effective arrangements to make TDS from payments made from the fund which are chargeable to tax under the head salaries. See, there is one section called section 192A. Whenever you withdraw money from provident fund, if you withdraw money from provident fund after 5 years of service, such withdrawal is not taxable. But if you withdraw money from provident fund before completion of 5 years of service, then like at the time of withdrawal, 10% TDS will be deducted if the amount of withdrawal is 50,000 or more. So like provident fund authorities, before they give money to the employee, they need to mandatorily deduct TDS at the rate of 10% if withdrawal is more than 50,000. If provident fund authorities forget or if they fail to deduct TDS, then whatever the amount paid to employee is there, that is not allowed as deduction to provident fund authorities. So very simple, PF authorities before giving provident fund money to employee, PF authorities should ensure TDS is deducted under 192A and TDS is deposited to government. If they fail to deduct TDS, then whatever the amount paid to employee, that is not allowed as deduction to the provident fund authorities. Are you able to understand? Next. Tax on non-monetary benefits paid by employer on behalf of employee. What do you mean by this? Let's say there is employer, there is employee. Employee is getting salary 8 lakhs. Employee is getting perquisites, non-monetary perquisites, rent-free accommodation, car facility, education facility of children paid by employer. Perquisites are 4 lakhs. Let's say tax on 8 lakhs is 2 lakhs. Tax on 4 lakhs is 1 lakh. This is example. Now don't calculate and tell, sir, you are wrong. I took estimated amount. On 8 lakhs, for example, tax is 2 lakhs. On 4 lakhs, tax is 1 lakh. Now the point is, employee told to employer, sir, you are giving me 8 lakhs cash. From that 8 lakhs cash, if you want me to pay tax, I am happy to pay tax. You are also giving me rent-free accommodation, car facility, education facility, medical facility worth 4 lakhs. On 4 lakhs, income tax department is asking me to pay tax of 1 lakh. Employee said, I cannot pay tax 1 lakh rupees on 4 lakh rupees perquisites. Then employer said he will pay tax of rupees 1 lakh. So here employee is getting 3 benefits. He is getting salary benefit 1 8 lakhs. He is getting perquisites worth 4 lakhs benefit 2, and whatever the tax on perquisites is there, that is also paid by employer. If tax on perquisite is paid by employer, that is also benefit received by employee, right? That is third benefit. Okay. So now the point is tax on non-monetary perquisites paid by employer. So this is expenditure to employer and income to employee. Income to employee. Whatever expenditure to employer is there, that is not allowed as deduction. Whatever income to employee is there, that is exempt under section 1010C. Are you able to understand? The tax on non-monetary benefits, actually employee has to pay, but if that burden is paid by employer, it is expenditure to employer and such expenditure is not allowed as deduction to employer, and benefit received by employee, it is not taxable to employee. So did you understand? Next, assessment of partnership form. Section 40B. See, there is partnership form and there are partners. If partnership firm pays share of profit to partner, share of profit is exempt in the hands of partner. Exempt to partner. Because see, already partnership firm had paid 30% tax along with health and education cess. After payment of tax, whatever the balance profits are there, balance profits are distributed to partners. Now balance profits are again not taxable in the hands of partners because already partnership firm had paid the tax liability. Are you able to understand? Now, if partnership firm pays remuneration, salary, bonus, commission or interest on partner's capital or loan. Partner's capital or loan. So all these, whatever the amount, salary, interest, bonus, commission allowed as deduction to partnership firm is there, the same amount is taxable to partners under PGBP. What do you mean by this? For example, let's say bonus paid to partners. Whatever bonus, salary, commission that is paid is 80 lakh rupees. But as per PGBP provisions, as per section 40B, only 60 lakhs is allowed as deduction to partnership firm. Now, how much is taxable in the hands of partners? Taxable in the hands of partners is 60 lakh rupees. Are you able to understand? See, partners are getting 80 lakhs. But whether 80 lakhs is taxable in the hands of partners? No. As per PGBP provisions, for partnership firm, only 60,000 is allowed as expenditure. Sorry, only 60 lakhs is allowed as expenditure. Whatever the amount allowed as expenditure to partnership firm is there, same amount is taxable in the hands of partners under the head PGBP. Are you able to understand? So, share of profit received from partnership firm, fully exempt. Interest received, salary, bonus, commission, remuneration, these are received. Whatever the salary received, total salary is not taxable. Out of total salary received, whatever the salary allowed as expenditure to partnership firm is there, only that salary amount is taxable to the partner under the head PGBP. Are you able to understand? I hope it made sense to you. Next, see, for allowing interest, for allowance of interest, interest on partner's capital or partner's loan, some conditions are required to be satisfied. Then only interest on partner's capital is allowed as deduction. Otherwise, interest on partner's capital is not allowed as deduction. What are those conditions? Condition 1, interest should be authorized by partnership deed. That means only if partnership deed authorizes payment of interest on partner's capital, then only interest on partner's capital is allowed as expenditure. Otherwise, interest on partner's capital is not allowed as expenditure, not allowed as deduction. Next, interest on partner's capital is allowed as deduction on prospective basis. What do you mean by prospective basis? Prospective basis means from the date of change. Let's say I started partnership firm on 1st April 24. I have written partnership deed. In that partnership deed, there is no interest clause. There is no interest on partners clause. Okay. However, I came to know if there is no interest on partners capital clause, interest is not allowed as deduction under PGBP. So what I have done on 1st July 2024, I amended partnership deed. I amended partnership deed with effect from 1st April 24 and I have written interest on partners capital is 10%. I have written in partnership deed interest on partners capital is 10%. Now, how I am doing the amendment? I am doing the amendment with effect from 1st April 2024. Here I am doing the amendment retrospectively. Even though I do amendment retrospectively, whatever the interest for 1st April 24 to 1st July 24 is there, that interest is not allowed as deduction. When I made the change on 1st July 24. So from 1st July 24, whatever the interest is there, only that interest will be allowed as deduction under Income Tax Act. Are you able to understand? So interest on partner's capital, even though you make amendment retrospectively, under income tax it is not allowed as deduction on retrospective basis. Under income tax it is allowed as deduction on prospective basis. Are you able to understand? So condition 1, only if interest is authorized by partnership deed, then only interest is allowed as deduction. Condition 2, interest is allowed as deduction on prospective basis. Condition 3, whether you pay interest to sleeping partner or working partner, that interest is allowed as deduction. You can pay interest to either working partner or sleeping partner. Any interest paid to any partner is allowed as expenditure. Condition 4, maximum interest allowed. Maximum interest allowed is 12% simple interest. Are you able to understand? That is condition number 4. So we can tell maximum interest allowed is equal to actual interest paid or interest authorized by partnership deed, interest as per partnership deed, or 12% simple interest, whichever is lower. Let's say partnership deed authorized 14% interest. Partnership deed authorized 14% interest. Actual interest paid is 9%. Maximum interest allowed is 12%. Out of these three, whichever is lower means 12% interest is allowed as deduction. Are you able to understand? So that's the point. Maximum interest allowed as deduction is 12% simple interest. Next, for allowance of remuneration. Allowance of remuneration, or you can call it as salary or bonus or commission. For allowance of remuneration, salary, bonus, commission, again 4 conditions are required to be satisfied. What are they? Condition 1, same, authorized by partnership deed. That means what? Only if partnership deed authorizes payment of remuneration to partners, then only remuneration paid to partners is allowed as expenditure to partnership firm under PGBP. Otherwise, remuneration paid to partners is not allowed as deduction. Condition 2, prospective basis. That means remuneration to partners is allowed as deduction only on prospective basis. See, you have amended partnership deed. Even though you amended on retrospective basis, still remuneration is not allowed as deduction on retrospective basis. Remuneration to partners is allowed as deduction only on prospective basis. The date on which you made the change, from that date whatever the remuneration is there, only that remuneration is allowed as deduction. Next, condition 3, remuneration paid to sleeping partner is not allowed as deduction. Remuneration paid to sleeping partner not allowed as deduction. Okay. That means only if remuneration is paid to working partner, then only remuneration is allowed as deduction. Condition 4, remuneration allowed subject to book profits. Subject to book profits. What do you mean by this book profits? Open the material. You can see book profits. If book profits are up to 6 lakh rupees, then maximum remuneration allowed is 3 lakhs or 90% of book profit, whichever is higher. If on balance book profits, 60% of book profit. Are you able to understand? That means what? Let's say book profits are 15 lakhs. Now, up to 6 lakhs. What is the formula? 90% of 6 lakhs or 3 lakhs, whichever is higher. 6 lakh into 90%, how much? 5 lakh 40,000. 5 lakh 40,000 plus 60% of balance book profits. How much are balance book profits? 9 lakhs. 9 lakhs into 60%. Hey, strange. Same 5,40,000. Total 10,80,000. So this is remuneration based on book profits. Now did you understand how to calculate remuneration based on book profits? If there are no book profits, then remuneration allowed is 3 lakh rupees. If there are book profits, if book profits are up to 6 lakhs, then 90% of 6 lakhs or 3 lakhs, whichever is higher. If book profits are more than 6 lakhs, up to 6 lakhs, you already know, on balance book profits, you have to take 60% of book profits. Are you able to understand? So, we can write one formula. Remuneration to partners allowed as deduction under PGBP. How much is allowed? Actual remuneration paid to working partners. Actual remuneration paid to working partners or remuneration based on book profits, whichever is lower. Remuneration based on book profits, whichever is lower. That is allowed as deduction. So what you have to do? You have to calculate remuneration based on book profits. Remuneration based on book profits or actual remuneration paid to working partners. Very, very important, because if remuneration is paid to sleeping partners, that is not allowed as deduction. So remuneration paid to working partners or remuneration based on book profits, whichever is lower will be allowed as deduction. Okay. So did you understand section 40B? Next, shall we discuss 40A2? Everybody, please respond. Now, 40A2. What 40A2 says? 40A2 says that whenever you are dealing with related party, whenever you are dealing with close associate, you will make payment to related party, you will make payment to close associate. Whatever the payment that you paid, that is not allowed as deduction. Whatever the payment that you have made, that will be compared with fair market value. If you make any payment over and above fair market value, that excess payment is not allowed as deduction under 40A2. So 40A2 says that excess payment or unreasonable payment made to relative or close associate is not allowed as deduction. Okay. So whenever you make excess payment to or unreasonable payment to relative or close associate, that is not allowed as deduction. Are you able to understand? For example, holding company is there, subsidiary company is there. Holding company sold goods to subsidiary company. Fair market value 50 lakhs. But subsidiary company paid actual consideration 70 lakhs. That means both are related parties, na? Holding company, subsidiary company. Now, ideally, subsidiary company should pay only 50 lakhs, which is fair market value. However, subsidiary company is paying 70 lakhs. That means why subsidiary company is paying extra 20 lakhs? Because holding company is related party. Now, how much excess payment was done? Excess payment made is 20 lakhs. That excess payment is not allowed as deduction as per 40A2. Are you able to understand? So, whenever in business you are making payment to your related party or you are making payment to your close associate, excess payment is not allowed as deduction under section 40A2. Are you able to understand? Good. Now, entire discussion is who is called as relative, who is called as close associate. Now, see, I have written specified person. So, any payment made to specified person is not allowed as deduction. In case of individual, who is called as specified person? In case of individual, who is called as specified person? Answer is, in case of individual, relative is specified person. That means if an individual makes excess payment to relative, excess payment to relative is not allowed as deduction to individual. Now the question is, who is called as a relative? Relative means individual, relative means spouse, brother, sister, lineal ascendant, lineal descendant. These are treated as relative. Lineal ascendant means 3 generations upwards. Mother, father, grandmother, grandfather, great grandmother, great grandfather. Lineal descendant means 3 generations downwards. Son or daughter, grandson or granddaughter, great grandson or great granddaughter. They are treated as relative. So if any payment is made to relative, such excess payment in the business, it is not allowed as deduction. Okay. Not only relative, if any payment is made to any business or profession in which either individual or relative of individual is having substantial interest, You know substantial interest, right? Substantial interest means greater than or equal to 20% shareholding or greater than or equal to 20% profit sharing ratio, that we call as substantial interest. Now, I will tell one example, you will easily understand. Let's say there are two persons, Rahul and Sita. Both are husband and wife. Now, Rahul is into event management business. Sita has one boutique. In this boutique, Sita is having 40% share, Geeta is having 60% share. That means, can I tell Sita is having substantial interest in boutique? Yes. Sita is holding 40% profit share. So, Sita is holding substantial interest in boutique. Now, this boutique provided beauty services for event management business. Okay. Now, let's say fair market value. Fair market value is 70,000, but amount paid is 85,000. That means here Rahul is sole proprietor of event management business. Rahul is making payment to boutique, and in that boutique Rahul's wife is having substantial interest. Not only payment made to Rahul's wife, if any payment is made to any business in which Rahul's wife is having substantial interest, even this boutique is also treated as specified person. Are you able to understand? And whatever the excess payment made is there, how much is excess payment made? Excess payment made is 15,000, that is not allowed as deduction. Are you able to understand? I hope now you got clarity. Any payment made to relative, not only to relative, any payment made to any other business or profession in which either individual or individual's relative is having substantial interest, for that business also, if you make excess payment, that excess payment is not allowed as deduction. Are you able to understand? I hope you got clarity. Next, in case of company, who is called as specified person? In case of company, obviously director is specified person. Any payment, excess payment made to director not allowed as deduction. Not only director, relative of director is also treated as specified person. Not only director or relative of director, any other business or profession in which company or director or relative of director is having substantial interest. Relative of director having substantial interest. Even that is also treated as specified person. My dear students, you need not worry. Whatever the running notes that I am writing, even this running notes also I will share with you. Not a problem at all. Okay. So any excess payment made to director, any excess payment made to relative of the director, or any excess payment made to either any business or profession in which either company or director or relative of director is having substantial interest. Okay. All these are treated as specified person. For these specified persons, if any excess payment is made, that excess payment is not allowed as deduction. In case of partnership firm, who is called as specified person? In case of partnership firm, partner is treated as specified person. Not only partner, relative of partner is also treated as specified person. Not only relative of partner, any other business or profession in which either partnership firm or partner or relative of partner. Partnership firm or partner or relative of partner is having substantial interest. So if partnership firm pays excess payment to partner, not allowed as deduction. Any excess payment to relative of the partner, not allowed as deduction. If any excess payment is made to any business or any profession in which either this partnership firm or partner or relative of the partner is having substantial interest, for that business also if any excess payment is made, that is not allowed as deduction. Okay. So this is all about 40A2. Next, shall I discuss 40A3? A3. Oh, PGBP. It's like ocean. How much we discuss, it will never end. Next, 40A3. Per person per day. You should not make payment of more than 10,000 in cash. More than 10,000 cash payment you should not do. Okay. If you are making payment for transport operators, transporters, for transporters, you should not make cash payment of more than 35,000. Okay. See, generally in business, you will pay for expenses. Whenever you are paying for expenses, per person per day, you should not make cash payment of expenditure more than 10,000 rupees. However, if nature of expenditure is transportation charges, if you are making payment to transporter, up to 35,000 you can make payment in cash. More than 35,000, if you make payment in cash, 100% of the expenditure is disallowed. Are you able to understand? So, for transport payments more than 35,000, you should not make cash payment. For other payments more than 10,000, you should not make cash payment. If you make cash payment, 100% of the expenditure is disallowed. Under 40A2, excess payment is disallowed. Under 40A3, 100% of the expenditure is disallowed. Are you able to understand? But there are some exceptions. In certain cases, 40A3 provisions are not applicable. What are they? Whenever you make payment to RBI, cooperative banks, Primary Agricultural Credit Society, SBI, LIC, SBI and its subsidiaries. So whenever you are making payment to bank, 40A3 provisions are not applicable. I took loan of 10 lakhs. I need to pay interest of 80,000. 80,000 interest I paid it to bank in cash. Even though I pay interest in cash to the bank, that is not allowed as deduction. Are you able to understand? Because whenever you are making payment to bank, LIC, State Bank of India or its subsidiaries, 40A3 provisions are not applicable. You can make cash payment of more than 10,000 rupees. Next. When payment is made to government, let's say you paid municipal taxes, 30,000 municipal taxes you paid in cash. Still those municipal taxes are allowed as expenditure. Whenever you are making payment to government, you can make cash payment. Okay, you can make cash payment of more than 10,000 because 40A3 provisions are not applicable. Next, whenever you make payment by way of book adjustment. Book adjustment means what? You will not make payment. You will adjust debtor or creditor by adjusting books, by adjusting debtor's ledger. If you make any payment by way of book adjustment, then also 40A3 provisions are not applicable. Next, whenever you make payment for purchase of agricultural produce or forest produce or fish or fish related products or purchase of horticulture products or apiculture products, then 40A3 provisions are not applicable. Let's say I am purchasing agricultural produce, paddy. I purchased 100 bags of paddy. Each bag 1,000 rupees. Now I have to pay 1 lakh to the farmer. I paid 1 lakh cash to the farmer. 1 lakh is allowed as expenditure. So because 40A3 provisions are not applicable whenever you are making payment for agricultural produce or fish or fish related products. Whenever you buy these products, 40A3 provisions are not applicable. Next, where any payment is made for purchase of products that are manufactured without aid of power. What do you mean by this? Like let's say you purchased handicrafts. Whenever you are buying handicrafts, 40A3 provisions are not applicable. You are buying handicrafts, handlooms, 40A3 provisions not applicable. You can make cash payment of more than 10,000. Still that handicrafts expenditure, handlooms expenditure is allowed as deduction. Next, the day on which you are making the payment, on the day banking services are not available. You have to prove to income tax department. If banking services are not available, then you can make cash payment of more than 10,000 and it is allowed as expenditure. Are you able to understand? Next, where you are making payment of salary to an employee. See, your employee is not working in office. Your employee is working in remote location and he is working in remote location for more than 15 days. 15 days or more than 15 days. For that employee, even if you make salary in cash payment, that is allowed as expenditure. Are you able to understand? So, the point is you are making salary payment to employee and that employee is staying in remote location, not in your place of business. And in remote location, employee is staying for 15 days or more than 15 days. For such type of employee, even though you pay salary in cash, 40A3 provisions are not applicable. Are you able to understand? Next, where payment is made by an authorized dealer. You know authorized dealer, right? In financial management, SFM, AFM, Advanced Financial Management, your faculty would have told you. Like whatever the amount you pay to authorized dealer. Authorized dealer, you will buy foreign currency or you will sell Indian currency, you will sell foreign currency. So whenever you are buying foreign currency, you will make payment in Indian rupees. Whenever you are making payment in Indian rupees, even though you make cash payment of more than 10,000 rupees, 40A3 provisions are not applicable. That amount is allowed as deduction. Are you able to understand? So any payment made to authorized dealer, 40A3 provisions are not applicable. Okay. Next. Next 40A7. Under income tax, if you create any provision, provisions are not allowed as deduction. You created provision for loss of subsidiary, you created provision for gratuity, provision for retirement benefits, whatever the provisions that you create in accounts, those provisions are not allowed as deduction under Income Tax Act. Are you able to understand? So otherwise, whatever the net profit is there, total net profit will be transferred to reserve as a provision. Okay, and they will claim it as deduction. They will not pay taxes. Provision means what? It is not actual liability, it is expected liability. For expected liability, if you create provision today, you can create as per accounting standards, but as per Income Tax Act, if you create any provision, that provision is not allowed as deduction. Are you able to understand? Another important point, in this year you have paid gratuity. Whenever you actually pay gratuity, then gratuity is allowed as deduction. But if you create provision for gratuity is not allowed as deduction. For example, in 24-25, employee retired, you need to pay gratuity of 40 lakhs, but 40 lakhs is paid in 25-26. For this 40 lakhs, you have created provision in 24-25. Whether that provision is allowed as deduction? Yes, that provision is allowed as deduction. Are you able to understand? That means what? Whenever the liability to pay gratuity arises, in that year if you create provision, allowed as deduction. Or you actually paid gratuity, that is also allowed as deduction. For gratuity that is payable after 10 years, if you create provision today, that gratuity is not allowed as deduction. Okay, I hope you understood. Once read this, you will get clarity. Now let's take break of 10 minutes. Now let us start discussing section 43B. See, in section 43B, there are 6 payments. How many payments? 6 payments. These 6 payments, if you pay in current previous year, allowed as deduction in current previous year. But these 6 payments, if you pay in next financial year, immediately next financial year, then if they are paid before ITR due date, under section 139(1), then they are allowed as deduction in current previous year. If they are paid after ITR due date under section 139(1), allowed as deduction on cash basis. For example, these six payments are relating to previous year 24-25. As they are relating to 24-25, if they are paid in 24-25, then they are allowed as deduction. Deduction also allowed in 24-25. Okay, but they are not paid in 24-25. They are paid in 25-26. Now you have to check ITR due date. Generally ITR due date will be 31st July or 31st October. 31st July or 31st October. So 31st July 2025 or 31st October 2025. If they are paid before 31st July 2025 or 31st October 25, then deduction allowed in 24-25. Allowed in previous year 24-25. But if they are paid after 31st July 25 or 31st October 25, then allowed as deduction on cash basis. In which year they are paid? They are paid in 25-26, allowed as deduction in 25-26. If they are paid in 26-27, allowed as deduction in 26-27. If they are paid in 28-29, allowed as deduction in 28-29. So strictly allowed as deduction on cash basis. Whenever those six payments are paid after ITR due date in that particular previous year, allowed as deduction on cash basis. Okay, I hope your doubt is cleared. Now let us see what are those six payments. Any amount payable to government by way of tax, duty, cess, whatever name called. See, whatever the amount as per law that you are required to pay to government is there, that amount is allowed as deduction as per 43B. Okay. Let's say you are required to pay GST payment, you are required to pay municipal taxes, you are required to pay profession tax. All these payments you are paying as per law. So as per law, whatever the amount that you are payable to government is there, that amount is allowed as deduction as per 43B. Next, employer contribution to gratuity. See, morning we have discussed, employer will contribute to recognized provident fund, employee will also contribute to recognized provident fund. Morning we have discussed employee contribution to provident fund, first recognized as income, later on allowed as expenditure only if it is deposited before ITR due date. Sorry, only if it is deposited before EPF due date. If it is not deposited before EPF due date, then it is not allowed as expenditure. Now, employer contribution. Morning we have discussed it na, employee contribution. I think first concept that only we have discussed. So you can see employee contribution to provident fund. First it is recognized as income, later on it is allowed as expenditure. That is in case of employee contribution. Okay. Now employer contribution is allowed as deduction as per section 43B. That means whatever employer contribution is there, if employer contribution is paid by employer in current previous year, allowed as expenditure to employer in current previous year. If employer contribution is not paid in current previous year but is paid in next year, next financial year, then you have to check whether it is paid before ITR due date or not. If it is paid before ITR due date, allowed as deduction in current previous year only, otherwise allowed as deduction on cash basis. So allowed as deduction as per section 43B. So did you understand? Now, third payment, bonus or commission for services rendered payable to employees. So, like I already told you when we are discussing section 36, bonus or commission is allowed as deduction as per 43B. If bonus is really paid in current year, allowed as deduction. If bonus is paid in immediately next financial year, if it is paid before ITR due date, allowed as deduction in current year, otherwise allowed as deduction on cash basis. Next, whenever you take a loan from public financial institution, state financial corporation, yeah, one doubt here is, but the same is not applicable for employee contribution. Yes, only for employer contribution 43B is applicable. For employee contribution 43B is not applicable. Employee contribution first recognized as income. Deposit money before EPF due date, claim expenditure. If you don't deposit before a EPF due date, not allowed as deduction. But employer contribution, you have time. Before ITR due date, you can deposit and you can claim it as expenditure as per 43B. Okay. Now, whenever you take loan either from public financial institution, state financial corporation, state industrial investment corporation, scheduled bank, cooperative bank, NBFC. So from these 5 persons, public financial institution, state financial corporation, state industrial investment corporation, cooperative bank, NBFC. From these 5 persons, if you take any loan, on that loan you are required to pay interest, right? That interest is allowed as deduction as per section 43B. Are you able to understand? So whenever you take term loan from bank, you have to pay interest. If you pay interest in current year, allowed as deduction in current year. If you pay interest in next year, if it is paid before ITR due date, allowed as deduction in current year, otherwise allowed as deduction on cash basis. Next, leave encashment, fifth one. Leave encashment is expenditure to employer. That expenditure is allowed as deduction as per 43B. Last one is any sum payable to Indian Railways. See, whatever the amount that you are liable to pay Indian Railways, you can see in railway station, in railway platform, there are many stalls available. Okay, if you make any payment, so now all railway stalls, they are required to pay rent to Indian Railways. Whatever the rent payable by stall on the platform to Indian Railways is there, that rental expenditure is allowed as deduction as per 43B. So whenever you are required to make payment to Indian Railways, such payment is eligible for deduction as per 43B. Okay. So total 6 payments. These 6 payments, if you pay in current year, allowed as deduction in current year. If you do not pay in current year, if you pay in the immediately next financial year, if you pay before ITR due date, allowed as deduction in current year, otherwise allowed as deduction on. Next, 43BH, recently introduced, very important. There is supplier, there is also buyer. Supplier sold goods or provided services to buyer on credit basis. Sold goods or provided services to buyer on credit basis. Let's say supplier is micro enterprise or small enterprise as per MSME Act. See, if goods are sold on cash basis, no problem at all. Whenever goods are sold on credit basis, then only 43B is applicable. If amount is paid, no problem. Whenever amount is not paid, then only 43B gets attracted. Correct? Now, there is agreement. In between supplier and buyer, agreement is there. As per agreement, credit period is 60 days. How much is credit period? 60 days. But as per Income Tax Act, maximum credit period allowed is only 45 days. Okay. So as per Income Tax Act, max credit period is 45 days. So For example, that means what? Due date is equal to credit period as per the agreement. How much is credit period as per the agreement? 60 days. Or maximum period allowed as per Income Tax Act, 45 days. Whichever is lower means 45 days. Are you able to understand? That means what? Even though agreement states credit period of more than 45 days, as per Income Tax Act, maximum credit period allowed is 45 days. So due date is equal to credit period as per the agreement or 45 days, whichever is earlier. Within those 45 days, buyer has to make payment. Then only that expenditure is allowed as deduction on accrual basis. Otherwise, that expenditure is allowed as deduction on cash basis. Are you able to understand? That the thing is, for example, if paid, here two options will arise. If paid within due date, allowed as deduction on accrual basis. If paid after due date, allowed as deduction on cash basis. So did you understand? Now, there is seller. Example, there is buyer. Sold goods on 17th March 2025. Credit period is 30 days. Now, what is due date? Due date is 30 days as per agreement or agreed credit period. Okay. 30 days agreed credit period or 45 days, whichever is lower. That means due date, like maximum credit period available is 30 days. That means what is due date? 31 minus 17, 14. 16th April. 16th April 2025 is due date. Correct? Now, if buyer pays on 10th April 25, that means it is before 16th April 2025, right? Before 16th April 25. Then allowed as deduction on accrual basis. Allowed as deduction in previous year 24-25. Are you able to understand? See, paid on 16th April 25. 16th April 25 falls in 25-26. Even though it is paid in 25-26, as it is paid before due date, before 30 days, allowed as deduction on accrual basis in 24-25. Are you able to understand? Next. If buyer pays on 20 April 25. 20 April 25 means before due date or after due date? After 16 April 25. Then it is allowed as deduction on cash basis. Allowed as deduction on cash basis. Here ITR due date, that concept is not applicable. Allowed as deduction purely on cash basis. Okay. Here you will get doubt. Sir, it is paid on 20th April only. 20th April means before ITR due date. Can we claim it as deduction in 24-25? No, they will not allow in 24-25. Purely allowed as deduction on cash basis. In 25-26, it is allowed as deduction. In 24-25, it is not allowed as deduction. I hope you got enough clarity. So whenever you are required to make payment to micro enterprise or small enterprise, what is due date? Credit period as per the agreement or 45 days, whichever is earlier. Within that date, if you make payment, allowed as deduction on accrual basis. Otherwise, allowed as deduction on cash basis. Are you able to understand? Now, some students will get doubt. Sir, if there is agreement na, then agreed period or 45 days, whichever is lower. What if there is no agreement? If there is no agreement, then credit period allowed is equal to 15 days. Credit period allowed is equal to 15. Okay, did you understand? Very important recent amendment. I think in Finance Act 2023, this 43BH concept is introduced. Questions will be asked on this point in the examination. Prepare carefully. If the agreement says 15 days credit period, then 15 days or 45 days, whichever is earlier, due date is 15 days only. The important sections we cannot skip, we have to discuss because questions will come in the examination. Next, one note point is there here. Loan taken in previous year 21-22, 80 lakhs, interest rate 10%. In 21-22, interest 8 lakhs paid. In 22-23, interest is 8 lakhs, that interest is not paid. In 23-24, interest is 8 lakhs, that is also not paid. In 24-25, interest is 8 lakhs, that is also not paid. In 25-26, interest is 8 lakhs, that is also not paid. Now, how much is outstanding interest? Outstanding interest is 32 lakhs. One day, bank people came to the business of SSC. They demanded SSC to pay 32 lakhs interest. SSC said, I cannot pay 32 lakhs interest. So bank people have done restructuring. So first loan is 80 lakhs. Whatever the outstanding interest is there, this is deemed, they treated like they converted this outstanding interest as second loan, repayable in 60 months. How many months repayable in 60 months? So 32 lakhs divided by 60 months. How much? 53,333 per month. Okay. Now, just because 32 lakhs is converted into second loan, you cannot claim 32 lakhs as deduction in P&L account. Are you able to understand? See, original nature is interest only 32 lakhs. Just because 32 lakhs interest is converted into second loan, it does not mean you cannot deem 32 lakhs as paid to bank. You cannot claim 32 lakhs as deduction. Okay. Out of 32 lakhs, whatever the amount that you actually pay, only that amount is allowed as deduction as per 43B. For example, in 24-25, you paid 7 installments. So 7 into 53,333. How much? 3,73,331. Only this much amount is allowed as deduction. Okay, total 32 lakhs, it is not allowed as deduction. So whenever outstanding interest is converted into second loan, total outstanding interest don't claim as deduction. Whenever restructuring is done, don't claim outstanding interest as deduction. You cannot claim it as deduction. Out of that outstanding interest, after restructuring, how much interest you actually paid, only that much amount is eligible for deduction under section 43B. Okay. Next we will discuss section 41. Oh, I am exhausted. Section 41. What section 41 says? In earlier years, in P&L account, if you claim any deduction, that deduction can be either expense or loss or outstanding expense, outstanding expenditure. With regard to that, if any benefit is received in future, any benefit received in future, that benefit is taxable as deemed profits. Taxable as deemed profit. Are you able to understand? For example, in earlier years, you claimed bad debts as deduction. Bad debts. In future, there is a recovery of bad debts. Recovery of bad debts is taxable as deemed profits under section 41. Did you understand? Next, second example. Earlier years, there is loss of stock. When there is loss of stock, you will debit loss of stock to P&L account. With regard to loss of stock, you received insurance compensation. Now, in future, whenever you receive insurance compensation with regard to loss of stock, that insurance compensation is taxable as deemed profits under section 41. Are you able to understand? You claimed outstanding expenditure audit fees 80,000 rupees. That means what? You did not pay 80,000. Let's say in previous year 22-23, you claimed 80,000 as audit fees. In P&L account, you claimed 80,000 as deduction. In previous year 24-25 or in previous year 25-26, you came to me and said, sir, audit fees 80,000 rupees. Right now I am into losses. I am into bankruptcy. I cannot pay 80,000 rupees. So what I have done, I have written 80,000 as bad debts in my books of accounts. Now there is cessation of liability. Cessation means what? Cancellation of liability. Cancellation of liability. When there is cancellation of liability, the total 80,000 is treated as deemed profits. Okay, 80,000 deemed profits under section 41. So, whenever you claim any expenditure on accrual basis in earlier years, outstanding expenditure, with regard to that expenditure, if there is cancellation of liability or reduction of liability, whatever the liability that is reduced, that liability reduced is treated as deemed profits and it is taxable under section 41. Okay, next. There is remission of liability. Remission means what? Nothing but reduction of liability. For example, you said, sir, 80,000 is audit fees. I can pay 60,000, 20,000 I cannot pay. So 60,000 paid, 20,000 waived off. Now, whatever 20,000 waived off is there, this 20,000 is a reduction in liability, right? Now, this 20,000 is taxable as deemed profits under section 41. Are you able to understand? I hope you got clarity. So, in earlier years, if you claim any outstanding expenditure, with regard to that, in future, there is cessation of liability or reduction of liability that will be treated as deemed profits and it is taxable under section 41. So, you can read this, you will understand. Even these examples also you play, you read, you will be able to understand. cessation, remission, examples are there. You please read these examples, you will get clarity. Yes, now let us see remaining PGBP concepts. In this video, let us finish off all the remaining concepts of PGBP. 43 CB. See, in case of construction contracts, you all know construction, in case of construction contracts, it will take longer period of time to complete the construction projects. It will take 2 years, 3 years. Some construction projects will take 5 years to finish. So whenever you are doing calculating income for construction contracts, income for construction contracts is recognized based on percentage of completion method. So at the end of every year, engineer will give the report how much percentage of project is completed. Out of, like, whatever the percentage of project is completed, that percentage should be applied to total contract revenue. Let's say in first year 35% of project is completed. So out of total contract revenue, 35% of contract revenue will be recognized in current year. Are you able to understand? So in case of construction contracts, income will be recognized based on percentage of completion method, POCM method. But there are exceptions. Profits and gains arising from contract for providing services with a duration of not more than 90 days shall be determined on the basis of project completion method. See, there are small constructions which will hardly take less than 90 days. So when you are recognizing revenue for such short-term contracts which take less than 90 days to finish, when you are recognizing contract revenue, then you have to recognize contract revenue based on project completion method. What do you mean by project completion method? That means whenever you are doing construction contracts for less than 90 days, in that case, whenever project is completed, in that year you will recognize the revenue. Let's say on 15th March 2025, you got construction contract. Duration is very less. Duration is 50 days. Now, this will be completed in 25-26, right? In 25-26 only, revenue will be recognized. Are you able to understand? Here, construction contract is for less than 90 days. Am I correct? So, when construction contract is for short-term period, short-term project like periodicity less than 90 days. For those projects, don't consider percentage of completion method. In which year the project gets completed, in that year only recognize the revenue. Are you able to understand? Next, involving indeterminate number of acts over a specific period of time shall be determined on the basis of straight line method. What do you mean by this? See, 43 CB not only applicable for construction contracts, it is also applicable for service contracts. So, what second exception is? For example, there is me and there is client. I entered into internal audit agreement with the client. In that internal audit agreement, I said I will do internal audit on a monthly basis. Okay. Now, what is contract value? Contract value is 1,20,000 per annum. In this case, every month I have to do internal audit of that company. That company is liable to pay 1,20,000 rupees to me. So here same services are provided every month. Okay, so if same services are repeated over a period of time, then contract revenue is required to be recognized proportionately. Are you able to understand? That means what? Let's say April audit done. After April audit is done, I have to recognize proportionate. 1,20,000 is per annum. For 1 month, how much? 1,20,000 divided by 12 months. How much? 10,000 rupees. So April audit done, I have to recognize 10,000 per month audit fees in my books of accounts. Are you able to understand? May month audit done. Again, I have to recognize 10,000 audit fees. June month audit done, I have to recognize 10,000 audit fees. So are you able to understand? So like whenever you are providing same service on a repetitive basis over a period of time, then that contract revenue is to be recognized proportionately. Are you able to understand? So, involving indeterminate number of acts over a specified period of time shall be determined on the basis of straight line method. Straight line method means what? Whatever the contract revenue is there, that you will divide it by number of months on a straight line basis. Okay. Next, retention money. Do you know the concept of retention money? Let's say I have completed 35%. Let's say contract revenue is 80 crores. Now, how much I will ask the I will ask the client to pay 80 crores into 35%. How much it will be? 28 crores. Now, client will not pay 28 crores. Client will retain 4 crores. Retention money 4 crores. Balance 28 crores will be paid to me. Sorry, balance 24 crores will be paid to me. In this case, whether like I raised bill for 28 crores, but did I get 28 crores? I got only 24 crores. Now, how much is my contract revenue? 28 crores will be considered as income under PGBP. Are you able to understand? So, whatever the retention money is there, retention money is also considered as income for the purpose of PGBP income calculation. Are you able to understand? Next, section 43D, special provision for taxation of interest on bad and doubtful debts in case of public financial institutions, etc. See, you all know NPAs, right? Non-performing assets. NPAs. NPA, when we call a loan as NPA, non-performing asset, if installment of that loan is not paid and it is outstanding for more than 90 days, then we call that loan as non-performing asset. So, in case of NPAs, there will be interest accrued, right? There will be interest accrued. But did we receive interest? We did not receive interest. Now, the point is whether this interest income, on this interest income, are we required to pay tax? Whether this interest income is taxable or not, that is the question. See, non-performing asset means any loan for which installment is not paid by the client. If client do not pay installment, then we did not receive interest income, but we are following accrual basis of accounting. We need to recognize interest accrued. But the question is, under income tax, whatever the interest on NPAs is there, it is not realized. On unrealized interest on NPAs also, are we required to pay tax? That is the question. For that, special provision was written in income tax, that is section 43D. What section 43D says? Like in case of NPAs, in case of interest on non-performing assets, how that interest income is to be recognized? Interest income on such category of bad and doubtful debts as prescribed by RBI shall be taxable on cash or accrual basis, whichever is earlier. That means what? In case of interest on NPAs, what Income Tax Act is saying, whatever RBI says, do that. If RBI says recognize interest on accrual basis, in income tax also recognize interest on accrual basis. If RBI says recognize interest on cash basis, in income tax also recognize interest on cash basis. So, interest on NPAs is recognized as per and taxable as per RBI guidelines. Okay. Generally, interest is recognized on accrual basis, normal interest. But interest on non-performing assets, whatever that interest is there, whatever RBI says, accordingly it is taxable. If RBI says it is taxable on accrual basis, under income tax also that interest income is taxable on accrual basis. If RBI says that interest income is taxable on cash basis, the interest income under income tax also it is taxable on cash basis. that is 43D. I hope you got clarity. Next we will discuss 44AA. Shall we discuss 44AA? Section 44AA answers 3 questions. Question 1. What books of accounts are required to be maintained? Question number 2. Place where books of accounts are required to be maintained. Question 3. Period for which books of accounts are required to be maintained. These 3 questions. Generally, books of accounts are required to be maintained for a period of 6 years from end of assessment year. Remember, not from end of previous year, from end of assessment year. Books of accounts are required to be maintained for a period of 6 years from end of assessment year. If you calculate from end of previous year, books of accounts are required to be maintained for 7 years. Are you able to understand? Next, place where books of accounts are required to be maintained. Generally, books of accounts are required to be maintained at place of business or place of profession. That means the place where business is going on, the place where profession is going on, in that place books of accounts are required to be maintained. However, if there are multiple places, okay, for example, Pullareddy Sweets is there. In Hyderabad only 7 branches are there where books of accounts are required to be maintained at head office. So if there are multiple places of business, books of accounts can be maintained at principal place of business or principal place of profession. Are you able to understand? So generally books of accounts are to be maintained at place of business, place of profession. If there are multiple places of business, books of accounts are to be maintained at principal place of business or principal place of profession. Next, if there are branches to the business, books of accounts relating to branches can be maintained at respective branch offices. Are you able to understand? So 3 simple points. Generally books are to be maintained at principal place of place of business or place of profession. If there are multiple places, maintain books at principal place of business. If there are branches also, books of accounts relating to branches can be maintained at respective branch offices. Okay. Next, question 1. What books of accounts are required to be maintained? First, notified professionals, business SSCs and non-notified professionals. Who are called as notified professionals? Legal profession, advocate profession, doctor profession, engineering profession, architectural profession, accountancy, technical consultancy, interior decoration, authorized representative, film artist. Film artist means director, actor, producer, lyricist. All will be considered as film artist. Company secretary, information technology profession. All these are treated as not notified professionals. So, like for notified professionals, separate books of accounts are required to be maintained. For business SSCs and non-notified professionals, separate books of accounts are required to be maintained. First, we will discuss in case of business SSCs and non-notified professionals. Shall we discuss? Business SSCs and non-notified professionals. See, there are 2 criteria: income criteria, turnover criteria. Out of these 2 criteria, if one criteria is satisfied, sufficient books of accounts are required to be maintained. That means conjunction is or. That means income criteria satisfied, maintain books. Income criteria not satisfied, turnover criteria satisfied, maintain books of accounts. If income criteria is not satisfied, turnover criteria is also not satisfied, then you are not required to maintain books of accounts. Okay, next, income criteria. What income criteria? What is current previous year? 24, 25. Ignore current previous year. Chod do. Don't consider current previous year. Take last 3 previous years. What are last 3 previous years? 23, 24, 22, 23, 21, 22. What is conjunction? Conjunction is or. That means in last 3 previous years, for any one of the previous year, in case of individual or HUF, criteria is 2,50,000. In case of other persons, 2,50,000. In case of other persons, 1,20,000. 1,20,000. So, in last 3 years, for any one of the previous year, in case of individual or HUF, if total income is more than 2,50,000, okay, then minimum books of accounts are required to be maintained. Otherwise, no books of accounts are required to be maintained. So the thing is, in case of individual or HUF, if total income is more than 2,50,000, if total income is more than 1,20,000, if answer to above question is yes, then minimum books of accounts are required to be maintained. If answer to above question is no, then no books of accounts are required to be maintained. Minimum books of accounts means ledger and cash book. Okay, so did you understand? Income criteria. Income criteria, ignore current previous year, take last 3 previous years. Out of last 3 previous years, for any one of the previous year, if in case of individual or HUF, if total income is more than 2,50,000, in case of other persons, if total income is more than 1,20,000. If answer to these questions is yes, then you need to maintain minimum books of accounts. Otherwise, you are not required to maintain any books of accounts. Okay, next, turnover criteria, same as it is. Ignore current previous year, 24, 25. Take last 3 previous years, previous year 23, 24, previous year 22, 23, previous year 21, 22. Conjunction is or. That means out of last 3 previous years, in case of individual or HUF, if turnover is more than 25 lakhs, in case of others, if turnover is more than 10 lakhs, if answer to this question is yes, then you need to maintain minimum books of accounts. That means ledger and cash book. If answer to this question is no, that means in case of individual or HUF, turnover is less than 25 lakhs in last 3 previous years, then you are not required to maintain any books of accounts. No books of accounts are required to be maintained. Okay. So either income criteria or turnover criteria. If any one of the criteria is satisfied, minimum books, ledger and cash book are required to be maintained. Otherwise, no books of accounts are required to be maintained. I hope you got clarity. Yeah, minimum those books of accounts are required to be maintained. If you want, you can maintain additional books of accounts also. But minimum ledger and cash book are required to be maintained. Because if ledger and cash book are maintained, using them, assessing officer can calculate the total income. Okay. Next, in case of notified professionals, there is one small mistake. Please rectify. In case here, Turnover is not 2.5 lakhs, turnover is 25 lakhs. Please change 25 lakhs. Turnover is not 2.5 lakhs, it is 25 lakhs. If business is started newly in current previous year only, we will estimate the turnover. In case of individual or HUF, if estimated turnover is more than 25 lakhs, then minimum books of accounts are required to be maintained. If estimated turnover in case of other persons is more than 10 lakhs, then minimum books of accounts are required to be maintained. Okay. Next, notified profession, turnover criteria. Notified professionals. No, like in case of business people and non-notified professions, two criteria are there. Income criteria, turnover criteria. But in case of notified professionals, only turnover criteria is there. So ignore current previous year 24-25. छोड़ दो. Take last three previous years. Previous year 23-24. Previous year 22-23. Previous year 21-22. What is the conjunction? Conjunction is and. For all three previous years, criteria is to be satisfied. So, for all three previous years, if gross receipts are more than 1.5 lakhs, what is the conjunction? And you have to consider for all three previous years. For all three previous years, if gross receipts is more than 1,50,000. In that case, if answer to this question is yes, then books of accounts as per rule 6F are required to be maintained. If answer to this question is no, then minimum books of accounts are required to be maintained. That means notified professionals, they cannot escape from maintaining books of accounts. Like if criteria is satisfied, as per rule 6F, they are required to maintain books of accounts. If criteria is not satisfied, then minimum books of accounts are required to be maintained. Are you able to understand? Now, what are books of accounts as per rule 6F? Cash book, journal, ledger, carbon copies of bills and receipts exceeding 25 rupees. So, more than 25 rupees, more than 50 rupees, if you give money or if you take money, you have to maintain the bills and vouchers. Okay. Next, vouchers and bills for expenses. And if notified professional is doctor, if notified professional is medical profession, then along with this rule 6F books of accounts, additionally they are required to maintain daily case register and they are required to maintain opening stock and closing stock of drugs and medicines. Okay, those are required to be maintained. Yes, one question here is whether aggregate turnover of all 3 years should exceed 1.5 lakhs. Yes, all 3 years, every year turnover should be more than 1.5 lakhs. Then only books of accounts as per rule 6F. For any year, if turnover is less than 1.5 lakhs, then minimum books of accounts are required to be maintained. So that is all about section 44AA. All 3 years. Shall we discuss 44AB? Tax audit. In case of business people, business SSEs, one or more businesses aggregate turnover. If aggregate turnover is more than 1 crore, then tax audit is applicable. They are required to get their books of accounts audited under Income Tax Act. If aggregate turnover is less than 1 crore, then tax audit is not applicable. They are not required to maintain books of accounts. They are not required to get tax audit done. But there is one exception. One exception. What is that one exception? Whenever a client comes to you, you have to ask all businesses together if aggregate cash receipts are less than or equal to 5% of total receipts. And if aggregate cash payments are less than or equal to 5% of total payments. If answer to this question is yes, then threshold limit is 10 crores. If answer to this question is no, then threshold limit is 1 crore. That means in your business, cash receipts are very low, minimal, less than 5% of total receipts. And along with that, cash payments are less than 5% of total payments. That means cash transactions are less than 5% now. If cash transactions are less than 5%, up to 10 crores, tax audit is not required because 95% of transactions are done through bank. If 95% of transactions are done through bank, that information will go to income tax department. If that information goes to income tax department, so like income tax department can verify it. So that's why up to 10 crore rupees tax audit is not required. Are you able to understand? So in this case, if turnover is less than 10 crores, then tax audit is not applicable. If turnover is more than 10 crore, then tax audit is applicable. Here, if turnover is less than 1 crore, tax audit is not applicable. If turnover is more than 1 crore, then tax audit is applicable. Are you able to understand? So generally for businesses, threshold limit is 1 crore. However, in business, if cash receipts are less than 5% of total receipts and cash payments are less than 5% of total payments, in that case, threshold limit of 1 crore, and like if both conditions are satisfied, C1 and C2, both conditions are satisfied, threshold limit is 10 crores. Up to 10 crores tax audit is not required. More than 10 crores tax audit is required. Okay. Next, in case of professionals, one or more professions. See, I'm in two professions. I'm CA in practice. I'm also doing teaching. So, two professions combined turnover you have to take. So, one or more professions together. Aggregate gross receipts. If aggregate gross receipts are less than or equal to 50 lakhs, then tax audit is not applicable. If aggregate gross receipts are more than 50 lakhs, then tax audit is applicable. Are you able to understand? So for business people, criteria 1 crore or 10 crore. For those who are engaged in profession, criteria is 50 lakhs. If gross receipts are more than 50 lakhs, then they are required to maintain books of accounts. If gross receipts are less than 50 lakhs, then they are not required to maintain books of accounts. Okay. Next, what is the due date for submitting tax audit report? Due date for tax audit report. Due date is 1 month before ITR due date under section 139(1). What do you mean by this? Generally, whenever tax audit is applicable, ITR due date is 31st October of assessment year. 1 month before means 30th September, okay? 30th September of assessment year. On or before 30th September of assessment year, tax audit report is required to be submitted. ITR is required to be submitted on or before 31st October of assessment year. That is the due date. Next, sir, what if tax audit is not done? If you do not get your tax audit done, then penalty will be levied. Tax audit report is required to be submitted before 30th September of assessment year. If you do not get your tax audit done, penalty is equal to 0.5% of turnover or 1,50,000, whichever is lower. That is the penalty. I hope you got clarity about 44AB. Next we will discuss, you read these examples, clarifications, you will understand. I have discussed the concept, you will understand. Next, 44AD, 44ADA, 44AE. These sections we call as presumptive provisions. Yeah, one question from Aishwarya, is there any penalty for non-maintenance of books of accounts? Yes. If you do not maintain books of accounts, penalty is 25,000 rupees. Okay. Next, 44AD. See, small businesses will be there. They cannot maintain books of accounts. Let's say like small hotel is there. Daily it will sell tiffins. But you know, small businesses, can they maintain books of accounts? Or small shop is there, retail shop, fancy shop, it will sell all the goods. Turnover is more than 1 crore, but when you see inventory, 1500 items, 1800 items will be there. How can you maintain books of accounts for 1800 items of a 1 crore turnover business? Hardly their margin will be 5 to 10%. Even though they do turnover of 1 crore, hardly their income will be 5 to 10 lakhs. If they maintain books of accounts, for maintaining books of accounts, for paying for accounts only, it will cost 3 to 4 lakhs. It will be a huge expenditure. So to give relief to small taxpayers, small business people, 44AD was introduced. So if you are paying tax under 44AD, you are not required to maintain books of accounts. You are not required to get your books of accounts audited. So like books of accounts are not required to be maintained. Tax audit is also not required to be done. Okay. So then you will maintain the details of turnover. On turnover, certain percentage you will offer as presumptive income. Are you able to understand? So that section we call as section 44AD. So business people, they have option. Either they can maintain complete books of accounts or they can choose 44AD. If they choose 44AD, they will not pay tax on actual income. They will pay tax on estimated income or presumptive income. On turnover, 8% of turnover or sometimes 6% of turnover, that will be taken as presumptive income, and on that presumptive income, they are required to pay tax liability. Are you able to understand? So that section 44AD. Now let us see further. Who can choose 44AD? resident individual, resident HUF, resident partnership firm, but not LLP. LLP cannot choose 44AD and non-resident cannot choose 44AD. Resident individual, resident HUF, resident partnership firm. These three only can choose 44AD. Okay, next. If they are claiming deduction under section 10AA, then also they cannot choose 44AD. So simply resident individual, resident HUF, resident partnership firm. If they are not claiming 10AA deduction, then only they can choose 44AD. Okay, next. They should be in which business? To choose 44AD, what is the criteria? They should be in any business or any profession other than person income, earning income in the nature of commission or brokerage, nothing but agent. If you are in agency business, you cannot choose 44AD. Okay, next, notified professional. Notified professional also cannot choose 44AD because for notified professional there is separate section 44ADA. Okay, next, person engaged in the business of plying, hiring or leasing goods carriages. See, those who are engaged in the business of plying, hiring or leasing goods carriages, for them separate section 44AE is applicable. So who can choose 44AD? Any businessman can choose 44AD other than agency business, other than notified professional, because for notified professional another section is there, 44ADA, other than person engaged in the business of plying, hiring or leasing of goods carriages. Other than these three persons, remaining all can choose 44AD. Okay, next. Up to which turnover they can choose 44AD? That is the question. In business, if cash receipts are less than or equal to 5% of total receipts. If cash receipts are less than or equal to 5% of total receipts. If answer to this question is yes, then threshold limit is 3 crores. If answer to this question is no, then threshold limit is 2 crores. That means in this case, if turnover is less than 3 crores, then 44AD can be chosen. If turnover is more than 3 crores, in that case, you cannot choose 44AD. 44AD cannot be chosen. Here, if turnover is less than 2 crores, you can choose 44AD. However, if turnover is more than 2 crores, then 44AD cannot be chosen. Okay, as simple as that. So whenever a business person comes to you, you have to ask the question in your business whether cash receipts are less than 5% or more than 5%. If cash receipts are less than 5%, up to 3 crores, 44AD can be chosen. If cash receipts are more than 5 crores, then more than 5%, then up to 2 crores only 44AD can be chosen. Okay. Next, how much is presumptive income? Presumptive income is equal to %6 of bank turnover plus 8% of cash turnover. Let's say you are into supermarket business. In supermarket, cash turnover is 60 lakhs. Bank turnover is 80 lakhs. You will apply, or bank turnover is 90 lakhs. On cash turnover, what is the percentage? 8%. On bank turnover, what is the percentage? 6%. So tell me how much? 6 8s are 60 lakhs into 8%, 4,80,000 plus 90 lakhs into 6%, 5,40,000. total 10,20,000 will be treated as presumptive income. Are you able to understand? Now, did you understand how we calculated presumptive income? Next. There is one point. For any previous year, if you choose 44 AD, for next 5 years also, you should disclose income under 44 AD only. For example, in previous year 2021, you chose 44 AD. That means you paid taxes under 44 AD. For next 5 years also, you should pay tax under 44 AD. So, in 21-22, 22-23, 23-24, 24-25, 25-26, like for next 5 years, you should pay tax under 44 AD. That is the rule. But what happened? In 21-22, you paid taxes under 44 AD. In 22-23 also you paid taxes under 44 AD. In 23-24, you did not pay tax under 44 AD. That means you are violating the rule. What is the rule? In any year, if you choose 44 AD, for next 5 years, you should choose 44 AD. But yeah, kind of lock-in period. In next 5 years, if you come out of 44 AD, there is punishment. What is punishment? For next 5 years, you cannot choose 44 AD. You cannot choose 44 AD. That means what? For 26-27, 27-28 and 28-29, you cannot choose 44 AD. That is the punishment. So, in these years, the year in which you came out of 44 AD and in next 5 years where you are ineligible to choose 44 AD, in these 5 years, if total income is more than basic exemption limit, then you need to maintain books of accounts. You are required to get your books of accounts audited by a chartered accountant. You are required to maintain books of accounts. You are required to get tax audit done. Are you able to understand? So this is the scenario. I hope you got clarity. First, any year you choose 44 AD, next 5 years you have to pay tax under 44 AD, lock-in period. But if you come out of 44 AD, next punishment, next 5 years you cannot choose 44 AD, and the year in which you came out of 44 AD, in next 5 years, if total income is more than basic exemption limit, then you are required to maintain books of accounts. You are required to get books of accounts audited by a chartered accountant. Generally, under 44 AD, you are not required to maintain books of accounts. You are not required to get tax audit done. But in this exceptional scenario, you are required to maintain books of accounts. So, Aishwarya, have one doubt here. Even if turnover exceeds 10 crores, we have to declare 8% or 6%, sir. No. If turnover exceeds more than 10 crores, you have to disclose actual income only. In that case, this will not be treated as violation. Voluntarily, you are not coming out of 44 AD. You are coming out of 44 AD by provision. Then, not a problem. Intentionally, you want to disclose lower profits than 8% or 6%, or you wanted to disclose loss. For that purpose, you came out of 44 AD. Then it will be treated as violation. Yes, for loss means what? You are not disclosing minimum 8% or 6%. Then it is violation of 44 AD. Next, if you are paying taxes under 44 AD, section 30 to 38 expenses are not allowed as deduction. Are you able to understand? Next, those who are paying taxes under 44AD, generally advance tax will be paid in 4 installments. But if you are paying taxes under 44AD, you are not required to pay advance tax in 4 installments. It is sufficient if you pay entire advance tax in a single installment before 15th March of previous year. Okay, so only one due date for payment of advance tax for those who are paying taxes under 44AD. Next, we will discuss 44 ADA. Notified professionals. See, who can choose 44 ADA? Only notified professionals can choose 44 ADA, and that too they should be resident in India. So resident individual, resident partnership firm other than LLP, they can choose 44 ADA. Who can choose notified professionals? Then what is the criteria? For notified professionals, in profession, if gross receipts, if cash receipts are less than or equal to 5% of total receipts. If answer to this question is yes, then threshold limit is 75 lakhs. Up to 75 lakhs, they can disclose income under 44 ADA. If answer to this question is no, then threshold limit is 50 lakhs. Up to 50 lakhs, they can disclose income under 44 ADA. Next, how much is presumptive income? Presumptive income is equal to 50% of gross receipts. Did you understand? Next, see, for 44 ADA, lock-in period wala concept is not applicable. That means every year minimum 50% of gross receipts are to be offered as presumptive income. In any previous year, if you offer actual income which is less than 50% of gross receipts, and if total income is more than basic exemption limit, in this case, you need to maintain books of accounts, you need to get tax audit done. Are you able to understand? So that's what. Every year, notified professional, minimum he is required to offer 50% of gross receipts as presumptive income. In any previous year, if he offers actual income which is less than presumptive income, and in that year, if his total income is more than basic exemption limit, he is required to maintain books of accounts, he is required to get tax audit done. Once he chooses 44 ADA, section 30 to 38 expenses, they are not allowed as deduction. And if they are paying taxes under 44 ADA, for them also there is only one due date for payment of advance tax, that is 15th March of previous year. Are you able to understand? Next, 44 AE. Any SSC can choose 44 AE, any SSC, whether he is individual, partnership firm, HUF, company, all SSCs can choose 44 AE. Next, they should be engaged in the business of plying hiring or leasing of goods carriages. They only can choose 44 AE. Simply goods transport business. Okay, they can choose 44 AE. There is criteria. Whoever the goods transport business that wants to choose 44 AE, in that business, the owner, he should not own more than 10 vehicles at any time during the previous year. That means if owner owns maximum 10 vehicles, then only he can choose 44 AE. On any day, if owner owns more than 10, 11 vehicles, then he cannot choose 44 AE. Are you able to understand? Next, heavy goods vehicle. How much is presumptive income? Before I explain presumptive income, you need to know two words: heavy goods vehicle, light goods vehicle. When we call a vehicle as heavy goods vehicle, if weight, gross weight of vehicle is less than or equal to 12,000 kgs or less than or equal to 12 tons, that vehicle, that vehicle we call as light goods vehicle. If gross weight is more than 12,000 kgs or more than 12 tons, then we call it as heavy goods vehicle. Okay, more than 12,000 kgs heavy goods vehicle, up to 12,000 kgs that vehicle we call as light goods vehicle. For light goods vehicle, presumptive income is equal to 7,500 per month or part of the month. For heavy goods vehicle, presumptive income is equal to 1,000 rupees per ton per month or part of the month. Let's say 18,000 kgs vehicle. That means it is 18 tons, right? Presumptive income is equal to 1,000 rupees into 18 tons into, if that vehicle is used for 12 months, how much? 2,16,000 will be treated as presumptive income. Did you understand? For a heavy goods vehicle, presumptive income is equal to 1,000 rupees per ton per month or part of the month. For light goods vehicle, presumptive income is equal to 7,500 per month or part of the month. Next, see, maximum owner should own 10 vehicles. While calculating ownership of 10 vehicles, if any vehicle is purchased on hire purchase basis, even that vehicle will also be considered in calculation of 10 vehicles. Clear? Next, another important note point. You purchased vehicle, purchased in May 2024, put to use from September 24. Now, put to use is irrelevant. The month in which you purchase, from this month only you are required to calculate presumptive income. Are you able to understand? So, for depreciation, put to use is required. For calculating presumptive income, depreciation is not required. For calculating presumptive income, like from month of purchase only, you are required to calculate presumptive income. Are you able to understand? Next, if they are choosing 44 AE, 4 installments are applicable. For advance tax, normal provision, they are required to pay advance tax in 4 installments. Another important point, under 44, like let's say every year you are required to disclose minimum presumptive income in any previous year. If actual income is less than presumptive income, then you are required to maintain books of accounts, you are required to get tax audit done. So if you are in goods transport business, every year minimum you should disclose presumptive income. In any year, if you disclose your actual income which is less than presumptive income, you need to maintain books of accounts, you need to get tax audit done. Are you able to understand? Common points. See, if you want to disclose income higher than presumptive income, will Nirmalamma say no? Let's say presumptive income. We have done one example, supermarket example. In supermarket example, presumptive income is 10,20,000. I wanted to disclose actual income of 14 lakhs. Will Nirmalamma say no? If we disclose more income, we will pay more tax. If government is getting more tax, will government say no? No. So if you want to disclose income higher than presumptive income, you can disclose actual income higher than presumptive income, not a problem at all. Okay. And from presumptive income, you can set off chapter 6A deductions, you can set off losses also. Next one last section is there, section 44 DB. Special provisions for deduction in case of business reorganization of cooperative banks. See, nowadays there is lot of restructuring among banks. 2 or more banks are getting merged. Some banks are getting demerged. So if there is amalgamation of cooperative bank or demerger of cooperative bank, conversion of primary cooperative bank, then section 32 depreciation, section 35D preliminary expenses, section 35DD amalgamation expenses, section 35DDA VRS expenses. See, all these expenses, they are not allowed as deduction in a single installment. They are allowed as deduction over a period of 5 years in 5 equal installments. Correct? So, see, if amalgamation happens at the beginning of the year, not a problem at all. But if amalgamation happens in the middle of the year, then whatever the expenses are there, they are to be allocated, they are to be apportioned proportionately between predecessor and successor. Let's say there is amalgamation of cooperative banks. Amalgamation took place on 10th November 2025. So what we will do from 1st April 25, okay, 1st April 24, 10th November 24. From